आइए हम तालियों के साथ स्वागत करेंगे अपने चीफ गेस्ट का। नमस्कार। समर्पित और प्रभावी नीतियों के आधार पर एक सशक्त और समृद्ध भारत का निर्माण करने में पूरी तरह से समर्पित माननीय वित्त राज्य मंत्री भारत सरकार श्री पंकज चौधरी जी का हम प्रथम अंतर्राष्ट्रीय पेंशन शोध सम्मेलन 2025 के शुभारंभ पर हार्दिक अभिनंदन करते हैं, स्वागत करते हैं। यह PFRDA द्वारा IIM अहमदाबाद के सहयोग से भारत को एक पेंशन युक्त समाज बनाने के महत्वाकांक्षी लक्ष्य को प्राप्त करने की दिशा में एक महत्वपूर्ण कदम है। आज हम अपने बीच में माननीय वित्त राज्य मंत्री भारत सरकार की उपस्थिति से गौरवान्वित महसूस कर रहे हैं। सर, हम आपका स्वागत करते हैं, वंदन करते हैं। साथ ही हम अपने आप को सौभाग्यशाली मानते हैं कि माननीय सचिव वित्तीय सेवाएं भारत सरकार श्री नागराजू मदिरला जी हमारे बीच उपस्थित हैं। सर, हम आपका भी सहर्ष स्वागत करते हैं, अभिनंदन करते हैं। साथ ही साथ हम आभार प्रकट करते हैं हमारे बीच उपस्थित प्रोफेसर भारत भास्कर, निदेशक IIM अहमदाबाद का। हम सादर स्वागत करते हैं डॉक्टर दीपक मोहंती, अध्यक्ष PFRDA का। हम अभिनंदन करते हैं डॉक्टर मनोज आनंद, पूर्णकालिक सदस्य वित्त PFRDA का। हम स्वागत करते हैं सभी सम्मानित अतिथियों का जो वित्त मंत्रालय, अन्य वित्तीय क्षेत्रों और आज के कार्यक्रम में हमारे बीच वीडियो कॉन्फ्रेंसिंग के माध्यम से जुड़ रहे वक्ता और पैनलिस्ट्स हैं। आप सभी का भी हम हार्दिक अभिनंदन करते हैं। अब मैं अध्यक्ष PFRDA से अनुरोध करती हूँ कि वे माननीय वित्त राज्य मंत्री भारत सरकार को शॉल भेंट करके उनका स्वागत इस शुभ अवसर पर उपस्थिति के लिए करें। धन्यवाद सर। मैं अध्यक्ष PFRDA से अनुरोध करती हूं कि वे माननीय सचिव वित्तीय सेवाएं भारत सरकार को शॉल भेंट करके उनका स्वागत करें। धन्यवाद सर। अब मैं वापस से अध्यक्ष महोदय से अनुरोध करती हूं कि वे माननीय प्रोफेसर भारत भास्कर, निदेशक IIM अहमदाबाद को शॉल भेंट करके उनका स्वागत करें। धन्यवाद सर। रिटायरमेंट के समय वित्तीय सुरक्षा सुनिश्चित करना व्यक्तियों की सुखमय वृद्धावस्था के लिए अत्यंत आवश्यक है, विशेष रूप से जब दुनिया भर में जनसंख्या बढ़ रही है और लोग दीर्घायु प्राप्त कर रहे हैं। सही पेंशन योजनाएं आय सुरक्षा देने और लंबे जीवन के जोखिम को कम करने में मदद करती है। इस संदर्भ में PFRDA और IIM अहमदाबाद पेंशन पर एक 2 दिवसीय शोध सम्मेलन आयोजित कर रहे हैं, जहां पेंशन प्रणालियों की वैश्विक चुनौतियों को आर्थिक, पर्यावरण और समाज से जुड़ी समस्याओं पर चर्चा होगी। IRCP 2025 सम्मेलन में सरकार के अधिकारी, वित्तीय क्षेत्र के प्रमुख, विद्वान और उद्योग विशेषज्ञ एक साथ आएंगे, जहां वे शोध साझा करेंगे, नए समाधान पर चर्चा करेंगे और पेंशन प्रबंधन और सामाजिक सुरक्षा जैसे विषयों पर चर्चा करेंगे। जैसा कि हम सब जानते हैं कि हमारी भारतीय संस्कृति में हर शुभ अवसर ईश्वर की वंदना और आशीर्वाद के साथ ही शुरू किया जाता है। इसीलिए हम इस कार्यक्रम की शुरुआत दीप प्रज्वलन एवं सरस्वती वंदना के साथ करेंगे और ईश्वर से सबकी समृद्धि और कल्याण की कामना करेंगे। मैं अब निवेदन करती हूँ कि मंच पर उपस्थित सभी गणमान्य अतिथि दीप प्रज्वलन की कृपा करें।
या कुन्देन्दु तुषारहार धवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्कर प्रभृतिभिर्देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा शुक्लां ब्रह्मविचारसार परमाम् आद्यां जगद्व्यापिनीं वीणापुस्तकधारिणीम् अभयदां जाड्यान्धकारापहाम्।
सभी का धन्यवाद सर। अब मैं डॉक्टर मनोज आनंद, पूर्णकालिक सदस्य वित्त PFRDA से स्वागत भाषण देने का निवेदन करती हूँ। प्लीज सर।
माननीय वित्त राज्य मंत्री श्री पंकज चौधरी जी, सचिव वित्तीय सेवाएं श्री M नागराजू जी, PFRDA के अध्यक्ष डॉक्टर दीपक महांती जी, IIM अहमदाबाद के निदेशक प्रोफेसर भारत भास्कर जी, अंतर्राष्ट्रीय प्रतिनिधि, मीडिया कर्मी, विशिष्ट अतिथिगण, देवियों और सज्जनों, आज इस अंतर्राष्ट्रीय शोध सम्मेलन में आपका स्वागत करते हुए मुझे बहुत गर्व और संतोष का अनुभव हो रहा है। ये सम्मेलन पेंशन क्षेत्र में ज्ञान और नवाचार के जीवंत इकोसिस्टम को बढ़ावा देने की हमारी सामूहिक संकल्पना का परिणाम है। ये सम्मेलन भारतीय प्रबंध संस्थान अहमदाबाद के सहयोग से संयुक्त रूप से आयोजित किया जा रहा है। इस सम्मेलन का मुख्य उद्देश्य अग्रणी पेंशन विनियामकों, वित्तीय क्षेत्र के विशेषज्ञों, नीति निर्माताओं और शिक्षाविदों को एक मंच पर लाना है ताकि पेंशन इकोसिस्टम के विभिन्न पहलुओं पर एक समन्वित चर्चा की जा सके, जिसमें स्थिरता, समावेशिता, पहुंच, तकनीकी नवाचार, अभिशासन और सर्वोत्तम अभ्यास शामिल हैं। पिछले कुछ वर्षों में भारतीय समाज के कार्यबल में गिग अर्थव्यवस्था जैसे महत्वपूर्ण क्षेत्र भी उभरे हैं। इसलिए पेंशन परिदृश्य में तेजी से परिवर्तन हुए हैं। गिग अर्थव्यवस्था की विविध आवश्यकताओं के अनुरूप एक लचीले, पोर्टेबल और स्केलेबल पेंशन समाधानों के अन्वेषण से गिग और अनौपचारिक तथा असंगठित क्षेत्र के श्रमिकों के लिए पेंशन कवरेज में काफ़ी वृद्धि हो रही है। डिजिटल पब्लिक इंफ्रास्ट्रक्चर और जेम ट्रिनिटी जैसे नीतिगत बदलावों के बाद भारत ने अपने सामाजिक सुरक्षा संजाल में वंचितों और असंगठित क्षेत्र के श्रमिकों को किसी न किसी रूप से शामिल करने में अच्छी प्रगति की है। लागत कम करने और गैर पारंपरिक श्रमिकों को औपचारिक पेंशन योजनाओं में शामिल करने के लिए प्रौद्योगिकी का लाभ उठाने में और समावेशी नीति डिज़ाइनिंग की दिशा में भारत का अनुभव अन्य देशों के लिए लाभदायक हो सकता है। बढ़ती हुई दीर्घायु के कारण अवित्त पोषित पेंशन देनदारियां विश्व भर में पेंशन प्रणालियों के लिए एक चुनौती के रूप में उपस्थित हुई हैं। इस संदर्भ में सरकारी कर्मचारियों के लिए परिभाषित अंशदान DC योजना के रूप में राष्ट्रीय पेंशन प्रणाली NPS को शुरू करने के लिए भारत सरकार द्वारा उठाए गए कदम और परिभाषित अंशदान DC और परिभाषित लाभ DB दोनों को सम्मिलित विशेषताओं के साथ शुरू की गई एकीकृत पेंशन योजना यूपीएस की परिकल्पना कई देशों के लिए उपयोगी हो सकती है। ये यूपीएस योजना अभी केवल केंद्र सरकार के कर्मचारियों के लिए लागू की गई है और इसमें राजकोषीय स्थिरता और पर्याप्तता को इष्टतम रूप से मिश्रित किया गया है। इसमें अभिदाताओं के लिए उनकी सेवानिवृत्ति पर प्रदान की जाने वाली सुनिश्चित पेआउट, सुनिश्चित पारिवारिक पेआउट, सुनिश्चित न्यूनतम पेआउट के साथ मुद्रास्फीति सूचकांक और एक मुश्त भुगतान जैसी कुछ अनूठी विशेषताएं शामिल हैं। एआई, ब्लॉकचेन टेक्नोलॉजी और मोबाइल प्लेटफॉर्म जैसी उभरती तकनीकों के एकीकरण में पेंशन प्रबंधन में बदलाव होने की अपार संभावनाएं हैं। ये तकनीकियां पेंशन प्रणालियों की दक्षता, उनकी पहुंच और पारदर्शिता को बढ़ा सकती हैं, जिससे व्यक्तियों के लिए उनके बचत का प्रबंधन करना तथा सरकारों और संस्थानों के लिए उनके अंशदान को ट्रैक करना आसान हो जाता है। सार्वभौमिक पेंशन कवरेज सुनिश्चित करने के लिए कुशल तकनीक का अन्वेषण किया जाना जरूरी है, क्योंकि ये अनौपचारिक क्षेत्र में श्रमिकों और कम आय वाले व्यक्तियों की ज़रूरतों को पूरा करने में विशेष रूप से प्रभावी हो सकता है। 2 दिवसों में आयोजित इस सम्मेलन के दौरान विभिन्न विषयों पर आधारित चर्चा स्तर और महत्वपूर्ण शोध पत्रों की प्रस्तुति का भी आयोजन किया गया है। ये चर्चा स्तर सुदृढ़ आय सुरक्षा, पेंशन क्षेत्र में नवाचार और विभिन्न विनियामकों के बीच समन्वय जैसे विषयों पर आधारित होंगे। अंत में मैं यहाँ उपस्थित सभी सम्मानित गणमान्य अतिथियों का पीएफआरडी की ओर से स्वागत और अभिनंदन करता हूँ। धन्यवाद।
आपका धन्यवाद सर, स्वागत भाषण के लिए और कार्यक्रम की दिशा निर्धारित करने के लिए। अब मैं डॉक्टर दीपक मोहंती, अध्यक्ष पीएफआरडीए से निवेदन करती हूँ कि वो अपना संबोधन दें। प्लीज सर।
Honorable Minister of State for Finance, Sri Pankaj Chaudhary ji, Secretary Financial Services, Sri Madirala Nagaraju ji, Director IIM Ahmedabad, Professor Bharat Bhaskar, Professor Manoj Anand, international delegates, media, distinguished guests, ladies and gentlemen. It is a moment of immense pride and satisfaction to welcome you at this landmark conference, a culmination of our collective vision to foster a vibrant ecosystem of knowledge and innovation in the pension sector. The Pension Fund Regulatory and Development Authority, that is PFRDA, has over the years embarked on a transformative journey, evolving from a nascent regulator to a dynamic force driving financial security for millions, with an objective of building a pension society in a Vikshit Bharat. The pension sector that the PFRDA regulates, covering NPS and APY, that is Atal Pension Yojana, has made steady progress with an accumulated corpus of rupees 14.4 trillion, that is 14.4 lakh crore, with 8.4 million subscribers, that means 8.4 crore subscribers. The unique character of NPS as a pension product is that it is available to all, including children. We have prioritized customer experience, introducing tech-driven initiative for seamless onboarding, transactions, and exit. Beyond our regulatory mandate, PFRDA has always aspired to be a knowledge institution. We recognize that informed policy decisions and sustained growth require a strong foundation of research, capacity building, and continued learning. This international conference, partnering with IIM Ahmedabad, is a natural progression of our commitment to fostering a culture of intellectual inquiry and evidence-based policymaking. The global pension sector is facing challenges of demographic shifts and financial sustainability. As populations age and life expectancies increase worldwide, the need for effective pension system has become more urgent than ever. a major concern in the fiscal is the fiscal impact of population aging and the need to establish sustainable funding for old age income security. In our context, the goal should be to develop a retirement income system that ensures full coverage for workers while remaining both financially viable and socially sustainable. This conference brings together experts, regulators, policymakers, and researchers to explore innovative solutions. The response has been overwhelming. There are 120 research papers from about 210 authors. Following 2 stages, double-blind review process, 8 papers have been shortlisted for conference paper presentation, and 23 papers have been shortlisted for conference poster presentation. The papers examine a number of relevant issues, such as the reason for low retirement preparation, how to make communication strategy more effective, the relationship between education, employment status, and financial security, how wages and market performance determine the replacement rate, appropriate product design to inculcate saving habits early, optimal withdrawal rates, and impact of pension wealth on economic growth. Other critical issues, including coverage and adequacy, sustainable financing, gender equality, and financial literacy, remain equally pertinent for the pension sector. These findings, no doubt, will enhance our understanding of the pension sector and help us to design better policy. The conference aims to develop inclusive pension solution for gig, platform, and informal worker, leveraging India's tech advancement, strengthen pay-as-you-go pension system through fully funded models like the unified pension system, utilize artificial intelligence to enhance accessibility and transparency in the pension management. Let us work together to build a robust and resilient pension system that safeguards the financial well-being of generation to come. I once again welcome you to this conference. Thank you.
धन्यवाद सर, आपके विचारपूर्ण संबोधन के लिए आपके शब्दों ने इस कार्यक्रम के लिए सही मार्गदर्शन दिया है। अब मैं आदरणीय मुख्य अतिथि से एकीकृत पेंशन योजना यूपीएस पुस्तिका का विमोचन करने का अनुरोध करती हूँ। धन्यवाद सर। पीएफआरडीए की अद्वितीय यात्रा को बेहतर तरीके से समझने के लिए हम अब पीएफआरडीए की यात्रा पर एक विशेष वीडियो देखेंगे। यह वीडियो पीएफआरडीए की प्रगति और वर्षों में हासिल की गई महत्वपूर्ण सफलताओं को प्रदर्शित करेगा।
Every great story begins with a vision. A vision deeply rooted in the aspiration for financial security and dignity during later years of life. To achieve this, the government established PFRDA to regulate and develop the pension sector, ensuring income security during old age. National Pension System (NPS) marked a shift toward a sustainable contributory model. In 2004, NPS was implemented for central government employees, except for the armed forces, and was adopted by most state governments. In 2009, NPS became available to all citizens. The government introduced the Atal Pension Yojana to provide assured pensions to low-income households. NPS Vatsalya empowers parents to invest in their children's future. With over 80 million subscribers and an AUM of rupees 14 trillion, NPS and APY are strengthening India's pension landscape, ensuring social security for all. As India advances, so does NPS, leveraging technology for seamless retirement planning. NPS has an unbundled architecture, making it one of the lowest cost pension systems in the world. The government introduced the Unified Pension Scheme, UPS, under NPS for central government employees. UPS is a fully funded contributory pension scheme that provides assured payouts on superannuation, balancing financial security with fiscal sustainability. PFRDA partners with global and domestic regulators to strengthen the regulatory framework and enhance financial literacy.
Pension is essential for income security and dignity. NPS has made pension accessible to all. This international conference, bringing together academia and practitioners, will provide valuable insights in our progress towards a pension inclusive society.
PFRDA, pension for every Indian, secured the future for every generation.
बहुत सुंदर प्रस्तुति। अब मैं IIM अहमदाबाद के डायरेक्टर प्रोफेसर भारत भास्कर जी को मुख्य भाषण देने के लिए आमंत्रित करना चाहूँगी। प्रोफेसर भास्कर की कुशलता और वित्तीय क्षेत्र के भविष्य के लिए उनकी सोच आज की चर्चाओं की दिशा तय करेगी। प्लीज सर।
Honorable Minister of State for Finance, Shri Pankaj Chaudhary ji, Shri Nagaraju Madirala ji, Secretary Finance, Chairperson PFRDA, Dr. Deepak Mohanty, all the whole-time members of the authority, senior officials from the ministry present here in the hall. I'm truly honored to be here at this international research conference on pension, which is jointly organized by PFRDA and IIM Ahmedabad. PFRDA actually became a statutory body, you just saw, but it has shown a substantial growth, especially in the past 10 years. Starting in 2014 with about 48,000 crore, today it has reached 14 lakh crores of assets under its management. It has grown almost 28 to 29 times in a short period of time, and the subscriber base has also grown from roughly about 65 lakh subscribers to 8+ lakh subscribers today, which has been a wonderful growth. And if we continue on the same path, probably by end of this decade, we'll have more than 30 lakh crores under the assets managed by NPS at that point of time. Since the subscriber base continues to grow, it also begins to provide a sense of security to the people who are going to be covered by this. The importance of making an India pension society is important because we are actually a very young country today. Our median age even today is 32 years. Only 1 in 10 or 10% of the people are above 60 years of age. But that's not going to remain true forever. As we move forward, maybe by 2047 and 2050, when we are talking about Viksit Bharat, that ratio of 60 and above people may become 1 in 5, or almost 20% of our population may be at the need of the pensionable or some kind of assured income at that stage of time. As we move forward, that means our assets under management has to be equally higher, because we are a country of 1.4 billion people, and 20% of that is a huge number to be managed. The challenge there is that not only 60 years and above people are, also the senior people, super senior people, which are 80+ years, with the improvement in the economy, improvement in the health services, accessibility to the hospitalization and medical services. There are going to be many more super senior people than compared to today, which requires that more and more assured income is going to be in the requirement. If you look at the fact today, not more than 20% or even lesser than that are covered under pension scheme. It's mostly the formal sector, and today with the Atal pension scheme, some of the informal sectors are coming into the play. Most of the people in the farming sector, etc., are uncovered by the pension scheme, which is a bigger area for our PFRDA and all the related bodies are a bigger challenge for them to ensure that they also come under one of these schemes, are able to do that. In the senior citizens group, there's another important aspect, which is the female percentage of the population. One, it's going to be higher because of they have a better longevity or in our economy. But more important than that is that they have not been part of the working force in the same percentage as our men force has been part of the working force. Consequence is there are going to be mostly or many more women who are going to be uncovered under the after 20, 30, 40 years. And that is why even today we see the female poverty at a older age higher than the male poverty because of the historic reasons that they have been lesser part of the organized workforce, and we need to work on that as well. More than 80% of the population of India is engaged in informal sector. Now, government started also a Atal pension scheme, but still it's a formidable challenge for everyone to become and participate in that, where in the informal sector, the relationship of employer and employee doesn't exist, so we require certain kind of assured guarantee schemes for these people as well. And this sector has an additional challenge as the technology continues to improve, more and more AI and robotics driven manufacturing environment comes into the play, the gig worker economy is going to grow. More the gig workers, lesser the formal sector, and you'll have a larger number of pool of people who are going to be what we call the informal sector. And when we think of informal sector, we don't think of a professional sector there, we think of more of a casual working people, but tomorrow's economy will have a whole lot of people who are going to be a gig worker and high-end professionals who are going to be part of it. So assuring their income, etc., is going to be a greater challenge. Although Atal pension scheme has laid out the framework for that, but it's not an easy thing because to get all of them on board. We have a technological solution which has been put together by the government, which is driven by our Aadhaar card and what we call the JAM, Trinity, which is a Jan Dhan, Aadhaar and mobile combination. We can try connecting them and getting them becoming part through the easy to use interfaces, etc., and so on. But yet it remains a challenge that out of 1.4 billion, how we'll be able to get more and more gig workers or non-formalized sector of the economy, which is going to grow faster than the formal sector of the economy over a period of time. Today we are a fifth largest economy, and when you are going to be a fifth largest economy with 4.3 trillion, I think we are attaining by end of this financial year. We may attain 5 trillion by next financial year. The projected, what is being projected together, the long-term fund, insurance, provident fund, etc., are going to be important part and accumulate money for the development of this economy. Because when you're talking about Viksit Bharat, we need to have a huge amount of assets which are available, or financial access which is available to the government, and much of it comes from these kind of investments which are NPS and other long-term investment by the people. In our Indian system, today these defined schemes are only contributing to 16% of the GDP. If you look at any developed economy, it's more or less 80% of the assets, or 80% of GDP is covered from these assets. For us to sustain that growth rate and reach that 2047 vision of the Viksit Bharat, we require that kind of a growth where we also reach, if not 80%, but at least 60-70% of our GDP should be accumulated in various defined schemes and so on. I'm sure that PFRDA, in coordination with its intermediaries and regulated bodies, will be instrumental in taking this forward. And today's and tomorrow's conference, I'm hoping will deliberate on many of these issues and lay a path for future of the India. I wish all the success to the PFRDA conference. Thank you. Thank you very much.
थैंक यू वेरी मच सर। अब मैं भारत सरकार के सचिव वित्तीय सेवाएं से उद्घाटन संबोधन देने का निवेदन करती हूं। सर, हम वित्तीय सेवाओं के वर्तमान स्थिति और भविष्य की दिशा पर आपके विचार सुनने के लिए उत्सुक हैं। प्लीज सर।
Honorable Minister for State for Finance, Sri Pankaj Chaudhary ji, Dr. Mohanty, Chairman PFRDA, Dr. Bharat Bhaskar, IIM Director, and Dr. Manoj Anand, Member PFRDA, and colleagues, my colleagues from the government, and CEOs and MDs of banks, distinguished guests, ladies and gentlemen. It's a privilege to be here today at the first International Risk Conference on Pensions. And at the outset, I would like to congratulate Dr. Mohanty and entire PFRDA team for taking the initiative to organize the first International Conference on Research on Pension in Delhi, bringing together all the stakeholders in the ecosystem. You know, the term retirement benefit or pension holds different meanings to diverse segments of the workforce. Individuals with a secure financial future post-retirement are more likely to maintain their lifestyle while being prepared for contingencies. Pension is a tool to achieve this life goal. Hence, the adequacy of pension measured by the replacement rate becomes an important metric. This replacement rate should preferably be adequate to provide smoothing of consumption and prevent destitution in old age under any circumstances. Creating financial buffers through contributory pension programs is a sustainable way of achieving these goals. With this intent, NPS was introduced by the Government of India as a defined contributory pension scheme, marking a paradigm shift from the defined benefit pension scheme. Over the past 2 decades, NPS has evolved significantly, expanding its architecture to include most of the citizens of India, introduction of Atal Pension Yojana, extension of NPS to minors through NPS Vatsalya, has added important segment of population to the system. As detailed by the chairperson, PFRDA, NPS has emerged as a robust retirement savings mechanism in the country. Its growing assets under management and subscriber base is reflective of people's trust in the scheme. To the credit of ecosystem created by PFRDA as a regulator, returns on NPS have largely outpaced the market. And my heartiest congratulations to PFRDA for doing an excellent job on this front. It has been our constant endeavor to engage with the subscribers and tweak or create products that meet their requirement. Following the same consultation approach, Government of India has recently introduced the Unified Pension System under NPS for central government employees. It is a unique contributory but defined benefit scheme that provides an assured payout of 50% of the average basic pay of the last 12 months upon superannuation, along with the benefit of inflation indexation through DNS relief. This ensures a secure retirement for employees while also preventing undue fiscal burden on future generations. I trust that implementation of this scheme, which was started from 1st of April this year, for Government of India will build capacities for replicating the same model on demand for other stakeholders in the country. The pension coverage in India is inadequate, as you all know, mainly because 80% of workforce is engaged in the unorganized and informal sectors, where they do not have access to occupational pension as in the organized sector. As of the Economic Survey 24-25, approximately 58.4% of India's workforce is self-employed and 19.8% is casual labor, neither of which benefit from occupational pension schemes, unlike those in the formal sector. The e-Shram portal indicates that over 305 million unorganized workers are registered, highlighting a massive coverage gap. While programs such as the EPFO and EPS, Atal Pension Yojana, and Pradhan Mantri Shram Yogi Mandan exist, their reach and impact have so far remained limited. To live comfortably in retirement, many individuals are relying on multiple saving mechanisms, including EPF, NPS, life insurance, and mutual funds. Therefore, a subscriber is relying on multiple regulatory and supervisory ecosystem for sufficient income in old age. This necessitates coordination of efforts at our level. In this direction, Honorable Finance Minister in this year's budget has announced for establishment of pension forum for regulatory coordination and development of pension products. At a broad level, the forum would facilitate achievement of the following objectives. One is enhancing pension coverage, to look at identifying strategies to expand pension inclusion, particularly for gig workers, informal sector employees, and underprivileged sections of the society. Regulatory reforms and innovation, and assess the need for a seamless transition between different pension schemes such as EPS, NPS, and superannuation funds, and leveraging technology for better accessibility and affordability. And sustainability of pension system, exploring fiscal sustainability, adequacy of pension benefits, and potential shifts towards a universal pension system to ensure retirement security for all. As you know, India's pensions universe is fragmented. With a view to strengthening the interregulatory coordination, this forum was announced. I am pleased to note that today's agenda also includes a panel discussion on this initiative, featuring distinguished regulators and experts from the financial sector. I hope today's discussions set the tone for the establishment of this forum and its future direction, and finalizing the terms of reference for this forum for going forward. Despite the progress being made, pension savings in India remain lower than in other emerging and OECD economies, where pension assets exceed 80% of GDP. In India, pension assets account for only 70% of GDP. Therefore, it is essential for all stakeholders to collectively work with the government to enhance pension awareness, focus on financial literacy, and increase participation. India's pension sector is at a transformative juncture. As we move forward, continuous reforms, industry collaboration, and stakeholder engagement will be key building blocks for a more robust, inclusive, and resilient pensions ecosystem. And the programs like these will help to bring together global experts, industry experts, scholars, and researchers to deliberate on these matters and suggest best way forward. I'm confident that these efforts, in consultation with all stakeholders, will pave the way for a more robust and sustainable pension framework for India's citizens. To conclude, I extend my congratulations to PFRDA and all the participants for participation, and PFRDA for organizing the first international research conference on pensions today, and wish you all the best. Thank you so much.
धन्यवाद सर, आपके विचारपूर्ण संबोधन और प्रोत्साहक शब्दों के लिए। आपके मूल्यवान विचारों ने हमें वित्तीय सेवाओं के भविष्य की दिशा को स्पष्ट रूप से समझने में मदद की है। अब मैं माननीय वित्त राज्य मंत्री भारत सरकार श्री पंकज चौधरी जी से अनुरोध करती हूँ कि वे कृपया अपने संबोधन से हमारा मार्गदर्शन करें। हमें आज उनके साथ होने का बहुत मान प्राप्त हुआ है और उनका संबोधन निश्चित रूप से सरकार की वित्तीय क्षेत्र के लिए प्राथमिकताओं को, दृष्टिकोण को स्पष्ट रूप से बताएगा।
मंच पर उपस्थित डिफेंस सेक्रेटरी श्री एम नागराजू जी, PFRDA के चेयरमैन श्री दीपक मोहंती जी, डायरेक्टर IIM अहमदाबाद श्री भरत भारस्कर जी, PFRDA पूर्णकालिक सदस्य श्री मनोज आनंद जी। आज इस महत्वपूर्ण अंतर्राष्ट्रीय पेंशन शोध सम्मेलन में आप सभी के बीच आकर मुझे बड़ी प्रसन्नता हो रही है। पेंशन एवं सामाजिक सुरक्षा किसी भी देश की नागरिक का आर्थिक सुरक्षा के आधारशिला होती है और इसलिए इस दिशा में किए जा रहे अनुसंधान और नीतिगत प्रयासों की महत्ता संदेह से परे है। 2014 में देश की बागडोर संभालने के बाद माननीय प्रधानमंत्री श्री नरेंद्र मोदी जी ने विश्व का सबसे बड़ा वित्तीय समावेशन का कार्यक्रम चलाया था, ताकि हाशिए पर रहने वाले लोगों को बैंकिंग सुविधा एवं बीमा सुविधा उपलब्ध कराई गई है। और मैं आज गर्व से कह सकता हूँ कि देश के 99% से अधिक गांव किसी न किसी प्रकार से बैंकिंग सुविधा से जुड़ चुके हैं। और अब इससे भी आगे सोचने का समय है हम सबके पास। माननीय प्रधानमंत्री जी जो देश को 2047 तक विकसित राष्ट्र बनाने का लक्ष्य रखा है, विकसित राष्ट्र की संकल्पना की है, ये तभी संभव होगा जब देश का हर नागरिक की मूलभूत आवश्यकता पूरी हो और हर नागरिक का देश के विकास में योगदान हो। वर्तमान में हमारी देश की अर्थव्यवस्था आज 4.3 ट्रिलियन डॉलर है और 2027 तक हमारी अर्थव्यवस्था 5 ट्रिलियन की होगी, जो विश्व की सबसे 3 बड़ी अर्थव्यवस्थाओं में से एक होगी। और 2047 तक देश का ये 30 से 35 ट्रिलियन डॉलर की अर्थव्यवस्था बनने का लक्ष्य सरकार ने रखा है। 2047 के विकसित भारत का संकल्पना के लिए हर नागरिक को सामाजिक सुरक्षा कवच देने की भी आवश्यकता होगी। एक व्यापक पेंशन प्रणाली की आवश्यकता होगी जिसका वैश्विक प्रसार हो रहा हो, उससे असंगठित क्षेत्र भी शामिल हो ताकि कोई भी पीछे ना छूटे। और ये लक्ष्य प्राप्त करने की कार्य योजना हमें अभी से बनानी होगी। इतनी बड़ी संख्या वाले देश में सभी को पेंशन कवर करना आसान नहीं होगा। इस लक्ष्य को प्राप्त करने में तमाम चुनौतियां होंगी। सबसे पहली बात जो डेमोग्राफिक शिफ्ट होगी, जिसमें एजिंग पॉपुलेशन और घटती जन्म दर शामिल है, जो पेंशन प्रणाली के लिए एक महत्वपूर्ण चुनौती प्रस्तुत करते हैं। दूसरी बड़ी चुनौती होगी जो वित्तीय स्थिरता, अर्थात पेंशन प्रणाली को दीर्घकालिक रूप से आर्थिक रूप से सक्षम बनाए रखना। तथा तीसरी चुनौती होगी जो समान सुनिश्चित करना ताकि पेंशन कवरेज और उसकी पर्याप्तता में असमानताओं को दूर किया जा सके। इस चुनौतियों से निपटने के लिए एक मजबूत और समावेशी पेंशन संरचना का विकसित करना आवश्यक है, जो भारत के कार्यबल के भविष्य को सुरक्षित करे और सभी नागरिकों के लिए आर्थिक सम्मान को सुनिश्चित करे। भारत सरकार वित्तीय समावेशन और दीर्घकालिक वित्तीय स्थिरता को बढ़ावा देने के लिए निरंतर प्रयास कर रही है। राष्ट्रीय पेंशन प्रणाली एनपीएस और अटल पेंशन योजना एपीवाई जैसी योजनाएं इसी प्रतिबद्धता का परिणाम है। इन योजनाओं के माध्यम से हम न केवल संगठित क्षेत्र बल्कि असंगठित क्षेत्र के श्रमिकों को भी वित्तीय सुरक्षा प्रदान कर रहे हैं। सितंबर 2024 में माननीय वित्त मंत्री द्वारा एनपीएस वात्सल लॉन्च किया गया, जिसका उद्देश्य बच्चों के लिए बचपन से ही पेंशन योजना का लाभ सुनिश्चित करना है। ये योजना एक सुदृढ़ भविष्य की नींव रखने में सहायक सिद्ध होगी और भारतीय परिवारों को दीर्घकालिक वित्तीय सुरक्षा प्रदान करेगी। इसके अतिरिक्त एकीकृत पेंशन योजना यूपीएस कैबिनेट के माननीय प्रधानमंत्री जी के नेतृत्व में 24 अगस्त 2024 को एकीकृत पेंशन योजना को अनुमति दिया गया। भारत सरकार ने इस योजना को 24 जनवरी 2025 को अधिसूचित किया और पीएफआरडीए ने इस योजना का कार्यान्वयन करने के लिए विनियम को 19 मार्च 2025 को अधिसूचित किया, जिसे केंद्र सरकार के सेवानिवृत्त तथा सेवारत कर्मचारियों और जो 1 जनवरी 2024 से राष्ट्रीय पेंशन प्रणाली में जुड़े हैं के लिए 1 अप्रैल 2025 से लागू किया गया। ये प्रणाली परिभाषित लाभ और परिभाषित अंशदान के सर्वश्रेष्ठ तत्वों को जोड़ करके एक संतुलित और टिकाऊ पेंशन समाधान प्रदान करेगी। यूपीएस के तहत कर्मचारियों को एक सुनिश्चित भुगतान मिलेगा, जिससे उन्हें रिटायरमेंट के बाद वित्तीय सुरक्षा सुनिश्चित होगी। इससे सरकार का वित्तीय प्रबंधन बेहतर होगा और दीर्घकालिक पेंशन दायित्वों का पूरा करने में सहायता मिलेगी। इस दिशा में पेंशन निधि विनियामक और विकास प्राधिकरण पीएफआरडीए की भूमिका अत्यंत महत्वपूर्ण है। पीएफआरडीए ने न केवल पेंशन प्रणाली को सुव्यवस्थित किया है, बल्कि इसे पारदर्शी और प्रभावी बनाने के लिए अनेक सुधार भी किए हैं। आज पेंशन योजनाओं के डिजिटलीकरण का और सरल पंजीकरण प्रक्रियाओं को लागू करने में पीएफआरडीए का योगदान सराहनीय है। मुझे अवगत कराया गया है कि आज के इस सम्मेलन का उद्देश्य पेंशन व्यवस्था में हो रहे परिवर्तनों और नए अवसरों और संभावित चुनौतियों पर विचार विमर्श करना है। अर्थशास्त्रियों, नीति निर्माताओं, उद्योग विशेषज्ञों और शिक्षाविदों के बहुमूल्य सुझाव इस क्षेत्र में नए समाधान खोजने में सहायक सिद्ध होंगे। हम सभी जानते हैं कि भारत एक युवा देश है और लेकिन अगले कुछ दशकों में डेमोग्राफी के स्वरूप में बड़ा बदलाव आने वाला है। 2050 तक हर 5 में से 1 व्यक्ति 60 वर्ष से अधिक आयु का होगा और भारत से वरिष्ठ नागरिकों की संख्या 14 वर्ष के बच्चों की जनसंख्या से अधिक हो जाएगी। 2050 तक भारत में वृद्ध जनसंख्या लगभग 19% हो जाएगी, जिसमें महिलाएं पुरुषों से अधिक होंगी और अधिकांश महिलाओं ने अपने जीवन काल में संगठित क्षेत्र में काम नहीं किया है, विशेष रूप से ग्रामीण क्षेत्रों में, जिससे उनकी आर्थिक स्वतंत्रता और पेंशन तक पहुंच सीमित हो जाती है। इस बदलाव को देखते हुए नीतिगत स्तर पर विशेष ध्यान देने की आवश्यकता होगी। ऐसे में पेंशन फॉर ऑल केवल एक लक्ष्य नहीं, बल्कि एक आवश्यकता बन गई है। सरकार इस लक्ष्य को हासिल करने के लिए समावेशी पेंशन योजनाओं के विस्तार पर कार्य कर रही है। पेंशन प्रणाली को और अधिक प्रभावी बनाने के लिए हमें कुछ विषयों पर ध्यान देने की आवश्यकता है और मैं आशा करता हूं कि आज इस मंच पर इन विषयों पर भी चर्चा करेंगे। हमें पेंशन योजनाओं की जागरूकता को जमीनी स्तर तक ले जाना होगा ताकि अधिक से अधिक लोग इसका लाभ उठा सकें। डिजिटल तकनीकों और फिनटेक समाधान का उपयोग कर पेंशन योजनाओं को अधिक सुलभ और समावेशी बनाया जाना चाहिए। आर्टिफिशियल इंटेलिजेंस और डाटा एनालिटिक्स जैसी नई तकनीकों का उपयोग कर पेंशन प्रणाली को पारदर्शी और कुशल बनाया जा सकता है। सरकार और निजी क्षेत्र मिलकर पेंशन योजनाओं की पहुंच और क्रियान्वयन को अधिक प्रभावी बनाना होगा। नागरिकों को वित्तीय साक्षरता से युक्त करना होगा ताकि वो अपने रिटायरमेंट प्लानिंग को बेहतर ढंग से समझ और लागू कर सकें। हमें सर्वोत्तम अंतर्राष्ट्रीय प्रथाओं से भी सीखने की आवश्यकता है। कई विकसित देशों ने अपने पेंशन सिस्टम को अधिक प्रभावी और लाभदायक बनाने के लिए नई रणनीतियां अपनाई हैं। हमें उनका अध्ययन कर उन्हें भारतीय संदर्भ में लागू करने के बारे में विचार करना चाहिए। हमें विमर्श करके समाधान खोजना होगा कि कैसे हम अंतिम व्यक्ति तक सुरक्षा कवच पहुंचा सकते हैं और आर्थिक स्थिरता के साथ साथ मानसिक स्थिरता प्रदान कर सकते हैं ताकि देश का हर नागरिक अपनी क्षमताओं के अनुसार निश्चिंत होकर देश के विकास में अपना योगदान दे सके। इस विमर्श में हमें विचार करना होगा कि कैसे पेंशन की पहुंच अंतिम छोर के व्यक्तियों तक बना सकें। हम शोध के माध्यम से कार्य योजना बनानी होगी कि देश के हर भौगोलिक क्षेत्र के निवासियों का हर वर्ग के नागरिकों को पेंशन सुविधा उपलब्ध कराई जा सकती है। मैं इस सम्मेलन में के आयोजकों, शोधकर्ताओं और सभी प्रतिभागियों को शुभकामनाएं और धन्यवाद देता हूं कि जो इस महत्वपूर्ण विषय पर विचार विमर्श करने के लिए एकत्र हुए हैं। मुझे पूर्ण विश्वास है कि आपके विचार और सुझाव भारत की पेंशन प्रणाली को और अधिक प्रभावी और समावेशी बनाने में सहायक सिद्ध होगा। धन्यवाद।
आपके प्रभावशाली और उत्साहजनक शब्दों के लिए धन्यवाद सर। आपकी बहुमूल्य उपस्थिति के लिए भी आपका आभार। हम आशा करते हैं कि हमें भविष्य में भी आपके दिशा निर्देश प्राप्त होते रहेंगे। इस सत्र का समापन करते हुए मैं धन्यवाद ज्ञापन के लिए मिस ममता रोहित, एग्जीक्यूटिव डायरेक्टर PFRDA को आमंत्रित करना चाहूँगी। उनके शब्द इस सत्र का समापन करेंगे और हमें आज के कार्यक्रम के अगले भाग में ले जाएंगे। प्लीज़ मैडम।
धन्यवाद प्रियंका। आप सभी को मेरा सम्मानपूर्वक नमस्कार। IRCP 2025 के इस परिपूर्ण और ज्ञानवर्धक सत्र के समापन पर मुझे आप सभी को धन्यवाद ज्ञापन करते हुए गौरवान्वित महसूस हो रहा है। सर्वप्रथम हम अपने सम्मानित मुख्य अतिथि माननीय वित्त राज्य मंत्री भारत सरकार श्री पंकज चौधरी जी का हार्दिक आभार व्यक्त करते हैं। सर, आपकी उपस्थिति और उत्साहवर्धक शब्दों से न केवल हमें सम्मानित किया है, बल्कि हमें राष्ट्र के वित्तीय परिदृश्य को आकार देने में पेंशन फॉर ऑल, डेटा एनालिटिक्स, AI, फिनटेक, वित्तीय साक्षरता एंड ग्लोबल बेस्ट प्रैक्टिसेस के महत्व को भी रेखांकित किया है। आपकी विशेषज्ञता और दूरदृष्टि से विकसित भारत में पूर्णतः पेंशन युक्त समाज को साकार देने की दिशा मिली है। आपका बहुत बहुत धन्यवाद सर। हम श्री M. नागराजू, सचिव वित्त सेवाएं, वित्त मंत्रालय के भी अत्यंत आभारी हैं। सर, आपकी समृद्ध भागीदारी, समग्र दृष्टिकोण और निरंतर समर्थन के लिए हम आर्थिक रूप से अनुग्रहित हैं। हम प्रोफेसर भारत भास्कर, निदेशक IIM अहमदाबाद को भी हार्दिक धन्यवाद देते हैं। सर, आपका सहयोग, आपकी भागीदारी और मुख्य भाषण हमारी प्रेरणा का एक प्रकाश स्तंभ है, जो हमारे भविष्य में शोध और अकादमिक उत्कृष्टता के लिए मार्ग प्रशस्त करता है। हम डॉक्टर दीपक मोहंती, अध्यक्ष PFRDA का विशेष रूप से आभार व्यक्त करना चाहते हैं। सर, आपका असाधारण नेतृत्व, आपकी अटूट प्रतिबद्धता और ज्ञानवर्धक मार्गदर्शन ने वित्तीय सुरक्षा के क्षेत्र में कई सार्थक सुधारों को अंजाम दिया है। मैं पूर्णकालिक सदस्य वित्त प्रोफेसर मनोज आनंद का विशेष रूप से धन्यवाद देना चाहूँगी, जिन्होंने इस सम्मेलन की अवधारणा बनाने में महत्वपूर्ण भूमिका निभाई है और जिनके अथक प्रयासों के बिना IRCP संभव नहीं हो पाता। इसके अतिरिक्त मैं पूर्णकालिक सदस्य अर्थशास्त्र मैडम ममता शंकर का भी विशेष आभार व्यक्त करती हूँ, जिन्होंने इस सम्मेलन के सुचारू निष्पादन में अपना पूर्ण सहयोग प्रदान किया है। मैं यहाँ उपस्थित सभी मीडिया कर्मियों को विशेष धन्यवाद देना चाहती हूँ, जो समय समय पर हमारा सहयोग करते हुए इस क्षेत्र में अपना योगदान देते आए हैं। और मैं सबसे महत्वपूर्ण आयोजन समिति के समर्पित सदस्यों और IRCP को यथार्थ रूप प्रदान करने के लिए अपने सभी सहकर्मियों का हार्दिक आभार व्यक्त करती हूँ। As we look forward to the exciting possibilities that lie ahead, let us remember the words of Albert Einstein. The important thing is not to stop questioning. Curiosity has its own reason for existing. महत्वपूर्ण बात यह है कि अपनी जिज्ञासाओं को समाप्त न करें। जिज्ञासा हमारी मौलिक अस्तित्व की वजह है। This sentiment resonates deeply with the spirit of our upcoming research conference. It's a call to delve into the depths of our fields and to challenge the boundaries of our understanding. To all our esteemed speakers, presenters, and researchers, you help us establish connections between theoretical frameworks and practical applications, paving the way for transforming research into real-world solutions. To all the delegates, we expect IRCP to be a fertile ground for rich exchange of ideas that will not only lead to future breakthroughs, but will also aid in building bridges between disciplines, institutions, and ideas. I sincerely hope that all of you leave with renewed inspiration. Thank you all.
धन्यवाद मैडम। मैं आप सभी से निवेदन करती हूँ कि कृपया हमारे साथ हाई टी के लिए जुड़ें। साथ ही मैं अनुरोध करती हूँ कि 11:10 तक वापस लौटें ताकि हम समय से पैनल चर्चाओं की शुरुआत कर सकें। एक ज़रूरी सूचना, यूपीएस की पुस्तिका सभी मेहमान रजिस्ट्रेशन डेस्क से कलेक्ट कर सकते हैं। थैंक यू वेरी मच।
Ma'am, is it audible to you? Esther Ludin, ma'am. Madam is online, but she's not responding.
Good morning. Sorry, were you talking to me?
Yeah, ma'am. Yeah. So we'll be starting the session in next 5 minutes, ma'am.
Great.
Great. Okay. So we'll when we announce, we'll send you a message separately. We'll be on mute till then.
Thank you.
Thank you, ma'am. Thank you.
I request everyone to please settle down so that we can begin with our next session.
विकास सर ओके हैं, प्रवेश सर ओके, मोनू सर ओके नहीं है। ठीक है, गांधी सर यानी तो बता आशीष सर, प्रवेश सर, विकास सर, एक और चाहिए तो सुमित सर। आशीष सर से कॉल करें। प्रवेश सर के बाद में सुमित सर आएंगे। नहीं, प्रवेश सर के बाद विकास सर, विकास सर के बाद सुमित सर। यार एक तो यहाँ पे सब एकदम से हो जाते हैं ना। खैर हमें वो थीम कितना लंबा है? थीम 1 कितना लंबा है? कितना? It will start 11:15, 12:45. So 11:15 to 12:15, 1.5 घंटे। 1.5 घंटे। सवा घंटा। हाँ, 1.5 घंटा। तो 1.5 घंटे में मेरे को थोड़ा सा राउंड अप लेना पड़ेगा। किसी से कॉल करवा के मैं आपको ममता मैम के पास में से आशीष सर क्योंकि बाकी लोगों को है खाली गांधी सर नहीं है। अच्छा, गांधी सर नहीं है, वो नहीं है। हाँ, वो नहीं है। तो मैं आपको ना इन बिटवीन आके बताऊँगा। मैं अभी नीचे भी आऊँगी ना, जब सेशन के बाद इंट्रोड्यूस करने के बाद बैठूँगी मैं नीचे। I request everyone to please settle down. I request everyone to please settle down so that we can begin our next session.
Welcome back, everyone. So we are ready to start with our first panel discussion, for which we have been joined by 5 distinguished speakers who will bring prudent insight on the topic. It is my privilege and honor to invite our esteemed panelists to this important discussion on the theme Pension for the Future, Building Resilient Old Age Income Security. So first, I humbly request Chair of Panel, Dr. Soumya Kanti Ghosh, Member 16th Finance Commission and Group Chief Economic Advisor, State Bank of India, to join us on the dais, please. Dr. Ghosh is a leading economist with extensive contributions to policy design, financial regulation, and economic research. Dr. Ghosh is recognized as one of India's best individuals in research for 6 consecutive years, 2018 to 2023, by the Asset magazine, and remains at the forefront of economic thought leadership. Thank you very much for joining us today. Our next panelist, Ms. Astrid Luden, Deputy Commissioner, FSCA, South Africa, is joining the session through video conferencing. Ms. Astrid Luden joined the Market Conduct Regulator in June 2021, and her responsibilities include oversight over financial markets and retirement fund supervision, as well as the digital transformation of the FSCA. Since November 2024, Ms. Astrid is also the president of the International Organization of Pension Supervisors. She has an MA in International Affairs from Columbia University, a BA Honors in Politics, Philosophy and Economics from York University, and a certificate in Design Thinking from the Emeritus Institute of Management. Thank you for joining, ma'am. It is our privilege to have you with us today. Next, I invite Ms. Omolola Olawuraran, Director General PENCOM, Nigeria, to join us on the dais, please. With over 20 years of experience spanning in financial operations, capital markets, and pension fund oversight, she plays a key role in shaping institutional investment strategies and regulatory advancements in Nigeria's pension industry. She holds an MBA from Manchester Business School and has completed executive programs at INSEAD and the University of California, focusing on artificial intelligence, strategic decision-making, and financial leadership. Thank you for joining, ma'am. Next, I invite Mr. William Price, CEO, D3P Global, to join us, please. Mr. Price works on regulation, investment, risk, and social policy in financial services with a focus on pension and retirement income. Previously, he had worked for the World Bank, UK Treasury, UK Pension Regulator in collaboration with OECD and IOPS. His first degree is from Oxford University, and he has a master's in economics from University College London. Thank you for joining, sir. Next, I would invite Dr. Deepak Mohanty, Chairperson PFRDA, to come on dais for the panel discussion, please. Dr. Mohanty assumed charge as Chairperson PFRDA in March 2023. He is an economist with substantive policy experience. Earlier, he was Chief Economic Advisor, Federation of Indian Chambers of Commerce and Industry, served as ED of RBI, and worked as Senior Advisor at the International Monetary Fund. Thank you, sir, for joining. It is our privilege to have you here today. Thank you, everyone, for joining. Each of our esteemed panelists will offer their unique insights on the topic, and we will then open the floor for questions and an engaging discussion. I encourage you all to actively participate and make the most of this opportunity to engage with our experts. So without any further delay, let's get started. Please join me in warmly welcoming our panelists. Now I request Dr. Soumya Kanti Ghosh to take over. Please, sir.
Thank you, everyone, and Thank you, PFRDA, for inviting me to grace this occasion. And it's indeed a pleasure to be amongst all of you, and specifically such an learned panel. So I think we will get to know a lot about the industry, the trends, what has been happening in the last decade. We can say that there has been a lot of developments also in the pension industry, as the Honorable Minister in the morning said about the population projection of India. India still remains a young country, but as every country grows old, maybe 20 years down the line, there could be some population differences, projections. So pension actually serves as a crucial safety net, as all of you know, and providing financial security for post-retirement life. If we actually look into the data, and I was checking up some data of all the Indian context also, which I will give you shortly. Over the last 2 decades, if you look at the pension assets, which is basically defined as the fund set aside for retirement within OECD countries, has shown a remarkable growth, tripled in value when you measure them in US dollars. And the UK and US economy growth rates has averaged around 5 and 6% per year over the past 2 decades. So that's actually a very big number. So one of the most important fallout of these, that the key factors contributing to this growth has been the increasing equity allocation of these pension funds. This has also resulted in significant role in the reduction of fixed income securities within the pension portfolio. Policymakers have been increasingly following the investment strategies, sometimes which are less conservative, and consequently the percentage of asset allocation to bonds has been on a downward trajectory over the past 2 decades. So there has been a lot of developments over here. Participation rates in various types of pension plans have been a rising trend. To encourage greater participation in pension plans, many countries have implemented mandatory plans. Financial incentives, targeted communication campaigns have also been employed to encourage individuals to contribute to their pension plans. India is also actually not an exception. If you look into the Indian experience, I mean, we'll talk during the panel discussion. We have recently launched some of the products, but there has been active campaigning and very innovative marketing of the products. After experiencing a decline in 2022 across most jurisdictions, the liabilities of defined benefit plans have saw a resurgence in 2023. However, despite the improvement in funding rates for defined pension plans in 22 and 23, the share of asset held in these plans has declined in all reporting jurisdictions in 2023, with the notable exception of Finland, which is 90% assets in the DB plans. When examining the ratio of the pension assets to GDP, I think this is very interesting trend, and there is a significant disparity between countries. India, the current pension assets to GDP ratio stands at 16.5%, and I'll give you some numbers over here. I think the total number of NPS, if I am correct, the number of subscribers under NPS, of the overall subscribers, actually, if you look into them, has reached around 8 crore in January 2025, which was 8 lakh in March 2010. So that's a big increase. There has been also a significant increase in the APY that we will say the Atal Pension Yojana, the share is at 76%. And India's population coverage, if you look at the NPS and the Atal Pension Yojana, which is primarily for the informal sector, the NPS has increased to close to 6% in January 2025. From 0.6% in March 2014. So in the last decade, we have traversed a lot of distance, but as you know, India is a large country. We need to travel even further. Developed countries, however, UK, USA, Australia boost ratios exceeding 100%. The OECD countries have a ratio of 88%, but Scandinavian countries have a ratio that sometimes exceeds 200%. So I think there is a large disparity, but India has been doing well. There is a significant growth, as we will discuss. This disparity highlights the various levels of pension and accumulation and investment strategy it employs across different countries. As countries continue to navigate the complexities of pension funding and investment, I think the lesson learned from the past experience will be very valuable in shaping the future contours of the industry and the retirement security benefits for India down the world. So I believe that the panel discussion which we'll have today will provide valuable insights for India also as a country to have the goal of pension for all vision by 2047. Thank you for patiently hearing to me. I'll start with Mrs. Omolola Olowaran, the Director General PENCOM Nigeria. Thank you, ma'am, for addressing this occasion. I just want to start with the country Nigeria. I think for the benefit of the audience, if you can briefly describe how the pension system in Nigeria has been organized, basically the share of Pillar 1, Pillar 2, and Pillar 3, and what is the approximate coverage ratio of labor force and share of pension assets in GDP in Nigeria? Thank you.
Thank you, and I'm happy to be here today. Thanks for having me. So in Nigeria, we run like a multi-pillar system based on Pillar 1, 2, and 3. Pillar 1, which is essentially like a social security net, is not that rampant in Nigeria. Some states are running that, but they are running into the issue of sustainability. And what we are trying to do is to get those states onboarded to the contributory pension scheme, which is Pillar 2. Prior to the implementation of the contributory pension scheme in Nigeria in 2004, Pillar 1 was very much the order of the day in government. But again, it ran into funding problems, and the huge liability resulted in the need for reforms in Nigeria in 2004. So in 2004, the contributory pension scheme came into effect, and since then, the scheme has been growing, and that's Pillar 2. So in Nigeria, where we play a significant role, or what we practice in Nigeria is essentially Pillar 2, because we believe that's where we can ensure affordability, sustainability, and adequacy of the pension system as well. So what we've been doing is essentially trying to grow the scheme into the formal and informal sector. Now, Pillar 2 is mandatory, so that's for the formal sector. But we also have a huge informal sector segment in Nigeria, and that's over 85% of the workforce population, which is Pillar 3, the voluntary contributions, or voluntary pensions, as the World Bank may call it. And what we are trying to do is essentially to see how we can grow that path, because in 2019, in order to penetrate the informal sector, we did introduce the micro pension scheme. And it's been a challenge growing that scheme, and till date, it's still been meager coverage. So what we're doing this year is to see how we can put together different initiatives, from communications to technology, and potentially incentives as well, to see how we can grow the informal sector and grow voluntary pensions. Now, because of the low coverage, because of the pretty low coverage in the informal sector, which I said is responsible for over 85% of the Nigerian workforce, that then brings down the coverage ratio. So the coverage ratio in Nigeria is, the pension coverage ratio is about 12 to 15%, and you can see that that's pretty low. In addition to that, it also means that our pension to GDP ratio is also very low as well. I think I listened earlier, or I read, for that of India is 16.5 or 17 thereabout. In Nigeria, the good thing is India is doing better than Nigeria, because in Nigeria the ratio is about 9%. But we've seen that the adoption of the scheme is increasing, but the truth is at a very low pace. We believe if we put in place all the initiatives we have planned to grow the informal sector, then we'll be able to increase the coverage ratio and also be able to increase the share of pension funds or pension assets to GDP as well.
Thank you. And I think this is a very heartening number that you have been, the 85% informal, trying to cover them. And the share actually at 9% of GDP, obviously the share will increase over a point of time. So that's one interesting. Coming to online, Madam Ludin from South Africa. Ma'am, you can hear us clearly. Yeah, you can hear us? You can unmute. Yeah, okay. So I think...
Yes, I can.
Oh, sir, thank you. So similar question, ma'am, to you. Basically, from the South African, how the pension system in South Africa is organized, basically the share of Pillar 1, Pillar 2, and Pillar 3. And also, I think, what is the coverage ratio of labor force in South Africa and the pension assets and the share of pension assets in GDP? So if you can just kindly elaborate a little on this. Thank you.
Thank you very much, and thank you for accommodating me virtually. I'm very sorry that I can't be there in person today. So let me briefly talk to the South African system. We have three pillars as well. The first is really a sort of public benefit program that's funded from government revenue. It's a means-tested, a non-contributory older person's grant, and we usually refer to this as the old age pension. It's a very small amount, and it covers about 3.8 million South Africans that are over 60, which is about 73% of the pensionable people of pensionable age. Then the second pillar, which is our largest pillar, consists of both a sort of mandatory public contributory system that's also tax incentivized, as well as the voluntary occupational pension funds. And this is the largest component, really. This is where most of our assets under management sit. Collectively, the assets here are about $316 billion US dollars, and it covers close to 12 million people, which is about 73% of the working population. And then the last pillar is voluntary savings. Here we have retirement annuity funds that are provided, for example, by insurers. We also have a number of voluntary savings vehicles. And this last pillar really covers people who are not participating in the occupational retirement funds, so self-employed and I think also informally employed people. The assets under management, I've already mentioned, are about, in 2023 numbers, $316 billion. That's about 83% of our GDP at the time, which was $380 billion. So, I think what's relevant here, I think, is that 40% of this is the public pension fund, which in South African terms is 2.3 trillion rand. What else can I add? I think, you know, the institutional investors are extremely important in South Africa, and that's of course primarily our pension funds. And yeah, let me pause here.
Okay. So thank you. So I think that actually what you said at the beginning of the speech is that there is a large disparity. We are 83% of GDP. In other countries, Nigeria, for example, is closing down to around 10 to 9% of GDP. So there is actually a significant lot of learning across countries. So, Mr. Price, in the same vein, I think given the disparity across countries in terms of learning, in terms of the what stage they are, which countries or pension models do you believe that they provide the best examples, and what lessons can others gain from them?
Well, thank you very much. And firstly, it's a great pleasure to be here. Thanks to the PFRDA and MA, Ministry of Finance. It's particularly a pleasure. I remember being here in 2015, I think for the PFRDA's first pension conclave that was addressed by the late Arun Jaitley, and it was quite a thing, first time to meet a union finance minister, and you realize the kind of power and responsibility. So it's great to see that this is continuing 10 years later. In terms of the country examples, I'm from the UK originally, so let me start there. I always say that there's pretty much every triumph and disaster of pension policy that you can imagine that's been committed in the UK, so it's a good place to start. So on the positive side, I think there's just the recognition, as in many countries, you need something from everything. There'll be some people who, if you want them to have income in old age, you just have to give them income in old age, no contributions. And though the non-contributory part of pensions was sort of off the agenda a little bit for quite a few decades, and in the last 2 decades, last decade, people have just realized no matter how good your second pillar, your private pension, your voluntary investments, you just flat have to give some people some money. But that's extremely expensive. And so you have to get away from the ideology of is it public or private. It's both. It's public and private. It's contributory and non-contributory. And you need all of these different aspects in your pension system. The UK sort of tried to get the voluntary private to have very broad coverage. And in a world in the 1970s, high unionization, very large public sector, the numbers were not so bad. But it then had 30 to 40 years of declining coverage where everything was tried in communication, financial education, different pension products. At the end of the day, if you want broad coverage of private pensions, you have to make them mandatory or use auto-enrollment. So the voluntary initiatives are important, but the big drive in coverage is making that decision. Probably took the UK 30 to 40 years to realize that. Since it did it in 2012, there's been a massive increase in coverage. And that increase has been large firms through to the smallest firms, highest income through to the lowest income, people with disabilities, people with an ethnic minority background who traditionally had lower pension coverage. So the biggest gains have been for the people with the lower incomes because they were just not connected. And so making it sort of hardwiring it into the system. That's, of course, very difficult if you think about high rates of informality that all of our speakers have mentioned. But we have a chance now with the gig economy and the gig economy apps to hardwire them into the system. They are, you know, in the old days, informality is an impossible task because you can't find the person, there's no contract, it's all cash, there's no money flow, there's no data flow. And, you know, with the best will in the world, that's tough to deal with. Now, whether it's Uber or Ola or Grab or all of the different gig economy apps, it's all a digital flow. Digital finance as well. They are the perfect things to be plugged into a pension system. And it's just whether the legal system allows it. I was walking through a train station in the UK a couple of months ago, and there was an advert from Uber. And it has a picture saying one of these people has a pension. And the story is it's the driver. The driver for Uber in the UK is now part of the mandatory or auto-enrollment private pension. Uber, as the gig economy platform, has to pay 3%. The driver pays 4%. Probably not enough for the best retirement in the world, but they are now part of it. What that advert doesn't tell you is that Uber fought for 5 years, all the way through to our Supreme Court, to stop this happening. And it's a nice, kudos to the marketing department to take a 5-year battle that you lost into something which tells you how great a company you are and is a nice advert for people to use your service. But it's definitely something that all countries should do. Singapore are doing it proactively. The European Union have done a big stocktake of all of these different digital economy apps. And that's part of the way of squaring this circle, so they should be in. I won't give all of the other examples, but I guess the main point, just touching on a couple of other countries, is that there are no sort of good countries and bad countries, I think, in pensions. There are people who are kind of top of the international rankings who have very bad features, and people who are lower down who have good features. So take Australia, fantastic scale, expertise, and governance. They took probably 20 years too long to have a robust supervisory approach, to be transparent on data, on fees and investment returns, and have a robust action if you were charging too much and delivering too little. They also, in Australia, don't have payouts mandatorily, and so they have a twin problem, an amazing accumulation phase, those great numbers that you just heard on GDP, or assets as a percentage of GDP. Some people spend the money too quickly, but some people have the equal, but the opposite problem. On paper, they look fine. As the government, you think they're fine, but they're so scared of outliving their assets that they live, and I'm sure we all have older relatives, they don't want to spend the money because they're so scared of outliving it. So they're living poor, even though the pension system did what it probably should have done in terms of getting into the right position. So you must have the payout phase. Malaysia, very briefly, the Employees Provident Fund, US 250 billion, is just a great example of how to build an investment capacity to improve domestic and international returns, and doing that in what is a very tough governance environment in other parts of the economy. And let me then finish with India, because there are some really good features. So in the way that India pays pensions, as we heard, the amount of the non-contributory pension is very low, the ING and OPS, but there's a very nice feature where there's a higher payment for people who are 80 and lower when you're 60. And if you think about the demographics, at least start with higher and higher payments for people when they're 75 and 80, when they almost certainly will have used up any capacity to work or having any assets. It's much cheaper than giving the same amount to everybody at 60 or 65. Of course, the NPS architecture, the good returns, still having a role for the family, which no country should forget, even if it's only 10% of the solution. It's a mistake to forget about the family, and lots of, particularly, you know, pretty much every country outside Western Europe has a better family structure and has more chance, so don't forget that. But of course, difficulties in terms of the coverage, the access, and some other issues that we maybe touch on a little later in the answers to some other questions.
Okay. Thank you for that elaborate answer. So it's really interesting that you talk that about public and private is not only one. Now, coming to our chairperson, PFRD, I think as we were saying in the data, there has been actually a significant growth in these the assets under consideration. And India is also is an economy which is a share of the informal is larger, the formal basically is also, India is also getting formalized at a very large speed. So in this context, Dr. Mohanty, I just wanted to understand that how can the pension coverage, and I know that there has been the PFRD and the government has been doing a lot of work on this area. How can the pension coverage be expanded for informal workers? For example, the self-employed, the business owners, the gig workers, who often doesn't have significant access to traditional retirement plans. And I think that has been an issue within a country like India from the beginning. But how it has been expanded and being expanded for the informal workers through some of the schemes.
Thank you. As you just mentioned, you know, the big challenge really comes from the nature of the labor market, because 80% is informal, and if you look at really the organized sector, what we call about 10% of the workforce. So we, obviously the first place would be that how do we have an instrument to onboard the informal sector, for that matter anybody. And NPS is a good instrument in that sense, because it is employment neutral. It is, you know, also status neutral in that sense. Anybody from 0 to 70 years can do that.
people can go in and out of employment, still they can continue. So the important thing that continuity in the pension account. So that is how the accumulation takes place, and one can harness the benefits of compounding. So that is there. And our micro pension is quite good because APY that we have 67 million active accounts there, and so that's doing pretty well. But that's the tip of the iceberg because we have a long way to go. And since the instrument design is good, so that we hope that with better financial literacy and knowledge, people will commit themselves to the long-term social security. And the other factor would be that income is a major determinant of all this, that what you set aside for your future. So in that sense, that we are about $2,500 per capita, quite low in the income ladder, but the rate at which that we are growing, so we are one of the, we are the fastest growing large economy. So once the growth picks up, income levels go up, so pension gets a better look in. So, people can really come in, look at that. And that's what we are seeing, that we see kind of a momentum, that if you look at the last 3-4 years, there are a lot more awareness, lot more momentum. And post-COVID, people are even thinking about the future, set aside something for that. But, given the potential, we have a long way to go.
Okay, thank you. It's very heartening to know about the schemes. Let me come back to from where we started. Ma'am, actually, you talked about Nigeria, the share of the informal sector, the share of GDP. Coming from a country like Nigeria, how you are actually ensuring that the pension program, which you have been doing, could be structured as an affordable and an inclusive program? Do you have any plans, or do you have any way, how do you ensure this, that it is more inclusive in nature?
Yes, absolutely. Thank you for that question. So what we've been focused on in Nigeria is to ensure that there's pension penetration in the informal sector. And it's important that we address the issue of affordability. And the way that we think it can be affordable is by introducing flexibility to ensure that we come up with the right framework that can ensure that the informal sector, or rather that can ensure that the pension scheme is attractive to the informal sector. Part of what we're doing is to work with cooperatives, fintechs, and mobile money platforms to see how we can use these partners to penetrate the informal sector to all the various nook and crannies in Nigeria. And we are in advanced stages in that. We're looking at various options, including options like pay as you consume with mobile money operators or some fintech banks, such that as you're paying for certain things, you're contributing towards your pension. And in addition to that, technology is also very important. So onboarding needs to be simplified. Part of what we've done this year is to simplify the onboarding process such that it's very easy to get into the scheme. And onboarding as well needs to be digital because of the sheer size of the informal sector in Nigeria. And I dare say that that's child's play compared to the population in India. But we're talking about like over 77 million employees in the informal sector. So it's important we use technology to scale. And using technology, ensuring that the onboarding process is pretty easy, and also ensuring that the benefits disbursement process is also easy. So technology is a key part of what we're using to ensure inclusion. Fintechs, mobile money, operators in Nigeria to help to essentially distribute the product as part of what we're using. Then communication is also very important as well. We are mapping out a communication plan that allows us to go around to engage Nigerians. We'll be talking to influencers, news network, both print and social media platforms to sort of like spread the word, to educate Nigerians, because part of what we've also noticed is that the literacy level is low in some instances, and people don't really understand why they should even be contributing for pensions in the first place. So we believe once we've addressed this issue in terms of literacy and education of what pension is, then we would be able to get more people on board, and the issue of affordability would be also addressed, because essentially you're tying this to what people are doing. So whether you're spending money or whatever little funds you have, then you can save. One of the things we think we can do in Nigeria as well to sort of like catalyze that area is to see whether we can incentivize people to contribute. We're looking at various options, from pension-related loans to insurance-linked products, to even counterparty funding as well. So all those options are on the table. Later this year, we're hoping to have a rebrand, we're hoping to have a rebrand where we can come out again and give out the features that we think will attract people to the scheme. Our goal and vision in Nigeria is clear, is to ensure that everyone has a pension. Now, I was happy to see that India has set a 2047 target for themselves here, and we haven't put a number to ours yet. But what we are looking at is looking at all the various hurdles we need to get through to achieve that, and then we can have a target date for that. But whilst affordability is very important, and that's the bedrock on which the contributory pension system is built, flexibility is also equally as important or even more important, because it's critical that we have a pension system that is workable for the informal sector, that doesn't have the kind of rigid rules that we have under the contributory pension scheme, which is essentially a funded system by employee and employer. So you have guaranteed income, and your employer also essentially contributes a matching fund for you. For the informal sector, those are not there. So it's important that flexibility is part of what we implement as well. So in a nutshell, I would say that working with partners in mobile money, in fintech, in the various associations, cooperatives in Nigeria, simplifying onboarding process and making the process flexible for all. Thank you.
I think you answered one of the questions which I was planning to ask you, the role of fintechs. And believe me, I think in terms of the communication which you just said, I think this communication continues to be important in countries like us and also in Nigeria, and it reminds me of the decision which an individual has to take. I think as an economist, you all know about the debate of which has been started going from 1973 in terms of whether to save for now or save for later, for consume now. So that, I think that debate is well known, and I think hopefully this communication is very important in terms of building up a robust pension system. Coming to Madam Liudin, you can hear me also. I think, what are your views on designing a pension system that are inclusive and financially sustainable in an aging economy? I think in this context, I will ask a question specific to South Africa. I think if you can just share your thoughts on the recently introduced two-pot system that spills contribution into a retirement pot for preservation and a saving pot for emergencies. I think it's quite interesting, and if you can just elaborate on this two-pot system which have recently introduced, and also how this scheme could be more inclusive and financially sustainable for an aging economies. Thank you.
Thank you very much. So let me maybe say at the outset that we are, we're not an aging economy. We're in fact a young, growing economy. However, the challenges we face are similar to those of aging economies because we have a low growth environment. Our GDP growth is under 1%. It has been, and it's projected to continue that way. So, and our young population is not finding suitable employment and is not saving. So in that sense, we have the same problem as aging economies. Our problems have also, and that prompted the introduction of the two-pot system, which I'll talk to a little bit later. But the problems we had were, on the one hand, coverage. As I mentioned earlier, we don't cover the informal sector through the contributory system or the voluntary systems, and we have a 73% coverage of the formal sector. That's the coverage challenge on the one side, and on the other side, the adequacy of the pension benefits. And so the adequacy challenge really arose not because people weren't contributing, but because there was leakage pre-retirement. So when people, there wasn't mandatory preservation in the retirement fund benefits. So let me first talk to the coverage issue and what the thoughts are we have on increasing coverage in South Africa. There have been various policy debates, but from the National Treasury's perspective, and that's the ministry that we report into, the preferred policy approach is auto-enrollment, introducing auto-enrollment in the formal employed sector. I think the challenges on the informal sector, and I think the challenges we face there are very similar to, I suppose, the challenges that everybody faces around incentives, and I think also accessibility. So I think the situation in South Africa and the opportunities in South Africa to extend inclusion are very similar to what my colleague from Nigeria just outlined. And so I think the same possibilities exist there for, firstly, I think appropriate kind of products, but also technology to make it more accessible. The two-pot system was introduced because of calls, I suppose, largely from Labour for access, particularly during COVID, where the challenges were for people who had assets in their retirement savings, but were struggling financially. So the system introduces an early access to your retirement savings. So 30% of your contributions go into what we call a savings pot and can be accessed annually. And 66% goes into a retirement benefit. Now, what was significant about this reform is that it made preservation mandatory. So that's why this reform for South African system has been very good. So we see, and it will impact adequacy, we think, in future, specifically on the formal sector. We've seen a fair amount of access over the past year. This system was introduced, well, it's not quite a year, it's been 6 months, on the 1st of September, and there was a vested pot and a maximum that people could access of their vested pensions. We've seen now that every tax year, we've seen an increase again now in March, because that's the beginning of our tax year in terms of access. And of course, there are concerns about leakage through this, but I think the benefits from our perspective outweigh the challenges. I think the benefits go beyond mandatory preservation, because we've seen a huge surge in interest in pensions. You know, one of the challenges that you have is this complete disengagement between contributing members and their pensions and their benefit statements. So because firstly of investment in technology as well by administrators and funds, people now have better access to their benefit statements. And of course, because they now have a very strong interest in it, they are looking at those benefit statements. So we've seen, I think, a number of benefits that we haven't quantified as yet as a result of the two-pot system. And maybe just briefly, I just want to touch on some of the technology issues as well. I think the potential for technology to reach the informal sector from a savings perspective, of course, there are other products across the financial sector that can be offered much better technologically. And South Africa is financially included in the sense that we're a highly banked population, but we also have very deep penetration of smartphones and technology. So I think the benefits and the possibilities there are extensive. And we are definitely looking at learning from our peers and our colleagues, both on the continent and I think from India. Thank you.
Thank you. No, I think this is very interesting, this system which you have introduced. So maybe in the future, we may like to follow it, how it is working, because it's a very innovative idea. Coming to Mr. Price, I think, let me just shift a gear a little bit, because there is also other things involved. I think you know that the world has become increasingly uncertain. Uncertainty is the new norm. We have a situation of tariff rates. We have also a situation whereby we are trying to push up the interest rate in the USA for 12 to 13 years post the financial crisis. We could not do that, and suddenly in 2022, it has to be pushed up because of the inflation. So against all these benefits, and in a fact that mostly in a declining interest rate regime, and there is also a raising life expectancy across generations, how do these increased cost in defined pension benefit plans? So what are the strategies can policymakers adopt to manage this risk effectively? Because this is now becoming more of a risk given the uncertain global scenario. So any thoughts on this? What could be the strategies which the policymakers can adopt? Thank you.
No, thank you. And it's really important to remember that defined benefit pensions have a role. So I mentioned at the very beginning, you need something from everything. And I think there's been lots of discussions about, you talk about a pension system moving from defined benefit to defined contribution, and it's never really the case, because all government pensions, all non-contributory pensions, social security tends to be defined benefit, and it's the mixture. And so any system is going to have a look at these, the impact of defined benefit costs. There's a big difference though between whether there's assets backing those defined benefit promises or not. And so I'm mainly going to focus on that part. But one thing before talking about it is there's also a sense that defined benefit pensions are the good ones and defined contribution pensions are the bad ones. But if you were a woman working in lots of European countries which had vesting rules, or North American vesting rules, which meant you didn't get your defined benefit pension until you'd worked there for, say, 5 years. There were lots of people who actually worked dozens of years, but lots of broken career histories, who under a defined benefit system ended up with very little. Whereas under a defined contribution system where they're investing and there's contributions every single year they work, they can actually be better from a gender equality point of view. So it's just important to think through how do the rules work in terms of the way in which people actually have their working lives. But now, sort of turning to the costs, so there's an easy way to reduce the costs in a defined benefit pension system if the payout doesn't guarantee you against inflation. And that's just to lose control of your macroeconomy and have incredibly high inflation. Now that's not a good option, but one of the things I learned as I was working at the World Bank and going around to lots of different countries, you turn up in a country, you see they have defined benefit pensions, you expect them to be really expensive with massive liabilities. Actually, they're pretty well funded, and they're well funded because inflation has eaten away all of the real gains. And so there's a bad way of cutting the costs, and as I say, that's to allow inflation to have too much of an impact. There's then a whole set of things in terms of what's going to drive your funding levels. So what are the returns? And returns in lots of European schemes were very low under a low interest rate environment, and so that meant that the funding was not so good. India has had pretty good returns over the past period, so that helps your APY equivalent. And lots of the returns, particularly on the equity-based side, in people who stuck with defined benefit have really improved in the last 10 years, 5 years. What are your liabilities and how do you measure them? And I guess the main thing I'd say here is make sure that you're measuring the liabilities from lots of different angles. There's no one way to measure them. And so you have the way the accountants measure them, and you put them on the balance sheet of a company, and you measure it at a AA corporate bond. And that's not a bad way of doing it. It's market-based. But that interest rate can vary massively. And so when the interest rates are high, your liabilities look low. When the interest rates are very low, mortality is falling on average. In some countries, maybe it's running out, but I wouldn't recommend relying on it. And so to give you some examples, so what does all of that mean in terms of interest rates, rates of return, mortality, obviously needing to have contributions. So look at the UK, there's an index that someone has of the funding levels that's linked to the bailout fund. I won't go into the details, though I can. So in June 2007, before the global financial crisis, the assets more than covered the liabilities. So the funding was 118%, which looks pretty good, and that's a net £130 billion. Then the global financial crisis hits, and of course there's a massive fall in the assets. There's also, because the central banks were very significantly cutting the interest rate, a massive increase in the liabilities. Now, nothing has changed in terms of the value of the pension that you're going to have to pay out in cash terms in the future, but the way you valued it has increased. And so by May 2012, 5 years later, that 118% funding had fallen to 76%. And so the 118 probably looked too good. The 76% suddenly looks like a disaster. But you do, at that point, need to react but not panic. And so the reaction means you need to be making contributions. You need to be reducing the scale of the gap. And you need to be having good long-term investment strategies. Scroll forward to February 2025, and the funding levels are now 126%. So the best they've ever been. And why is that? That's because pretty decent investment returns have really helped reverse that decline since the global financial crisis. Mortality is not rising as much as people expected. Companies, particularly companies, have made massive efforts to have contributions, and the regulatory regime has forced them to make contributions. But the interest rates have risen very significantly from around, the 0 to 1 range to the 4 to 5% range. And so now those liabilities are looking much lower, and the funding is probably looking too good. And so what's the message I'm trying to say in terms of the funding is, particularly for your APY, look at it with different measures, look at it over the long term, but absolutely measure, then publish so it's transparent, and then act. Because the measures will change over time, but you've got to make funding contributions whilst you are through the journey. And why do I say that? Let me finish with a couple of examples. So the US, people probably heard that there were some big public spending plans. So there was one in 2021 called, that was part of the kind of big battle about how do we get back from COVID and how do we, spend public money to try and sort of help the economy recover. Not many people know that between 74 and 91 billion US dollars of that funding package was allocated to fill the massive funding gap in some large multi-employer pension plans that for decades hadn't been adequately funded. They were measured, they were published, but people didn't act to cut those funding. And it was like a political high-wire act. Can the situation get so bad that eventually there's going to be a party who has to put the money in? And they did, but that's, as I say, 75 to 90 billion US dollars of funding from the general taxpayer. Now, the advocates would say, well, the bank's got a bailout, so why not the pensions? It's just very expensive not to act. Another example on a sort of smaller scale, people probably remember Waterford Crystal, which are those nice glasses, which was a company in Ireland, lasted for 150 years. They didn't tackle their pension deficit. And when the company went bankrupt and the pensioners in payment were protected, there was only 20 cents on the euro left for the people who were yet to retire. So the failure to act on funding meant that 80% of the pension was unfunded if you were unlucky enough not to have already retired. Lots of court cases, lots of fights in the EU. In the end, the government had to bail it out, at least to a certain level. Of course, hundreds of millions of euro. And so the point being, you know there are going to be deficits, you have to fund. And if you try and avoid it, probably, either you make a disaster for some individual members or the government has to pay anyway. So better to kind of take the difficult medicine year on year rather than the incredibly unpleasant medicine in 10 years or 20 years.
Thank you. No, I think the data you've shared is very interesting. 118% to 76% to 226% and 20 cents to not to pay for the unfunded one. Coming to our Dr. Mohanty, I think the other is that I think this is also very, typical characteristics of pension industry. I think with growing awareness and there is a vanishing information asymmetry in the digital age. I think we'll all have heard about this, the information asymmetry in the financial markets in the 80s. But given that the information asymmetry is now largely vanishing in this digital age, should the investor be also given the option as far as the investment mandates are concerned? So will that be a better way of managing the things?
No, that's an important question, and as my co-panelist also mentioned, the big thing there is transparency, how transparent you are. People have various choices in terms of saving instrument. They're evaluating each against the other, and their transparency is the key. And in case of NPS, we have made it very transparent. You know, the returns that what they're getting, what the pension funds are giving are very much in the public domain at high frequency. And people can always, evaluate that with the alternatives. And then make their own choices. So that is another factor that is really prompting more pension adoption. And people who are informed, financially savvy, they can make their own cocktail. Because, for example, we have said even people can go up to 75% equity, irrespective of the age, and can retain that. And but people who cannot make choices, we have the life cycle funds, which tapers down the risky component of assets as you grow, for example, equity, so automatically. So those choices have been given, and with transparency, the rates have been put out. Of course, equity markets are a little down, but despite that, if you see the equity scheme in India, since inception of NPS, has given an annual return of about 13%. And the government NPS scheme, which is a more conservative mix of equity and debt, has given 9.5% per annum since inception. So these are good return, and so people can always evaluate. So I would see the key is transparency, and there should not be any hidden shocks or surprises coming. And so people can really make informed choices.
That's very interesting because the returns are quite good in terms of the market. And I think we'll now try to see the first one a little bit. Ma'am, I think you answered also the questions last time on the fintech. And I think that is one of the questions going to ask you. But just a follow-up question, I think, how the private sector and financial institutions can help supplement the public pension schemes. Any successful example, ma'am, which you can elaborate upon in your country, in a country like Nigeria? So basically the involvement of the private sector and financial institutions. Thank you.
Okay. So in Nigeria, the private sector already forms part of the bedrock of the contributory pension scheme in the country because pension funds administration is managed by the private sector, and the pension funds custody also sits with the private sector as well. But in addition to that, we're seeing a number of private sector companies come forward to offer their support. One in terms of pension distribution across the country by fintech companies, and also in terms of product innovation as well. And I did mention some of those products earlier. I did mention loans, I mentioned insurance, and card products like pay as you consume, which private sector is presenting to the Commission, we as a regulator, in terms of how we can work together to bring those initiatives to life. Part of what we've also done in Nigeria is a couple of years ago, we did introduce a regulation that allowed you to withdraw a certain portion, I think it's 25% of your retirement savings account towards purchasing a house, and that was in partnership with financial institutions and mortgage banks in Nigeria. So you go to them, you take a loan, and then you can use 25% of your retirement savings account, that's your pension contribution, to contribute as part of equity to acquire a loan. And if I could just mention, in Nigeria, we also have what the World Bank would refer to as the fourth pillar, which is informal system of support in old age, whether it's in the form of personal assets or general communal living. You see people who depend on their family a lot and all of that. So in supporting housing or mortgage for purchase of properties, or for contributors in Nigeria, that also fits a bit into that informal scheme. And what we aim to do is that we know that that informal support is very, very rampant in Nigeria and is very important. But what we aim to do is to ensure that there's some form of structured savings that people can rely upon and not overly be reliant on the informal support structures, which is very common given the large informal sector and again the large number of low-income earners as well. So in terms of private sector participation, what we are seeing then come on board with is product innovation and also distribution as well in terms of contribution, being able to reach every area of the country and with speed.
Thank you. I'll actually take some questions from the audience, and then, so I'll just quickly ask some follow-up questions. I think what ma'am said in terms of the product innovation, just a follow-up question to Mr. Price. I think this is, and also then to Mrs. Ludin. I think in the context of this product innovation, and as you are saying that the pension funds are strategizing to deliver returns that are higher for longer for a bigger rising pool of pensioners. So what are the innovations they can do in terms of, say, a change in their investment mandate or otherwise? And in this era of artificial intelligence, how to balance the risks to trade-offs, which could be a win-win for both parties? So I think if you can answer, have some specific points on this one, what could be the product innovation that could reward the pensioners for a longer period, so it will be very useful.
Sure, thank you. So let me start on the investment side. So one of the biggest things is the link between the investment side and the payout side. So as many of the private pension plans moved from a defined benefit world where it makes no sense to not have a payout phase because the pension is the payout phase. What do I get in retirement? When you move to a defined contribution and you're accumulating your assets, there's absolutely no reason why you need to kind of cut the pension payout phase off and that you then get your money at 55 or 60 or 65 and then you have a sort of completely separate decision about what am I going to do with these assets. And in some ways that's been the worst change in the whole transition over the last 30 or 40 years. Because what people want to do with those assets is spend them. So Malaysia, who has one of the best accumulation phases in the world, 50% of people have used all of their assets within 5 years, and 70% have used them all within 10 years. They have 23, 24% contributions. And so why am I mentioning this in terms of investment? Because if you reconnect the accumulation phase, the investment phase, into the pension phase, and you reconnect the idea of pensions as being something which delivers an income in retirement, that means your time horizon is not just 20 or 30 years, it's 30, 40, 50, 60 years. And that allows you to have a very much longer term investment strategy, allows there to be more risk. You have to check that the equity market in your home country is worth it. Lots of countries have defective equity markets and you wouldn't want to put your money there. But then you think about the balance between domestic and international. But thinking about it, investing not to retirement, but all the way through and linking it to a payout product. And so we've done lots of work, what we call a value annuity. So it's a variable life annuity. So it pays you until death, but you keep the assets invested. So it's not an annuity from an insurance company where they put all the money in government bonds. And if you look at it, it should give you benefits, probably 25% higher pension than if you go a traditional annuity route. And a country like India could do it. We actually did, India and Malaysia were case studies. But what it means is, even just in simple terms, my investment horizon is now much longer, which means the costs can be much longer because I'm not, as a provider, having to worry about someone coming in for 10 years, withdrawing their assets, coming back for another 10 years. I don't have millions of accounts which are tiny. So the long-term horizon. And another big thing on the investment side is too many systems. You know, it's good to have daily valuations where you can see how my pension plan is changing. That leads to a lot of rigor in terms of valuation. But a daily valuation, DC, a defined contribution, mutual fund model, which is often coming from sort of mutual fund markets in the US, is not the right model necessarily for pensions. And if you want to invest and get good long-term returns for members, you want to invest in difficult, illiquid investments, but only if you have the scale and the skill to do it. So part of it is pension system design. Do I have big institutions with the scale, the expertise, and the member-focused governance to do tough infrastructure? And then am I allowed to have a valuation and a reporting regime which maybe has monthly or quarterly valuations, not daily? And so the UK is introducing something called an LTAF now because they were seeing that too many pension funds were moving to the kind of the daily pricing models which don't try to get into these illiquid investments. And then if you do that and you do it well, you then end up having a source of good long-term investment for your domestic economy, as well as a link, and you should be moving for the domestic and the international together, because if you have more illiquid investments in your domestic economy, you need very highly liquid investments. Say if people are switching, if someone dies, they need a payout as people get to retirement. And so the mix of the public and private being invested in a global index fund of bonds or equities where you can always sell, where it's easy to get your assets, helps mean that you're not kind of suddenly forced to sell your assets in a downturn. So let me say that on the investment side. For time, remind me on the second question.
Yeah. No, this is, I think, this is fine. I'll have the last words from Dr. Mohanty. I think there are two questions over here. I think pension for all is a great initiative indeed, and India actually has set the vision by 2047 of an Viksit Bharat and pension for all. But in a country like India, where pension access to GDP is still in lower double digits, how do you think could be the other innovations which we could do in terms of those addressing those people at the bottom of the pyramid in terms of some meaningful gains? So that is one part of the question. The second question which I want to ask is that, as we were saying in the morning, that the government has introduced a unified pension system. And so, I mean, if you can just elaborate on a little bit, because this provides a fixed pension amount, and it includes an assured pension with inflation indexation and an assured family pension. So I think that's an interesting proposition. So if you can just highlight on these two, it will be grateful. Thank you.
No, unified pension system, as Mr. Price just mentioned,
yes.
It is again payout phase. You know, what do you do at that phase? So what is unified pension system does that it is brought in the defined benefit. You know, that we say 50% of last 12 months pay that you have, and then it is fully funded. You know, upfront. So. You know, in case of the defined benefit pension plan is various funding gaps and fluctuations that also you mentioned, and so that was an issue. But this is a fully funded pension scheme, and it optimizes on the return, because do you have an alternative to annuity? You know, that you optimize the market in that sense, and here the corpus which is created both for the guarantee and for what the employer-employee subscription is there. So that is invested in the market and generating the market return. So it is again pulling and gives you the best possible return. Of course, these are pension funds, these are not hedge funds, so balancing the risk. That way return is also optimized, which reduces the funding gap in the whole process. So a payout phase is addressed. And in case of, you know, Atal Pension Yojana, that what we see, it is also defined contribution, defined benefit. Though the benefits are small because it's a micro pension between 1,000 to 5,000 rupees. And, but it is also generating very good return because it is invested in the market. It gives per annum about 9% return. So the funding gap which the government stands guarantee is insignificant in the system. But in case of a contingency, the government can always step in. So optimizing return in the financial market becomes important to improve the sustainability of the pension system. So I would say that on that front. And here again, you know, that if you see that in case of informality, and that how we are going to address, because the nature of employment is also changing to gig platform and contractual workers. And the Social Security Code which is come out, it also promises that all these cohort of employees also would be covered. Then we would have to see how to address that. We have various alternatives. Of course, the APY and NPS are also open to them. And there are other social security schemes the government has. So that is one way that we are addressing this. And the other is that to position pension not as an individual product but as a family product. That if you're doing NPS, you see how do you get the gender balance there? You see bulk of our women labor force, they are unpaid household work. So what is the social security for them? NPS can be taken. What is the social security for your children, at least to empower them and make them aware in that whole process? So then we brought in the NPS Vatshalya. So this pension product that we are projecting is for the family rather than an individual pension account. So this is the way that we are trying to address that over time, that we would be able to cover everybody eligible for pension. Thank you.
Thank you, and I hope we will achieve that, and there's best of luck. So thank you for all the panelists, and if anyone has any questions, I can take a couple of questions from the panelists. Just mention your name and to whom the question you are addressing to.
Thank you, everyone. My question is directed to Professor Deepak Mohanty. Myself, Dr. Haldhar Sahu from Kalahandi University, Odisha. Sir, as you mentioned, in a lighter note, that there is a private cocktail and people are mixing that and making good returns. Even in fact, one of my friend, he had generated a return from NPS around 15%. That is different kind of CAGR. But he is enjoying the active choice equity. At the same time, I being a government employee, totally feel discriminated because I do not get any active choice. And even in fact, I am compelled to put my money in 100% bonds. So when I wanted to use active choice, when are you going to give us that liberty? Because basically by looking at the past trend, in past 16 years, what we have seen is that this corporate debt and government sec has generated a CAGR around 8 to 9% basically. But equity is the only asset class which could jump up my return. But I'm not getting the liberty to put it in. Even in fact, I do have a paper for that also, but thank you if you could address on that.
Of course, you know, NPS you have that option, and NPS also has a tier 2 account where 100% you can put in equity, and it is like an ATM. It's like a current account. You can put money and can take it out, and the risk is also not that high because this equity universe is also regulated. Because we only allowed top 200 as things stand now, equities to be invested. So it is not that everything that you can invest on in retail. But the alternative that you have, you know, they have their investment policy. It would not be appropriate for me to comment on that what kind of a choices and all that should be given. But suffice to say that these are pension funds, and safety is also of paramount importance, so that we have to think of safety of the funds over 30, 40, 50 years. Maybe returns are low, but you know, it should be in safe asset. Thank you.
Just to add to Dr. Mohanty's point, I think Indian debt market has also undergone a significant transformation in the last decade or so. If you look into the holding of the government securities, the share of provident funds and pension funds have increased significantly from what was there around 10 years back. And the banks, which are supposed to be the largest, which still remains the largest, the share is actually moderating. So that's a good sign of diversification of the market. Yeah, any other question you have? Yeah. Please introduce yourself and to the...
Sure. Good afternoon. My name is Sriram Iyer, and I represent one of the fund managers in the NPS architecture, HDFC Pension Fund Management. I have two questions for Mr. Price, if you can indulge me, sir. Question number one is the importance of tax advantages at the time of investment, given the fact that these are very long-dated investments from a subscriber's perspective. He gets to see the corpus at the age of, 60 or whatever. There is a very large amount of time that he has to spend. How important do you think how important is there a tax reduction at the time of investment? How important is it, and what are the global examples on this? Because in India at this point of time, it's available to a certain segment of the subscribers, which is salaried employees, but the self-employed doesn't really have a very compelling tax advantage. So that's question number one. Question number two is, there is a very close correlation at the superannuation stage. One of the other big important elements that comes in is healthcare, right, and health cover. Do you have any experience with global examples of pension plans which have a correlation or a linkage with some form of a medical cover at the time of superannuation? Because that's another big gap which is there in our country. Because at that time, your medical costs go up, but there isn't sufficient corpus available for the individual to and there are no covers available. Or at that age, it becomes very, very expensive. Thank you.
Thanks very much. So on the tax incentives, I'm glad the issue was raised. So as you say, it's a big thing for someone to put their money in a pension, the money to be locked away and then have to wait for decades. In general, the use of tax advantages is the standard way, but often is quite ineffective, is often very expensive in terms of the foregone fiscal resources, and often targets the money almost exclusively on the higher income. And in India, lots of countries, many of the people on the lower incomes wouldn't be paying any tax anyway, so tax-free is a kind of irrelevant incentive. I think that having matching incentives, something simpler whereby everybody who contributes, you get a third or 33% contribution as if it were tax relief, whether you pay tax or not, is a better approach. And particularly for people who are lowest income, even quite small flat rate contributions can have very powerful effects on the percentage that you are contributing of even low wages. So to give two specific examples, Turkey in 2013 shifted from using tax relief to promote individual private pensions to matching. And that meant that everybody could get it, and that was associated with a very significant increase in the coverage of private pensions. The flat rate is used in Mexico, for example, where they call it the social quota, and I would advocate India should use it absolutely. It was sort of used in the Swavalambam plan in some ways, the matching or the kind of flat rate contribution, but to say that if you contribute, you will get X%. You don't have to understand tax, and I know your tax system is going through some pretty massive changes. People don't understand pensions, they certainly don't understand tax, and the chance that they'll understand pensions and tax together is pretty low. But if you say you contribute, you get 30% or 50% or whatever the number is, make it super simple, I think that would be a more effective way of incentivizing pensions. The final point to note on that, what does APY tell you? The huge success of APY dwarfing other initiatives is nothing to do with tax incentives, it's to do with the nature of the product. Now you have to make sure it's well funded, and you could, if you don't fund it, store up a massive problem like lots of other countries have done with defined benefit pensions. But people are often attracted by the nature of the product, which then brings me to the second answer. It's a really good question, and there are very few examples I can think of where at retirement someone says, you're going to get X in your pension and you're going to get Y in terms of health insurance coverage. But it absolutely should be used more, that the bulk buying power of very large pension funds, which they've used to get good deals from fund managers in the accumulation phase or from the payout phase, should be used to get good health insurance. You used to get it a lot in employment plans, but not in a way which is well studied and not in a way I can give you good examples. But let me conclude with something in a different area that I was hearing recently. So there was a scheme in Indonesia. How do we stop people cutting down trees in the forest for environmental reasons? And you do loads of education, you do enforcement, you do lots of things. In the end, the thing that worked was saying, if your village doesn't cut down the trees, you get subsidized healthcare at the local clinic. And it was immensely successful. And I think the same is probably true for pensions, that if you say to people, if you contribute, you get sort of quotes free healthcare coverage, that's the kind of thing which may be a much better incentive than spending billions in tax relief, which effectively is just giving tax breaks to people who are higher income.
Thank you. I think the point, this question is very important in the context that India actually has transitioned to the new tax regime, whereby the concessions are not there. And it remains, and I think at the end of the day, given the cohort of the current individuals who are at the younger age, maybe they may be more inclined to save at their own perspective rather than going for tax breaks. So this is something which we may research on, but that we have actually moved ahead of the tax regime. I will have time for one or two questions more if anyone has anything. Just answer the question, then I will take the questions together and then, yeah.
Yeah. My name is Ahmed Laon from Nigeria. Just like South Africa, where you have two portions for the informal sector, Nigeria also have two portions in terms of contingency and retirement benefit. The contingency is meant to address the issue of flexibility, while you have a dedicated fund set for retirement benefit. So now my question is to Mr. Deepak, taking cognizance of trying to see how we can onboard the informal sector. How do you now strike a balance between the issue of adequacy and flexibility, taking the nature of this informal sector? Thank you.
Sir, answer now. I'll take another question and then close it.
Briefly, we have provided some contingency in case of NPS. Say 25% of personal contribution can be withdrawn in case of contingency, like health issues, wedding in the family and things like that. But that's a small component. And as I was just mentioning, tier 1 is more lock-in, and tier 2 in the NPS has two tier. Tier 2, which is there, that is full, contingency. You put some money that you see you want to stay liquid, one can really use that liquidity in that case. And of course, for the micro pension, we don't have that. But
we have alternatives that people have problem because these are things mostly done from the banking sector. You need to have a bank account to do this, and these are all done digitally. But there is always a microfinance and small loans they can always take in case of contingencies.
One last question, just one last question.
Yeah. Good morning. Good afternoon.
Yeah, please go ahead.
So my name is Rajiv Gupta. I am from Religare Broking Limited, and my question is to Dr. Deepak Mohanty. We have noticed that Dream 11 has got 23 crore subscribers, right, in few years, 2-3 years. And while, for example, 17 crore Demat accounts took 25 years, and 8 crore subscribers took 20 years in NPS. So what we can learn from Dream 11's experience in terms of ease of onboarding, and how much of it can be implemented here so to increase the adoption of NPS or other financial inclusion products? Thank you.
I can give you, economist's answer to your question. It is well documented, well researched, well proved that instant gratification overrides. Though as humans, cognitively we can see our future and plan for our future, but it is not always the case. The initial gratification overrides the other thing. If I say I'll give you 10 times the Dream 11, 50 years down the line through the power of compounding, you are finance people, you can just calculate, there is a pension calculator, and I give you Dream 11 3 crore instantly. So you will fall for that, and in the process many people ruin that. The gambling instinct overrides on the other side. Of course, I take your point. There is a need. There is a need to popularize the scheme, and so that it becomes much more attractive to people. People take notice of that.
Thank you. And I think some last question, yes, the gentleman, and then we'll close it. Yeah.
Good afternoon, everyone. Myself, Mohammad Zulkarnaim. I'm the Deputy Director of SARC Finance. So I have a question. How can, as a communication student, how can SARC countries collaborate to develop a regional framework for pension security? You know that SARC nations are working for future generation and for future pension security, and fintech also collaboration with that. So is it possible to collaborate these SARC nations? Thank you.
Yeah, I would say it is quite possible that collaboration is going, and you see that in terms of international participation, we have members from other SARC countries, Nepal and Bhutan. They are also represented here, and we also welcome delegates coming from the SARC countries. To formalize it, of course, it can always be reflected on, and why not?
One very brief thing on that. I think there's massive scope. We did some work on migration, South Asia to the Gulf countries, migration and how to expand the coverage of insurance and pensions for migrants. And there are some schemes which work in a particular country. The United Arab Emirates, in parts of it now, has the world's first defined contribution pension plan for migrants. If there are an initiative across South Asia and the Gulf countries to kind of link up the different schemes, so there's a kind of clearinghouse to mean that all of those individual experiences then are better linked back into the home pension system, I think there could be massive scope for improvements in coverage and assets under management and future pension income.
Yeah. Anything, Mrs. Rudni, you want to add? Anything from your side?
No, I just think one of the interesting points out of the conversation is around product innovation and the access, particularly on the informal side. So, from our perspective, what we are looking at is using our sandbox to try and test some of these fintech products. But of course, it may be better to actually just have a much more enabling regulatory environment so that the experimentation can happen commercially rather than in a sandbox. But you know, and maybe just the last point, it's been extremely interesting, certainly for me, to listen to this conversation, and what struck me is how much we can learn from each other. Thank you.
Thank you. Thank you, everyone. A big round of applause for the panelists. I think we covered a lot of distance, and it's really an enriching journey to learn and understand and make sure that we all are invested adequately for the future. Thank you.
Thank you, everyone, our panelists and participants, for an active and interactive discussions. It was indeed an insightful session. Now may I request officials of PFRDA to thank our panelists for their valuable contributions by delivering that token of appreciation. Let's have a huge round of applause for our panelists. Now I would request Shri Pravesh Kumar, Chief General Manager, PFRDA, to hand over memento to Dr. Soumya Kanti Ghosh, please. Ma'am, a memento, please. Yeah, please. Thank you very much. Thank you. Now I would request Shri Vikas Kumar, CGM PFRDA, to hand over memento to Ms. Umolola Olavaran, please. Thank you very much, sir. Now I would request Shri Sumit Kumar, CGM PFRDA, to hand over memento to Mr. William Price, please. Somebody will take the mementos. Just take them from the handle. Yeah. Thank you very much, sir. Now I would request Shri Arumuga Rangarajan, sir, CGM PFRDA, to hand over memento to Dr. Deepak Mohanty, please. So it's a pleasure to have that. Thank you. Thank you. We would also like to hand over a virtual memento to Ms. Astrid Luden. Thank you very much, ma'am, for being here. I now request everyone to join us for the lunch. The arrangements for lunch for dignitaries and panelists is at MR19, one floor down, and the other guests are requested to please join us for lunch at pre-function area. Thank you very much. Thank you. I also request everyone to join back at 1:50 p.m. so that we can commence the next panel session on time. Thank you very much, everyone. Thank you. Enjoy your lunch.
I would request everyone to please settle down. Good afternoon, ladies and gentlemen. It is an honor and a privilege to welcome each of you to this prestigious conference. I welcome our distinguished speakers present in person and through virtual platform, dignitaries, esteemed participants, and researchers again to the first International Research Conference organized by PFRDA and Indian Institute of Management, Ahmedabad. My name is Jaspreet Kaur, and it's my pleasure to be your host for another session of the conference. Your participation today elevates the importance of the discussions we'll be having. This conference serves as a crucial platform for addressing the dynamic and evolving global landscape of pension systems. The discussions will span economic, environmental, and social challenges reflecting the diverse experiences and strategies from around the globe. It provides an excellent opportunity to share knowledge, collaborate, and explore innovative solutions to some of the most pressing challenges in our field. Different countries have varied economic environments, regulatory frameworks, and investment approaches. By studying global best practices, pension funds can identify effective strategies that have worked in other markets. By leveraging international expertise, pension funds can better navigate complex and fast-changing financial markets, optimize returns, manage risks, and adapt to emerging challenges. Moving on to the next session of the conference, we have gathered some of the best minds from the globe to share insights and ideas on pension. Panel discussions are important because they bring together diverse perspectives, encourage meaningful dialogue, and provide valuable insights on complex topics. In line, the topic of our panel discussion is Global Lessons on New and Innovative Investment Practices in the Pension Industry. With this, I would like to invite on stage Professor Abhiman Das, Director, IIM Ahmedabad, as a moderator. Please, sir. Professor Abhiman Das is currently the ICICI Bank Chair Professor of Finance and Strategy of IIM Ahmedabad. Sir is a professor in economics and was also the RBI Chair Professor of Finance and Economics of IMA. A warm welcome to you, sir. Now, I would like to invite our esteemed panelist, Professor Prachi Mishra, Director and Head, Ashoka ISEC Center for Public Policy. Please, ma'am. Prior to joining Ashoka University, ma'am was the Chief of Systemic Issues Division and advisor in the Research Department and International Monetary Fund. You're welcome to the panel, ma'am. I would also take a pleasure to invite Mr. William Price, CEO, D3P Global, again to the panel. Mr. Price is a global pension expert and works on regulation, investment, risk, and social policy in financial services with a focus on pension and retirement income. Thanks for joining, sir. I am pleased to welcome Mr. Tushar Arora, Senior Financial Sector Specialist, World Bank Group. He leads analytical advisory services, lending operations, and policy dialogue in the financial sector. His work spans key areas such as digital financial inclusion, financial stability, long-term finance, capital market development, and MSME financing. I am also pleased to welcome Mr. Brian M. Miller from Vanguard, Head of Target Date Fund Product Management, who has joined us virtually and will be our valuable panelist. Sir is a senior investment specialist on multi-asset solution teams in Vanguard's investment management group. Welcome to the panel virtually, sir. Our next panelist who has joined online is Dr. Paul Yu, Director, Policy and Regulation, Mandatory Provident Fund Schemes Authority, Hong Kong, China. Dr. Paul is responsible for formulating investment policies and regulations of the Mandatory Provident Fund. Thanks for joining us virtually, sir. We also welcome Mr. R. Mark Davis, Senior Financial Sector Specialist, World Bank Group as a panelist for the session who has joined virtually. Mr. Mark work focuses on pension investment, governance and design. Welcome to the panel virtually, sir. Each of our panelists brings a wealth of knowledge and expertise, and I'm sure we are in for an insightful conversation. This is going to be a mixed panel wherein the panelists may ask questions to each other. Over to you, sir. Thank you.
Thank you, and a warm welcome post-lunch session. And we are going to talk primarily on the global relations and on new and innovative investment practices. And you know, the panel is a little bit organized differently. We are two moderators here, myself and Tushar. And we'll start with three brief presentations by the three, I think, specialists who are joining online. And we'll start with, because you know we have a really hard time constraint. We have to finish it by 3 o'clock. So we'll start directly with Brian. Brian, if you can share your experience, particularly on the topic of target date funds, roughly in 13, 14 minutes, and then we'll take it over to Paul and then Mark. Brian, can you hear us?
I can. Can you hear me?
Yes. Yes. Go ahead.
Okay, perfect. I'm not sure if everybody can see if the presentation is being shown on the screen there, so hopefully we can get that up. But first and foremost, thanks very much for having us here today. It's certainly my distinct pleasure to join you all at this wonderful event. By way of introduction, again, my name is Brian Miller. I lead our target date fund oversight here at Vanguard, where we have the privilege of managing roughly $1.5 trillion in target date assets globally. And target dates is really where I want to focus a portion of this talk here today. And the reason we want to do that is because what we've seen over the past couple of decades as defined contribution retirement markets have really started to expand globally. We've seen that that's been really accompanied by the rise of target date funds as a key innovation within the space. And it's honestly started to transform the way we see millions of people across the globe really save for retirement. So what I want to do in the roughly, let's call it 14 or 15 minutes that we have is just explore a little bit around the evolution of target date funds, talk with you a bit around some best practices and learnings we have within the space, discuss a little bit about what we've seen in terms of the impact on investor outcomes, and then I'll just wrap up some of my comments with what lies ahead in the space as well. So there we go. We've got the presentation up on screen. We can go ahead and go to the next slide here, and I'll just start here at the beginning because I think that probably makes the most sense. Target dates were really introduced back in the early 1990s, though what you'll see shortly is that we really didn't start to see widespread adoption until the early 2000s. What you had is really this transition that was taking place in a number of markets away from sort of more defined benefit plans towards more defined contribution plans. And I think what was quickly realized in a lot of countries is that many workers, many investors just didn't have the time, they didn't have the expertise to effectively manage their retirement investments. So target dates were really developed as a way that we could give investors a simple and a practical solution to try to address this gap. The intent here is really to provide a single age-appropriate portfolio of stocks and bonds that would reallocate over time, but in line with an individual's life cycle. So you would have allocations to more growth assets like equities whenever an individual is young, and then over time, as the individual starts to move through their career, you would see a transition to more stable assets like bonds as retirement years. In theory, the whole idea here is that assuming proper savings behaviors, target dates should give investors that ability to meet their retirement income needs, but do it with very little intervention, very little portfolio management skills required on the part of the end investor. If we go to the next slide, you can see that this idea has really caught on pretty quickly. The target date market today sits at over $4 trillion in assets globally, and that's, again, come about pretty quick. The US was certainly the first country where you saw target date use just explode. This followed what was called the Pension Protection Act of 2006. That really created a target date as a qualified default investment vehicle. And interestingly, today, if we look at usage, target dates are in about 95% of US employer plans. over 80% of participants actually use them today, and many have it as their sole investment within their retirement accounts. And then what we've also seen is that with the success we've seen in the US, a number of other countries have started to follow suit. Just to give you a few examples, Mexico and certain South American countries like Colombia, Brazil, have certainly implemented age-based allocation strategies in a number of different forms. I think Mexico is a great example. We saw the Mexican Afores there, the large pension plans that made a widespread effort to shift from more target risk style strategies to more target date style strategies in the last number of years, and have certainly had some success doing that in that space. You've also seen other areas like Australia, where regulations have allowed target dates within the life cycle strategies, and we see the majority of members there using these age-based life cycle type solutions. And then in the UK as well, we have the National Employment Savings Trust, or NEST, which allowed auto-enrollment back in 2012. You now see that about 99% of the NEST members, that's about 8 million people, are using target dates today. So just a few examples, but I think the key takeaway here is that while we've seen the pace of adoption and maybe the product structures that differ globally, the trend itself is pretty clear, that providing these strategic asset allocations based on age have become really the cornerstone of the defined contribution space. And this is across both developed and emerging markets. If we advance to the next slide, I want to talk with you a little bit about implementing and constructing target date solutions. So at Vanguard, we have been building these now for just over 20 years. We work with a number of local regulators, a number of pension schemes to really help design similar investment vehicles. And frankly, over time, we've developed a bit of a playbook that we try to adhere to when we design these solutions that we think can help promote some better outcomes for investors. So I want to walk you through a few of these ideas here at a high level. If we go to slide 5, the first principle that we certainly focus on is who is the end investor, right? What are their needs? What's the ultimate objective? What do we know about them and what don't we know about them? What's interesting in this space is that the typical retirement saver, again, usually lacks kind of the time, the willingness, the ability to design and implement an asset allocation over time that can enable them to reach a successful retirement. And usually they're simply not very engaged with their retirement. The other key thing is that we don't usually know a lot about this end investor, right? We know the investor's age, we might know roughly when they anticipate retiring, but we don't know individual specifics like their personal risk tolerance, their health, their outside assets. So when we're designing target date funds, we have to think about them for a broad group of investors and take a bit of a one-size-fits most approach based on age. And if we go to the next slide, this really goes hand in hand with the concept of determining what it is that we're trying to do with the target date portfolio. Here again, what we're doing is trying to get an investor entirely through their working years, make sure they accumulate enough assets so they can meet their retirement income needs. So when we think about this isn't just a return maximization effort. It's not just about minimizing risk, right? Instead, what we want to do is design a target date that can provide age-appropriate levels of risk and return to get you to that desired retirement target successfully. So we want to try to promote sound investment behaviors and certainly prevent things like inopportune selling, right? And this dovetails into the next illustration that we have on the next slide, where we think about the next key principle, right? And again, because we know very little about the end investor here, we have to try to think about the right inputs that allow us to create the right glide path, the right asset allocation. But while we're seeking to optimize that, it's not just a theoretical exercise, right? Instead, what we think is that this really needs to be a process that blends together 3 key areas: the quantitative, the qualitative, and the practical. And these all come together to really try to meet the needs of real-world investors, right? On the quantitative side, there are certainly a number of sophisticated models out there that allow us to do thousands of Monte Carlo simulations to build the most appropriate glide path for a given population. But we think that that needs to have an overlay of qualitative attributes, right? Individual characteristics that can allow us to hopefully hedge against some of the behavioral risks that we tend to see that are inherent with a lot of investors. And then lastly, there's the practical, right? We want to think about real-world practical considerations like fees, liquidity, simplicity. right? It's really this blending together of art and science to try to produce something that's theoretically and financially sound, but also practical at the end of the day. We go to slide 8. The third principle that I mentioned here is just an importance around strategic asset allocation, right? Determining the right mix of asset classes across each stage of the glide path. We've certainly seen numerous studies that have been done over the years that have shown that strategic asset allocation for these long-term portfolios is really the main driver of long-term return variability, accounting for roughly 80 to 90+%, depending on the market, of that long-term return variability. So much more important than many other factors like short-term tactical asset allocation. So we really believe that having this strong foundation is a critical starting point. And really goes hand in hand with the next slide as well, that we think that investor outcomes really can be improved by increasing diversification within portfolios, right? We really believe that expanding the opportunity set, being globally diversified, spreading yourself across securities and sectors and regions allows target dates to better capture growth opportunities and, importantly, smooth out some of that short-term volatility that you may have associated with a singular market. And then finally on slide 10, and kind of tying with that last idea, is just this idea of trying to reduce home bias gradually over time, right? What we see with target date funds, no matter where they are, is that they tend to invest heavily in domestic markets. That's true everywhere that these are implemented. This can be for a number of different reasons, but again, we find that having an overly restrictive asset allocation can hinder some of that diversification. So again, what we found as a best practice is as target dates are implemented, gradually trying to open up, provide more diversified portfolios over time. Again, this can be eventually on a global stage, but we also see that by diversifying domestically within and across asset classes, you can start to realize some of these benefits as well. And it can be a great initial step to try to reduce some of the concentration that we tend to see in these portfolios. So again, a few best practices that we see. We can certainly talk through a bit of them as we head into the panel piece. But if we go to the next slide, I'm sure as you're sitting here thinking about some of what I've discussed in terms of target dates and adoption and best practices, what you may be asking is, have these actually helped, right? You know, they've been in place for a bit. Have they actually improved investor outcomes? So what we've seen so far, and again, these are relatively new, is that we've actually had some pretty encouraging results from investors in the target date space. If you go to slide 12, I'll give you a couple of quick examples. One major impact that we've certainly seen is that target dates typically lead to more appropriate risk-taking behavior. What we show in this illustration is that prior to target date funds, we saw a significant number of investors that simply were just making suboptimal choices with their investment allocations. We had a lot of young workers that were overly conservative, right? They might have been in all cash or all bonds. That certainly put them at a bit of a risk of meeting their future retirement goals. And then on the other end, we had older workers that were still staying overly aggressive when they didn't need to. What we've seen is that target dates have largely eliminated these extremes, and we've seen a shift towards more appropriate age-based allocations with TDF adoption. On the next slide, again, another positive that we've seen is really just around better risk-adjusted returns compared to those investors that do it themselves. These two illustrations, the first one where you see the dots sort of all over the place, this is representative of the, I'll call it do-it-yourself investors, right? You see that the risk-return range is very dispersed. Some had excellent outcomes, other ones took on a lot of risk without any return. You contrast that then to target date investors in the second illustration, and here what you see is the outcomes are much more consistent, and they provide really that nice balance between the return achieved and the risk taken. And then lastly, the last benefit that we've seen, moving to the next slide, is just around the discipline and stability that target dates tend to induce, really this kind of sticky money effect. We see time and time again that because target date investors delegate their portfolio management responsibilities, they're really less prone to making some of those emotion-driven shifts during periods of market turbulence. And we see that target dates tend to trade much less during all market cycles than virtually any other type of investment. And again, this can be really beneficial, I think, during periods of market crisis, because instead of having millions of individual investors panicking and selling, target states just rebalance systematically. So they can act as a bit of a stabilizing force within markets and make sure that they're not exacerbating crisis further. So overall, I would say the story thus far, certainly encouraging, but as we depict on the next slide, target dates are really just one part of this savings puzzle, right? It's clear that we think target dates work best in conjunction with features like automatic enrollment, default investing, promoting adequate contribution rates. So if we take all of these together, we just do think that continued efforts around improving participation, increasing savings rates, providing financial education, all of that really goes hand in hand with the expansion of target date funds. The last piece I'll leave you with in the last minute or so is just where we think the industry itself is headed. A couple notable trends that we show here on the next slide, on slide 17. The first one is just around expanding access and investment opportunity. This just means we think we should continue to see expanding coverage to smaller employers, to informal sector workers, to countries and sectors where plans aren't just common just yet. We've certainly seen the World Bank and other agencies that work with various economies to help develop private pension pillars, hence part of the reason we're here today. And target dates and life cycle funds, I think, can really be a powerful addition to a lot of these systems since they encourage participation and they can really channel savings into growth assets in a safe manner. The second one, again, kind of goes hand in hand with number one, and this is really around increasing engagement in education. I think what's interesting is that even though target dates thrive on kind of a no action required premise, investor education, investor engagement is still critical. The better informed participants are, the more likely they are to stick with the program, the more likely they're to avoid periods of volatility and panic. And so we really think that effective communication is needed to make sure people really understand what these portfolios are trying to do so they don't abandon them during periods of market volatility. And then the last two areas really just around improvements, I would say, that we're continuing to make within the target date space. One, on the decumulation front, certainly target dates have proven to be great accumulation vehicles, but decumulation tends to be much more personal, right? So the industry is very much focused on how do we take those accumulated assets and convert that into a steady retirement paycheck for investors. And then with that, this idea of greater personalization, right? Can we move target dates from a one-size-fits-all to more customized asset allocations over time? Both ideas certainly face challenges, but we think these are areas over the next 5 to 10 years where you'll continue to see improvements within the target date space. So to wrap up, hopefully what you've seen here is that target dates have kind of moved from this idea of an experiment to really what I would say is the centerpiece of retirement systems in many countries. This powerful idea of asset allocation, of diversification, it can drive better investment outcomes. We obviously know that a lot of jurisdictions, they're going to chart their own glide path towards target date adoption, but we really do think that by expanding access, by embracing sensible innovation, by integrating things like education and decumulation solutions, that target dates can really play, I think, a powerful role in enhancing retirement security for a lot of investors worldwide. So I want to thank you for your time today. I know we have another presentation after this and look forward to your questions when we get to the panel section. But thank you very much.
Thank you, Brian. I think you be there. We'll get back with questions very soon. But before that, I think we can move from Vanguard to the Mandatory Pension Fund Authority, Hong Kong. Paul, you can speak over maybe again 13 to 14 minutes, and the questions and other clarificatory remarks will come down the line. Okay, so over to you, Paul.
Thank you very much. Thank you very much for inviting me to speak from Hong Kong. I'm joining virtually, and it's really my honor and pleasure to represent the MPFA in Hong Kong. The MPF system has been in place for almost 25 years, and so we have accumulated some stories and experiences to be able to share with the international community. So this is really a precious opportunity, and hope in the 50 minutes or so, this presentation will give everyone some insights or pointers that we can ponder on and see what lessons can be learned from other parts of the world. So The next slide will show the things I'm going to cover. So I will give everyone an overview of the MPF system as it currently stands. I will also talk about the MPF investment regulation regime. So we have a very elaborate regime is cast in the legislation. We also talk about 2 case studies, which are very important policy reforms of the MPF system over the years, the Default Investment Strategy, DIS, as well as the EM Platform project. So I will talk about these in detail in a minute. So moving on to the first is the quick glance of the MPF system. And the next slide will show that from the perspective of the, if we look at it from World Bank's multi-pillar retirement protection framework, the 5-pillar framework, MPF sits between pillar 2 and pillar 3. Because it is a mandatory system, so predominantly it is on pillar 2. But we also have a voluntary element, which is growing because we are encouraging voluntary contributions made by employees. So there we have some crossover to pillar 3 as well. But if we look at the next slide, we can see that the major features of the MPF system, actually, there are a few things that I think it will be important to highlight at the outset so that we can continue our discussion. First is that, as the name suggests, it is a mandatory system. So by mandatory, I mean that under the law, it is very clearly stated that the employers and employees should participate in it. And then both of them have a role to play in terms of choosing scheme, choosing investments, and also making contribution. And then, of course, stating in the law means that there are penal provisions if the non-compliance will result in penalty. And it is fully funded and financially sustainable because it's a defined contribution system. So there is a very clear definition under the law, the contribution level on the part of both employer and employees. And then the contribution level, there is maximum and minimum relevant income levels. They are subject to periodic reviews. There is a statutory mechanism for the review. And there's also a cycle for it. And then but the total contribution currently is only about $192 from employer, and also at the same amount for employee. So the maximum making up less than $400 per month. That means that the total contribution will still be quite small without any voluntary contribution. And therefore, over the years, we have been very, very concerned about using the MPF contributions for other purposes other than pension, investment and accumulation. In the middle of the chart, we emphasize that the MPF system is an employment-based system. So as I said, employer and employee both have a role to play in making contribution and choosing scheme and investments. The investment choice is entirely the employee's choice because it is a mandatory system, but we want them to manage and empower them to own their own investment. That's why they have the investment choices. Moving on to the next slide, I want to show you that currently some statistics about the MPF system. So we have over 4 million scheme members in Hong Kong, so covering almost all employees and all employers. The employers enrolled will exceed 300,000. Of course, for self-employed persons, because they own their own business and they employ themselves, the figure is relatively lower because it's quite difficult for them to know the requirements, and also they are not institutions, they're not corporate, so the enrollment rate will be less than the institutional side. On the right hand side, we have 12 trustees operating 24 schemes and offering 379 funds for investors, scheme members to choose from. The next slide will show that the asset under management of the MPF system have grown significantly. For a 10-year time span from 2015 to this year in January, there is a 129% growth in AUM. But of course, I must say this is a contribution plus return. So the contribution grow as well as the investment return. And if we look at the next slide, we will get an idea how the MPF funds are performing. Usually, we classify our the 300 or so funds into different types, which follows broadly the market convention. So equity, mixed asset, bond funds, guaranteed funds, money market funds. The MPF Consolidated Fund is statutory fund. And there are other types of money market funds in the MPF space. If we look at the growth drivers, which are usually the equity funds and mixed asset funds with a higher equity component, we can see that their share of the NAV in the MPF system is quite big, as well as the annualized rate of return in 3 dimensions, past 1 year, past 10 years, as well as since the inception of the MPF system, have been quite impressive. But of course, equity, they could potentially bring better growth kind of potential to scheme members. I must add that Hong Kong people are also, by tradition, they're quite used to stock investment, and that's why there is also a trend that they tend to invest more in equity funds as well as mixed asset funds. And then if we move on to the investment regulation regime, which I would like to talk about the principles, rationale, and how it is being cast in the current legislation. The background is that it is clearly stated in law. Unlike some other jurisdictions, the MPF investment regime is clearly stipulated in the law. We call it a whitelisting approach because the permissible asset classes, permissible investment practices are all stated in the law. Failing which will be impermissible, prohibited practices, and therefore compliance is very clear cut in this sense. So in the regime actually seeks to strike a balance between investment flexibility to drive performance on the one hand, and on the other hand, we also want to make sure that there is a safeguard against excessive risk-taking because to protect the interests of scheme members. Legislation is the core part, and we have the MPFA has issued guidelines and codes to investment managers for guidance, and so that also achieve both certainty as well as flexibility. And then trustees are the fiduciaries. They are under statutory fiduciary duties to act in members' best interest, and then they delegate the investment functions to investment managers so that the two together will have checks and balances, and then we have the MPF investment framework for them to give them guidance and rules. So it is very, it has been working well, I must say. The regime actually makes reference to the prevailing good practices in the fund management industry. So industry driven, but we modify it and look at it and adopt it in the legislation. And we also make reference and closely collaborate with the Securities and Fund Management Regulator in Hong Kong, the Securities and Futures Commission. So we also make reference to their relevant codes in product approval and supervision. Moving on to the next slide, I give you a flavor about the how the MPF schemes and funds is structured in Hong Kong. We basically, because we have trustees as fiduciary, so it's a trust system. We follow the English common law system. So trustees as a key player, and we are subject to fiduciary duties. And then they offer schemes so that employers would choose the scheme for their employees. And then employees, as I said at the outset, they will be entitled to choose their own funds. So they can choose from the constituent funds under each scheme. So each scheme normally have 15 to 30 kind of fund choices for them to choose from, with a mix of different types of fund types. This figure is, this chart is going to give you a flavor that we allow both active and passive strategy, and we also encourage flexibility for trustees and IMs to come up with products and fund options which can suit the needs of their own members. So there is quite some variations across different schemes. The next slide is about the general MPF investment requirements. I think these are pretty 101 for those in the fund management industry, because as I said, we are trying to adopt the best practices in fund industry, as well as making reference to the retail fund regulation from the SFC in Hong Kong. So anything you can think of, including spread of investments, I mean, to avoid concentration into one or two issuers, borrowing and lending of securities, borrowing of money will be subject to stringent regulation and highly restrictive, and only if the statutory conditions are met. And then securities and derivatives, we try to ensure that they can usually invest in listed equities or investment grade debts. For other types of securities, especially for financial derivatives, then we will be very, very cautious and make sure that they are only allowed for hedging purposes. And then on the right-hand side, we have also some bank deposits and currency exposure requirements. For currency exposure requirements, because we are a local system serving local population, so we have a special requirement that there should be 30% Hong Kong dollar currency exposure, which because to meet the redemption needs and also the needs of the retirees. So moving on, we have some factors to consider when we refine the investment regulation regime. In my current role, me and my team have always been have our doors being knocked on, because many investment managers or other people in the industry, other stakeholders come to us saying that they want new products or ways to drive better returns. So our approach is that our ultimate objective, we always call to mind, is that we have to enhance the interests of scheme members as well as to protect them from excessive risk-taking. And we will, of course, embrace an open mind towards refinement opportunities, and as well as we are being guided by the need to put scheme members' interests first, and balancing things like risk control, have an appropriate risk level, and also make sure that they can diversify the risk and address liquidity concerns in assessing new kind of proposals. We will, of course, also maintain open dialogue with the industry and other stakeholders as we proceed. I think I would like to move on to spend some time to talk about DIS. Echoing Brian's points about target date funds and life cycle investment strategy, this is a very important policy reform, and it's quite popular in Hong Kong as well as very well received in the international pension community, because it is basically driven by a concern that we need to help scheme members, most of which are not very familiar with pension investment, or they may be they don't know what to do, or they may have no time to do it, and then we want to put forward a life cycle investing approach for them to consider, so that they can have a hassle-free and one-stop shop kind of approach to their pension investment. The policy framework on the next slide summarizes the life cycle approach. Next slide, please. On the top, it is a life cycle strategy. That means that we will. It is an age-based kind of approach, so that as the scheme member progresses, then there will be an automatic de-risking feature at the age of 50. And then up to age 65, which is the official retirement age in the MPF system, where they can legally withdraw their MPF contributions. And so when they enter the workforce, enroll in MPF scheme towards age 50 and then towards age 65, there are different points in time that there will be the automatic de-risking will kick in. And then there is opt-out arrangement, because it is stated in the law that unless there is any express and specific investment instruction, a scheme member will have all his retirement benefits invested according to DIS. So this is an opt-out arrangement. Of course, the scheme member can choose not to join, but he or she has to give a specific instruction. There will also is choose to allow them to choose there are also two fund options for them to choose from under DIS. So one is the equity component, the mixed asset fund CAF, and the other is also a mixed asset fund, but with a heavier bond component, which is the age 65 plus fund. Moving on to the next slide, the major features of the DIS will include, there are three folds. First is globally diversified investments. So there are two constituent funds, one with a high equity component and the other with a higher bond component. Both are globally diversified, so they look to the global market to find suitable investments. Automatic de-risking mechanism, as I said, at age 50, the automatic de-risking feature will kick in up to age 65. The trick is that the investment will adjust between CAF and the age 65 plus fund. On the right-hand side, there is also a very important feature of DIS, which is fee cap. Under the law, the management fee and other out-of-pocket expenses are being kept at the statutory level. And so all of the funds, no matter which scheme, which trustee is offering DIS, they have to conform and comply with this. Currently, the level for management fee is 0.95%, and the out-of-pocket expenses for all other expenses is 0.85. And we are committed to ongoing review these two items, and we will commit to drive them down continually. The DIS actually performing quite well. The next slide will show that out of every 10 MPF accounts, 3 are investing in DIS. The next slide, please. And then for the annualized return is actually quite good, especially for CAF, the core accumulation fund, which has a higher equity component. Past 1 year is 11 double-digit growth, and for since launch in 2017, the rate of return is also 6.2. So it's quite impressive, and we are also actively promoting to our scheme members, hoping that they will be come to be aware of the benefits and potential of this
Paul, please, can you please conclude now?
Okay, sure. Yeah. Okay,
I'll
just say one thing is on the EMPF platform, which is that we will the EMPF platform is to centralize. Is another major policy initiative. Is also to centralize, automate, and streamline our existing scheme processes. It will pave way for other policy reforms, and also help us to continue to reform the DIS. So I hope this will give everyone a flavor on the MPF system. And then I'm happy to take any questions about the DIS and also other initiatives. Thank you very much.
Thank you, Paul. Maybe quickly I'll get back to Brian. Brian, are you there? Yes, I can see you. So Brian, couple of follow-up questions. Given that the TDFs were originally designed for markets with well-developed capital structure, and in India we lack that in many ways. How do you think that we can adopt these TDF principles for Indian market? Number one, and number two, if you can help us understand, the typical creative local investment instrument that you kind of touched upon in the case of Mexico can be used in Indian context. And the third one, TDF all along has been a strategic asset allocation, which is the central to TDF. And in India, there is a significant bias towards domestic fixed income. So how would you suggest balancing the home country bias with the need for global diversification? Thank you.
Yeah, thanks so much for the questions. So I'll cover each of those through my comments here and try to keep it relatively tight. Overall, certainly agree. I think target dates originally were designed certainly for markets with deep liquid capital markets. That being said, I certainly think they can be adapted to meet specific market circumstances, and we've seen that in a number of markets. You mentioned Mexico specifically, so I can certainly provide some examples there. I think, again, we've seen some great success. We've worked with a number of the plans down there to try to implement this. They currently have a limit on the number of non-Mexican securities that can be included within the overall target date setup. So we did have to somewhat rethink exactly how we were setting up the various target date portfolios that we were building. Couple things that I would say in terms of adapting some of those best practices. The first is just around thinking about the glide path, right? The key piece that underlies the target date. And that's really, I think, just thinking about local investor circumstances and characteristics, right? You want to make sure that you're thinking about what's the right replacement ratio for income for local Indian investors. Thinking about what the overall preferences look like, what you're able to invest in, so you can build some additional comfort, I think, with investors as well. Also, just understanding a little bit better what the risk appetite looks like for investors generally, right? Both the replacement ratio and the risk appetite, those are going to be two big drivers of what the ultimate slope and design of the glide path will looks like. So certainly areas where I think you want to bring in local characteristics rather than kind of using broad market characteristics. The other key piece, and I think this ties into a couple of the questions, you saw in the presentation, again, I'd say at the highest level, we tend to favor diversification across asset classes and from a global standpoint, and we think that that does tend to reduce market volatility. But at the same time, we very much know that that's not necessarily realistic to think that that will happen day one. So we very much think it's a gradual approach, thinking about what do many investors locally hold today and how can you expand out that opportunity set. So maybe moving into things like real estate investment trust or infrastructure trusts or local inflation-linked bonds as a way to kind of diversify the broader set of investments. And that's a lot of what we've seen in the Mexican market, right? Is, where there's the cap on sort of 30% of non-Mexican securities. Within the Mexican securities bucket, we've seen a general push towards other investment types within the countries. Certainly inflation-linked Mexican bonds, local real estate, we've seen some private investments that have been included there. So again, it's a way that you can gradually push towards greater diversification, but starting with a bit of a domestic flavor as well. And then the last piece that I would just mention here is just thinking about best practices from a qualitative and practical standpoint, right? We certainly see that emphasizing simplicity has certainly been helpful, right? Again, Paul mentioned and I mentioned in my comments that these tend to be less engaged investors, maybe a little bit less investment savvy. So to the extent that they can feel comfortable with their investments and embrace some of that simplicity, we find that helps with adoption. Same with having low costs, right? That means you can keep more of your investment returns. And then just on the education front, making sure that there's awareness, understanding of what these investments are meant to do, what the benefits and risks are. I think that also goes a long way in helping to encourage both participation as well as better outcomes at the end of the day.
Thank you.
Thank you, Brian. Thanks for those insights. Let me try and bring in Paul back into the conversation. And Paul, that was a great presentation. Thanks for sharing your insights from Hong Kong. One question which is pertinent in current times, like how do you deal with volatility? And at times there are investor losses. What is your stance on that, and how does Hong Kong deal with it? And is there any message to the Indian authorities that you would like to share when there are a lot of people entering the market-linked pension plans for the first time in their lives? How do they counter these sort of investor losses, perceptions, and concerns? Over to you.
Okay. Thank you for the question. I must highlight that MPF system, because it's a mandatory system. So the one feature is that the members' contributions cannot be redeemed or withdrawn until they reach the retirement age of 65. So for the members who are staying during the accumulation stage, we have been issuing reminders to them that saying that it is a long-term investment, spanning over 40 years. And so it is inevitable that during that very long investment journey, there will be economic cycles and market fluctuations. And then we also emphasize the importance of dollar cost averaging, because the contribution is done on a monthly basis. So which means that at low times, the scheme member can actually subscribe more fund units at a lower price. And then we also introduce the default investment strategy, DIS, which, as I said, is a life cycle approach to investment. So there will be a way to weather the to also counter the different investment cycles, and also be a hassle-free kind of investment kind of solution to scheme members over the long term. Of course, there will be ups and downs, but you keep reminding the scheme members that they should not be over worried about the short-term fluctuations. And then the mandatory retirement age with the withdrawal gateway is also, as I said, another checkpoint, so that their behavior will be quite different from the retail investors.
Thank you, Paul. Mark, you have been patiently waiting. Would be great to have your, insights. For those who don't know Mark has been, doing research in various jurisdictions across the globe. And as a pension fund expert, I think it'd be good to get your insights on two fronts, Mark. One on the regulation, and somewhat related, the diversification angle. When you compare India's regulatory environment with other countries, what sort of differences you see, especially when it comes to giving that flexibility to the fund managers, or having some sort of limits for different segments of investment? So if you can share your experience on this aspect, it would be very helpful.
No, happy to, and great to join the conference. Thanks. So regulation, I have been working across client countries all over the world now as a practitioner at the World Bank, but also many years ago I used to run the pension plans across a number of subsidiary companies for a major US multinational. So I had direct experience working with the subsidiaries in India and helping them, guiding them with investment practices for their funds. And what I found both then and more recently, as I think about the Indian kind of regulatory situation, is it's very strict. I would suggest needs to be loosened, and there needs to be more latitude. As Paul noted just a second ago, investment in pension assets should be thought about as something that's going to last a long time. And so a focus, an over focus on short-term volatility is not healthy, because by definition, these investments can be patient. These investments can be for the long term. That's another reason why I do like the example of the target date approach, because it sort of makes it clear to the participant. Most of them are willing to let someone else kind of design these solutions for them. And the experience in a number of geographies is these target date solutions are sticky. And investors who have the right to choose, like to move their money around among a menu of choices, typically don't when they're in a target date type instrument. So these default instruments, these target date instruments, I like them because they're sticky and they can allow the investments to be for the long term. But again, it needs to be in the framework of a relatively more flexible investment regulation, and trying to keep pension investments only in the very highest grade credit and largely out of equity and private equity and real estate type instruments like REITs. Those are needed. I mean, not to mention the global diversifications that's needed. I like the way Brian said that doing it gradually is always the best way, beginning with a little bit and over time, as the system is ready, gradually liberalizing. The benefit, of course, is diversification. Tushar, as you noted for the second point, I mean, Brian as well shared, just strategic asset allocation is so critical for a pension system to thrive. Doing that well, the SAA. And so to the degree that can incorporate for the young participants, growth assets that are gonna get the benefit of illiquidity and get the benefit of investing in the parts of the economy that are going to be the most helpful over time vis-a-vis inflation. That is the critical need. So there's a number of things I've tried to throw in there, but hopefully it's been helpful.
No, thank you. Certainly helpful. But just to build on to that point of diversification a bit more, in your experience, interacting with other countries, how have they managed to use, for example, some of the innovative instruments to diversify and go beyond the safe haven assets, so to say? And somewhat related question when it comes to diversification, India's needs in some of the specific sectors are quite huge. Take the case of infrastructure sector, for example. And India needs a lot of funding going into especially the patient capital going into the infrastructure sector. And pensions, the pension funds are one of those important sources of that patient capital. So one, how do you use such innovative instruments to diversify and specifically to meet needs of sectors like infrastructure? If you can throw some light on that aspect, please.
Yeah, so two things. First, the example of Mexico that Brian has already talked about is such a good one for the situation in India. I would suggest, One, because they've been very creative with bringing, there's a great chart out in the public domain where you can see how Mexico has moved its pension system from almost entirely government bonds back in the late 90s to a much more diverse system that now has a little bit of global diversification. It has all of these new and innovative infrastructure type investment instruments. They began, I think, with, I'm not going to get all the acronyms right, but they called it a CKD instrument. They improved upon that. They have these FIBRAs. They have now what are called CERPs, which is kind of an new and improved version of the CKDs. But they've been very intentional, the regulator, CONSAR in Mexico, with working with industry to create these new instruments that can be then vehicles for infrastructure investment. Another example is Namibia, so a different part of the world, where they have had historically quite a bit of pension assets vis-a-vis the size of their economy. So they've been forever kind of trying to figure out what to do constructively with all of those assets. And they actually had a new kind of segment created, SPV, special purpose vehicle type trust, where infrastructure was the aim of these SPVs. And they made sure that there were independent managers that were appointed to oversee these SPVs. But the SPVs ended up, the pension funds ended up being required to invest 1.75%. So very small, so not in such a manner that it's going to greatly skew the ability of the pension fund trustees to still kind of make sure that their beneficiaries are being taken care of, but still enough that there were new investments that were supported by these SPVs that were created, again, in the case of Namibia. So, I mean, there's a lot of things that can be done. Mexico, again, is a great example because they've gone to the target dates, which again can be these sticky type instruments, but many ideas out there, and happy to share further.
Thank you, Paul. Mark, just to leave some time in the end for a Q&A with the audience, we'll move on and then we might come back to both of you. Thank you.
Yeah, maybe moving on to the panelists on the dais. I'll start with Bill. And maybe, many of you may not be knowing that Bill is the author of the book, Saving the Next Billion from Old Age Poverty. It's a very, I think, nice book. I think maybe must read for many of us. And Bill, I think taking a clue from your work, and if I can ask, India is both a significant home as well as host country for migrant workers. In the morning panel, you did touch upon some of those issues, but such workers often have shorter time horizon than traditional assumed for life cycle based funds. What adjustments would you suggest to try to manage different horizons while still providing access to decent returns?
No, thanks very much. First, let me say I was a co-editor or co-contributing editor of the book, partly because Parul, who was one of the others, is in the audience, so I want to make sure I give her due credit. But so mentioning migrant workers may seem to be a bit of a tangent or left field, but to explain why, the world has 281 million migrants and their families abroad. And they remit about $1 trillion a year, and they support about 800 million family members. So they're their own kind of portable pension system for some of the people back at home. But they also are working and having a labor market experience outside of their home country, which in an ideal world should be contributing to their pensions journey, but often isn't. And migrants are almost never thought of in these pension discussions, and in some countries it's irrelevant, but a country like India, who do have obviously a lot of non-resident Indians overseas in different host countries, but also a host country themselves from Nepal and other countries, it's worth thinking through all of the things which we just heard on target date funds, which I completely agree with, and Mark's point as well, that almost there are lots of countries where there's a focus on short-term volatility and controlling that short-term volatility, and that's the enemy of the long-term returns. I completely agree with all of that as well. The question then is, if you have a migrant worker population who may only be with you for 5 years, you probably do have to have an exception. And then you are thinking through some of the short-term volatility, you can't necessarily exploit those long-term illiquid assets if, and it's a big if you let the migrants take the money out when they go back. And there's no reason why you should do this. So the United Arab Emirates have set up a mandatory DC scheme for migrants now. It's a great innovation, but as people leave, they're allowed to take the money out as a cash lump sum. And in that case, you have to make sure your investment rules are kind of consistent with your withdrawal rule. In an ideal world, though, all of those Indian workers or Sri Lankan workers who are now in the UAE, for the first time are getting access to put their pension money, pension savings into something with the hard currency, because there's a currency linked to the dollar. And in an ideal world, you'd have that money sort of operating to give extra diversification to their NPS account, and you would hardwire the data and the ID in a way which is possible so that the money is there in the UAE account, and then at some point it just connects back into the NPS system automatically. So you don't lose all that hard-won pension savings, but you just realize that there may be a kind of twin track for those investment strategies. So that was just, in some ways, just to raise that issue, because I think it is a material one for India. And if you think, there's been lots of innovation in India, so the non-resident Indians can contribute back into their NPS account, so as can as OCI, as overseas citizen of India. My guess is it's not very popular, because if I'm abroad and I can invest in a diversified pension plan, I probably don't want to put my money back into the NPS as it's currently constituted. If you had more flexibility in the NPS and you allowed maybe either a hybrid model or someone who had a diversified strategy like we heard from Brian and Mark, allowed that to be transferred in, I think you may have much more success in connecting this whole life cycle of a worker where they could be in the village, they could be in the town, they could be formal, they could be informal, it could be India, it could be the Gulf. Lots of different bits of their labour market history to stitch together. And if you can be flexible about the rules and the investment, this is the migrant part of their journey, maybe one extra thing you could add to strengthen the system.
Thank you very much. I think that was very nicely articulated. I think a lot to learn from what you said for NPS. We could definitely see that. Going to Prachi, you have been in the policy front at Reserve Bank and the IMF, particularly on monetary policy or transmission issues, and you have seen how global geopolitical scenario has been changing. Early morning when we got up, we started seeing hundreds of pleasantries in terms of reciprocal tariffs on countries. And given that your research, how do the changes in monetary policy, such as interest rate changes or interest rate adjustment by the central banks, would impact the investment strategies and risk profiles for pension funds?
Thank you, Abhiman, and let me start by thanking PFRDA and IMA for the invitation. It's really, I'm not a pension expert. I have a lot to learn from this panel. It's been really fascinating. On your question, I think, let me just say that, my understanding is that Indian pension funds, and correct me if I'm wrong, are very heavy in domestic fixed income, but they are allowed to invest in foreign assets. And, I think my cash, no. Through international mutual funds, no. It's zero. Okay. So that, I think then it insulates us a little bit, in a sense. Let me step back and say, the global scenario, as you pointed out, uncertainty is at, historical highs. So policy uncertainty, everything, even though we know reciprocal tariffs were announced, I can tell you at least 5 to 10 elements of uncertainty. Number one, Mexico and Canada are out. Number two, the energy is out. There are a number of areas where tariffs have already been placed, like autos, critical minerals. They are not included this time. And another very interesting thing is that the tariff is excluding the domestic content of U.S. imports. So another element of uncertainty is that on April 5th, the 10% is going to be implemented. But beyond that, there's going to be another date, I think April 9th, when the rest of it is implemented. There's a lot of scope for negotiations. So bottom line, I think we live in a world of uncertainty. To the extent currently our pension funds are not, do not have exposure to foreign assets, any changes in, say, global rates or, any changes in the global prospects may not directly have an impact, but I think that can change, from what a lot has been said, in the event we were to diversify and ease our regulations, that can change. But to the extent any changes in the global economy or the uncertainty we are seeing now affects our domestic economy and therefore our domestic rates, that is going to have an effect on Indian pension funds for sure. And how do we think about it? I think we have to distinguish between, again, I'm just trying to reason out basic Econ 101, we have to distinguish between existing assets and new assets. So for example, if India is in a rate cutting cycle, if interest rates are expected to go down, that's positive. Bond prices rise, bond valuations rise for existing assets. However, for new assets, I think it means lower returns for the investors. And again, I think we need to take into account the duration risk as well. Typically, pension funds tend to be, because of the very nature, long liability. So the assets are also long duration. So meaning that any changes in interest rates or any changes in monetary policy, which feeds into interest rate through the interest rate channel of transmission, can have, multiplier effects. So I think the implications of both the global backdrop, which may not affect Indian pension funds directly currently, which might change in the future, but to the extent that they change the domestic outlook and domestic interest rates, I think that is going to have a significant impact on Indian pension funds. Let me stop here.
Thank you, Prachi. I would just take the liberty of giving one more last word to you and ask you one question. Since you said you're not a pension expert, it would be good to hear like an independent, viewpoint from your side. You heard everyone. What are you really drawing from this conversation? Any 2-3 key takeaways that you can share with everyone, and then we can go to the audience.
First of all, thank you, Tushar. I learned a lot. I think, whenever I'm thinking about pension funds, and I always, one statistics which always comes to my mind is 90% of jobs, at least 90% of jobs in India are informal. And the big struggle for us in terms of policy is to get more and more people into, how many people in this room have the domestic help or drivers into the pension system? I bet, almost no one. So I think that is the biggest challenge, and I think this discussion of target dated funds and all is quite fascinating, and I really like the idea in theory, but in practice, given the level of financial literacy, given the level of informality in the economy, I don't know how practical it is to think about the applicability in our context, but more about scaling up. I think that is, my bottom line. Let me stop here.
Thank you. We understand we are overshooting the time, but if we can just take 2 minutes and ask from the audience if there is any question, I think our panelists would be very happy to take it. Maybe just max 1 or 2 questions. Yes, please.
Well, my name is Ahmed Laun from Nigeria. Well, I wanted to address, not a question, but I wanted to address one of the questions that Professor Abimam asked about how do we now, Indian, learn from implementation in terms of diversification. I think in Nigeria, we started with 2 funds, but with time, we are able to add 6 funds to it, looking at risk appetite, then age, but recently we have added even 2 funds where you have a micro pension because we wanted to have an informal sector. So we now have a designated fund for informal sector organization because of their nature. In addition, we now have an ethical fund just to give people choices. So I think even though we don't have any foreign direct investment, but within the economy, we are able to diversify these portfolios and allow individuals to have 1, choices, 2, for us to push this asset to certain strategic key areas. Thank you.
Thank you. Anyone else? Any question or any remark?
Yes, sir. My question is directed to Paul. In one of his slides, particularly slide number 9, he was mentioning one thing in that last 10 years, the annualized returns of equity, even in fact bonds, it has generated 0.9 negative, -1 actually negative returns. And if I would see that equity returns for last 10 years is 4%, but that is basically the effective outcome of the last year. The 10-year, the current annualized is 23 or 22%. And because of that, return is coming to 4%. In such difficult time with such a low return, how are you managing that mandatory provident fund?
Paul, I hope you were able to hear the question.
Yes, thank you for the question. I think we have been emphasizing, as I just answered earlier, one question, is that we have been emphasizing it's a very long-term investment horizon. This is first thing. Secondly, similar to the Indian experience about investing exclusively in debt instruments, we have been emphasizing to scheme members not to review the investment portfolio from time to time, and also to diversify the portfolio, and also to make changes to the investment strategy and investment choice periodically. And that's why I think, of course, if you look at a particular fund type, then given the economic cycle and market fluctuations, then a bond fund could be not quite performing in the past few years. But if you look at the broader perspective, longer investment horizon, plus the need to change and review the investment portfolio of individual members, I think that will make better sense from a broader perspective. Hope it makes sense. Thank you.
Thank you, Paul. I think thanks all the panelists, and a big round of applause to all the panelists. Thank you.
Sharing your valuable insights today. Your expertise and thoughtful contributions have sparked great discussion and provided us all with a deeper understanding of the topic. To felicitate our panelists, I would like to invite Shri Ashish Bharti, CGM PFRDA, to please present a token of appreciation to Professor Abhiman Das. Further, I would call upon Dr. Purnima Sharma, GM PFRDA, to present a token of appreciation to Mr. William Price. Also, I would invite Ms. Manju Bhalla, GM PFRDA, to present a token of appreciation to Mr. Tushar Arora. Please, ma'am. Group photo, please. we will deliver the memento to Professor Prachi Mishra shortly after the conference. We also extend warm gratitude to our panelists who have joined virtually. We truly appreciate your time and expertise. Thanks a lot for being a part of today's discussion.
Many thanks.
Ladies and gentlemen, we will now be having a short tea break. The break will last for 30 minutes and we shall assemble back at 3:45 p.m. for the next session. Enjoy your break, please. Thank you. For dignitaries and VVIPs, we are having the tea break at MR19 and for others at pre-function area at level 1. Request everyone to please settle down. Kindly keep your mobile phones on silent mode. Welcome back for having another session of panel discussion on a very relevant topic, Pension Forum for Regulatory Coordination and Development of Pension Products. Ensuring financial security in retirement is a fundamental component of safeguarding income and providing stability for individuals in their later years. As global populations age and life expectancies rise, the imperative for effective pension systems has never been more pressing. These systems are essential not only for old age income security and consumption smoothing, but also for mitigating longevity risk, especially in the era where old age dependency ratios are increasing globally. In order to have discussion on the same, let me have the pleasure of inviting Dr. M.S. Sahu, former chairperson, IBBI, as a moderator on the stage. Please, sir. Sir, with 4 decades of experience in economic reforms, financial markets, and policy making, Sir has held impactful roles, including Distinguished Professor at National Law University, Delhi, Chairperson of IBBI, Member of CCI, Secretary of the Institute of Companies Secretaries of India, whole-time member of SEBI, and Economic Advisor at the National Stock Exchange. We welcome you as a moderator, sir. Now, I would invite our esteemed panelist, Mr. Pankaj Sharma, Joint Secretary DFS. Sir is an engineering graduate from IIT Kanpur and has completed a master's in public administration from National University of Singapore. Sir has nearly 2 decades of experience in civil services with extensive expertise in fiscal policy, financial reporting, internal control and audit, and information systems. Welcome to the panel, sir. I would also like to invite on stage Mr. Ramesh Krishnamurthy, CEO EPFO, as a panelist. Yes. Sir is a 1992 batch Indian Revenue Service officer. Sir's research areas focused on supply chain management, e-commerce, industrial distribution, and ERP. Before assuming the charge of Central PF Commissioner, he was holding the charge of Additional Secretary, Minister of Labor and Employment. Sir, thanks a lot for joining us today. I am also pleased to welcome Mr. Amarjeet Singh, whole-time member SEBI, who has joined us virtually and will be our valuable panelist. Sir has nearly 3 decades of experience in regulation and supervision of security markets. Prior to this, Sir served as ED at SEBI, leading key departments such as market regulation, corporate finance, international affairs, and investment management. Sir, thanks a lot for joining us virtually. I would now like to invite Mr. Rajay Kumar Sinha, whole-time member IRDAI, as the panelist of the session. With 33 years of experience in banking and finance, he brings extensive expertise in investment banking, treasury operations, and financial management. Welcome to the panel, sir. Last but not the least, let me have the pleasure of inviting Dr. Manoj Anand, whole-time member finance, PFRDA. Sir assumed the charge of whole-time member finance at PFRDA on October 2020. With over 3.5 decades of experience in academia, research, consulting, and administration, he has made significant contributions to financial policy and regulation. Welcome to the panel, sir. I warmly welcome you all on the stage, and over to you for the next panel discussion, sir. Thank you.
Good afternoon, ladies and gentlemen. Welcome to the panel discussion on Pension Forum for Regulatory Coordination and Development of Pension Products. This has genesis in the last budget announcement. This session will try to explore the broad contours of the forum, what it should look like, its role, key constituents, and how it can importantly enhance the adequacy and sustainability of post-retirement income. And this is important given the changing market environment that we discussed in the last two sessions and the changing demographics. This discussion is very timely and crucial. To me, at its core, the forum has a genesis in a fundamental reality that the regulators and agencies having some kind of association with the pension products and services, they operate within the legally defined boundaries. While the pension products, services, suppliers, and beneficiaries, they do not neatly align with the boundaries of these agencies. If you consider the NPS or UPS, the basic product has come from the government. Both employers and employees contribute. Pension fund accumulation happens under the oversight of a PFRDA. Pension funds are invested in markets regulated by RBI and SEBI because securities are issued and traded under their oversight. Issuers, the insurers, they issue annuities under the oversight of IRDAI. They invest annuity funds under the oversight of SEBI or RBI. And possibly as we allow the pension funds to invest in a variety of products even beyond financial instruments, or as we allow the investments in foreign jurisdictions, the domestic and foreign regulators will have multiple regulatory jurisdictions. Additionally, we have a host of service providers who operate under jurisdictions of different regulators like the CRA, the Central Record Keeping Agencies. If someone is investing in debentures, the debenture trustee is regulated by another agency. But most important of them are the people who are the investment advisors or distributors of financial products. They operate across all these jurisdictions. But generally, the regulators have a tendency, and they think so for valid reasons, that they want to keep themselves in an isolated environment, in the sense they do not want the entities regulated by them undertake the activities which are supervised by another regulator. So thus the business landscape comprising products, beneficiaries, suppliers, all service providers, they do not recognize these regulatory silos as clearly as regulators would like. And often the regulators themselves, they do not know their boundaries strictly. There are gray areas. Sometimes these have required judicial or parliamentary interventions. All of you are familiar with the striking example of 2010 dispute between IRDAI and SEBI over the unit-linked insurance plan. While SEBI asserted that the product had some investment component, the IRDAI asserted that it has an insurance component. The conflict escalated to Parliament, resolved by a legislation, and while moving the bill, the then Finance Minister stated in the Parliament that the regulators are fighting like petulant children. So in such an environment, the real loser is the pensioner, who understands very little about these jurisdictions. And this really calls for a coordinated regulation and a more holistic approach to pension market development. With this, let's begin our discussion. We are privileged to have a panel of distinguished experts, each excelling in their respective fields. Their CVs have been read out, but more important is that they represent the key institutions namely the DFS, EPFO, SEBI, IRDI, PFRDA, all of which play a crucial role directly or indirectly in shaping the pension landscape and deliver pension-related services. And as for me, I am the odd man out. I am probably the only pensioner sitting here, but with several concerns. We have about 80 minutes for this session. In the past 60 minutes, I will engage our panelists with the concerns I have as a pensioner, inviting them to share their insights and perspectives. The remaining 20 minutes will be open to questions from the audience. So I have specific questions for each of the panelists, but before I get there, I would like to pose two questions which are common to all the panelists. In the interest of time, I will ask both the questions together, and I will request the panelists to respond to both the questions in about 4 to 5 minutes. My first question is, all along we have been talking about universal pension, pension for everyone, 100% coverage, got the examples of Scandinavian countries where the pension corpus is 200+% of GDP. Today we have coverage of about 5% and the corpus is about 50 lakh. Just by assuming that by magic we are able to reach the standards the Netherlands has or Iceland has. So with the current GDP, if I'm not looking at the GDP 2 decades hence or 2047, the current GDP is nearly 5 trillion, and if I assume 200% of that, or if I just say that 5% population having a 50 lakh corpus, 50 lakh corpus, so over 2 decades I see that at least we need investment opportunities to invest about 1,000 lakh crore, nearly $2 trillion. Our capital market capitalization is probably half of that. Mutual fund corpus is about 60-70 lakh crore. And you know how much of net government securities are issued in the country. So where would we think that such a huge sum, if we are driving on the one hand, everyone should come here, and the corpus will keep on increasing, where do we put this amount that we can get adequate returns, sustainable returns? Otherwise, this will be the binding constraint on our dream of achieving 100% pension. So the first question to the panelists will be, how can we expand investment avenues to ensure adequate and sustainable pension for all? So my second question is that comes directly from this session. Pension regulation involves multiple regulators, as I just discussed, each with their own set of rules, priorities, and in fact, different sets of principles they follow in relation to their markets and products. And we have seen the overlapping regulations, but the different principles, they distort the market level playing field, create inefficiencies, uncertainty for market participant. And that is the reason why we need a structured forum for regulatory cooperation so that we can address the redundancies, resolve conflicts, promote regulatory consistency, and have a more cohesive and a predictable framework for all. So my second question to the panelists is, what are your thoughts on the design and structure of such a forum? How do you envision its role, composition, functioning, and what are the key challenges you envisage in achieving effective regulatory coordination in pension sectors? So I request we start from the left, extreme left, from Mr. Krishnamurthy. These are the two questions and common to all the participants. You have 4 to 5 minutes to respond to both the questions.
Good afternoon, everyone. And both questions are extremely interesting and also very challenging. So, I mean, today I represent EPFO, and we have a corpus of close to 27 lakh crore. Every year, if you look at our accretions, we get close to about 3.5 lakh crore every year, as both towards provident fund and pension funds. Now, given the pattern of investment prescribed by MOF and our own conservative, I would say, approach to investing, we have very limited avenues for investment. So if I have to take this question from the moderator, MS Sahuji is a very eminent, I would say, personality who has been in various distinguished positions. And this question, I think he may probably at the end may be able to summarize better than anyone else. But I would say that then we have to start thinking out of the box. It can't be routine investment in the standard government borrowings, in debt securities. Obviously, our percentage of investment in equity has to go up. There is no doubt in that. But then if you look at the entire horizon of available investments, even in the stock market, I think there is a huge concentration, if not in just the top 50, but even if you expand it to the top 200, these are the only companies which probably today are able to attract investment without being worried about, either liquidity risk or concentration risk or any other kind of risk. So that is the first challenge. The challenge itself for the capital market is to expand its scope and make sure that you have more and more companies with solid fundamentals which enter the market. So, of course, there is very little that the capital market regulator themselves can do. This is a function of the economy. And as was pointed out, we are very close to becoming a $5 trillion economy. So the first prerequisite, obviously, is linked to our economic growth and our growth pattern. So as the economy grows, avenues for investment, a desire for funds will also increase. So that is a natural source for our investments. The second is, as you have seen, government has been committing about close to 10 to 11 lakh crore of investment in infrastructure. And obviously, the large part of that has to get funneled through long-term funds. And pension funds are typically by nature long-term funds. So I think we have a good opportunity in investing in infrastructure projects. And also, when I talk about thinking out of the box, then as is true for any of the Scandinavian or Norwegian companies or countries, when they start looking out not only within their own country, but also emerging markets across the entire world. Similarly, India also will have to start looking out for other opportunities in other markets, and that may include Africa, may include Southeast Asia. So, I mean, these are, I would think in the long term, these are the channels of investment that almost all pension funds will have to think of. The second question was relating to the multiplicity of regulators, the challenges that all the players in this sector encounter. I would broadly classify them under two categories. One, which is something like EPFO, where there is a clear legal mandate, and as a part of the social security ecosystem, EPFO is in prime position because it is mandated by law to make sure that each and every, at least as of now, the formal sector worker has adequate social security coverage. But if you look at the legislation that has come up, which is the Code on Social Security 2020, which has been enacted but yet to be notified, the scope has increased quite a lot. It also envisages the coverage of informal or unorganized sector labor, as well as gig and platform workers. So now if you take these two category of workers in addition to the formal sector, now you're talking about universal coverage. And so EPFO has been as a part of the Code on Social Security and as a part of the existing EPF Act 1952, has a legislative mandate. So this is the strongest, I would say, point in its favor, that probably from a commitment from a regulatory perspective, there is a mandate given for Social Security. That is number one. The second category of regulators are all pure play regulators. So EPFO is not only a regulator, it also regulates some of the exempt entities, but it is also managing the Social Security Fund on its own. Other regulators like IRDA or PFRDA are pure play regulators. They don't manage anything. Of course, PFRDA through NPS has a, I would say, an operational role as well. But I believe there is quite a, I would say, some amount of separation between the two. So there is a need, and the need that is coming up is not only in terms of increasing the awareness, increasing the coverage, getting everyone to participate in a pension product is extremely difficult. In India, where most of the citizens prefer cash in hand rather than worry about 20 years later, I think the problem is much more in terms of creating the awareness for pension products, number one. And I think the forum should ideally start from making sure that each and every Indian citizen is broadly aware of his rights, his responsibilities, and his awareness towards investing in securing his own social security. One of the problem areas that we face in EPFO is that as we make access to funds easier, there is a higher tendency for people to withdraw their savings money instead of keeping it over the long term. So when people finally get to their retirement stage, then they find out that they don't have adequate coverage. So that is one of the challenges that we are facing, and I think common regulation, common understanding in these areas, as well as I would say an understanding of the pattern of investment, probably in terms of its, while it is, I would say that by and large almost all between PFRDA and EPFO, we're broadly in sync with the pattern of investment. But there may be some minor variations, and I think to avoid any confusion, there may be convergence as far as investment opportunities are concerned. I think that will also help. And as I said, the starting point for convergence would be always starting from the citizen. And I think increasing the awareness, making sure that every citizen knows that social security is important, I think can be the first step. Thank you.
Thanks, sir. So, now representing government, I will very quickly make broad 3 points. The first point tries to address the question raised by Professor Sahu regarding the asset size becoming 1,000 lakh crore, 100,000 lakh crore for the pension sector as a whole. Now, today as we speak, of course, Government of India has a vision of creating a pension society by 2047. Now, which would very broadly imply that we have around 40 to 50 crore separate pension accounts. Now, where we stand today are at around 15 crore separate pension accounts with duplications, as a matter of fact. And total pension asset size, if I also include EPFO, LIC, PFRDA, which is the NPS, and the other SEBI, etc., would be approximately 60 lakh crore. So, as we speak, we are speaking of around 15 to 16% of our GDP as pension assets. And just a pure mental maths is we are today at around 4.5 trillion USD in terms of the GDP size. We of course have visions of achieving a GDP size of approximately 30 trillion in approximately 2 to 2.5 decades. Now, if this were to happen, so it would mean that our pension assets from 60 lakh crore go up to around 1,000 lakh crore. It would mean that our pension assets become approximately 17 times, while our GDP becomes 7.5 times. a small maths would show that it would mean that our GDP in our pension assets as a percentage of GDP will be approximately 30%. And I think it is doable. I think it is doable. And as a matter of fact, it is a target which would be still underwhelming. So point number one, that as we speak today in 2047, 30% of our pension assets as a ratio of GDP is not a bad target to have. On the contrary, I would say from the government's perspective, it could be slightly underwhelming, number one. Number 2 point, where the money would be invested. Now, it's a chicken and egg story in the sense that if I have to achieve $30 trillion of GDP size by 2047, I would require investable surpluses. Where will they come from? Now, they can come from insurance funds, they can come from banks, but I think going forward, pension funds will have to play a more proactive and a more direct role in building nation's infrastructure. Regarding the distribution among the asset classes, it will depend on how the development story is led. If it is led by the state, then of course the government securities will be predominantly the investable classes for the pension funds also. But if tomorrow, let us say, the growth becomes corporate driven, then of course we have to have a higher exposure in the equity. But at this point of time, it will be premature for me to say that where exactly these funds will flow. Lastly, just to build on the point of achieving the 30 lakh crores of, this 1,000 lakh crores of pension funds. Now, I can at least see a few roadblocks which are basically coming in the way of achieving this target. And the first is, of course, the issue of our low per capita income. So as on date, as we speak, citizens don't have sufficient surplus income to put in the pension as an asset class. Very importantly, I think where I have to say that often pension comes bundled with employment condition itself. So under EPFO, there is a binding condition up to a certain income threshold. A person has to compulsorily buy EPFO scheme itself. Now, while it's a good social security scheme, it may not be the best return earning scheme from the subscriber's perspective. Then there is a lack of flexibility in making any informed investment choice. So if I look at the investment choices which are made available today, to the best of my understanding, only NPS provides the option in which a person can go up to 75% equity exposure. Other pension programs don't have such kind of flexibility. Then the second issue would be that there is from the customer's perspective, there are differing supervisory experience as a pension fund manager, as a record keeping agency. And then there is a large space which is exempted space as per EPFO, which is not appropriately regulated. So these are some of the key roadblocks I can identify very, very clearly. Now, when I look at the third point would be that when I look at the pension forum, I am not looking at a unified pension regulatory space. All I am saying that from the customer's perspective, there must be an umbrella organization which is in a position to provide to him a comprehensive, full position regarding his options which are available to him. Now, closest example I can think of is something which on the banking space, RBI is doing in terms of ULI, which is Unified Lending Interface, or what Government of India already has done in respect of Jan Samarth. Now, it's a common platform in which a customer can go choose the credit product which he wants, and the customer becomes the king. Unfortunately, in the case of pension space, this kind of flexibility is not there with the customer. Now, can we, as 4 or 5 important regulators, supervisors, provide to an average subscriber the same kind of seamless, unified experience? Today, we are not in a position to provide that, and it also accounts for why the pension penetration is low today in India. So my expectation today going forward would be that as and when this forum takes shape, which I am sure shortly will, because it's a government's solemn promise, so it will have to take shape very soon. First thing would be that from the customer's perspective, while at the back end there could be EPFO, there could be PFRD, there could be REDI, SEBI, the customer's experience must be absolutely seamless and comfortable, and which is something which will take care of your requirement as a pensioner. Lastly, I think that going forward, there are very, very exciting areas on the investment front which are opening. I think that there are areas, for example, like climate finance, to which we have to start examining whether we can invest at least to start with some degree of money in the climate finance or the green finance. So these are some of the initial thoughts I had, and I would be more than happy to respond to any questions, any suggestions which we have as we interact with the participants. Thank you.
Thank you. First of all, I must thank Dr. Sahu to ask a very, very correct question and put it in perspective. As Mr. Sahu has very clearly brought out, investment by long-term investors, real money, in India is essentially a supply side issue, much less a demand side issue. There are not enough supply of eligible securities. If you look at the government borrowing program, for example, this year itself, gross borrowing and net borrowing, even in nominal terms, are nearly stagnant. Now, if you look at the demand side, 80% or more of government securities, including SDLs, are mandated investments. And if AUM keeps pace with GDP growth, then you can rest assured that mandated requirement will grow at 10 to 12%. We have seen PF growing at a rate significantly higher than nominal GDP growth. We have seen insurance industry growing at slightly higher than nominal GDP growth. So government securities, we are so dependent on government securities, so that it's something that I wanted to point out. Infrastructure is another area where we can invest, but look at the infrastructure issuances. For example, this year, I have data till this January. One issuance above 20 years, not above 20 years, one issuance for the financial year 2024-25 till January, one issuance of slightly less than 5,000 crore by NAFID. Certain issuances, some issuances around 60, 70,000 for 15 years, mostly the tier 2 bonds by banks and some other players, 30,000 by one particular large public sector bank. Issuers are issuing infrastructure bonds for 3 years, 4 years, 5 years. It's neither here nor there. Insurers and PFs managers do not require 3-year infrastructure bond. And the major problem with with infrastructure bond is the return is sub-SDL. I do not understand why a default free instrument should pay higher compared to an infra bond. So infra issuers will have to sit down with the investors and find a solution to that. You give them value for money. Otherwise, you will struggle. So essentially, as Dr. Sahu put it, it's essentially supply side issue. There are various investment opportunities. We can talk about private credit, we can talk about not NHIT, InvITs and REITs, not enough supply. Apart from NHIT, nobody is issuing InvITs. And NHIT InvITs are lapped up by the investors. EPFO has recently done something there also, but not enough supply. We'll have to find a solution to this supply side issue when it comes to investment. Otherwise, we'll have problem going forward, because as our moderator and other speakers have spoken, growth of pension funds and, for example, annuities in insurance will continue to outpace nominal GDP growth. As a result, the AUM will continue to go up, and if we do not find investment solutions, then we are in trouble. Second thing that we need to keep in mind is that when we talk about insurance, investment, especially for pension funds or annuities for that matter, we have to take care of various specific requirements. It should not only be long-term in nature, it should provide some sort of hedge against inflation if you are planning to, if you are intending to give real rate of return to your retirees. How do you do that? Inflation hedging is no instrument actually at this point in time is available in India. So these are the solutions. Why can't issuers provide such flexibilities in their instruments? Why can't issuers provide an exit route after, say, 5-7 years in long-term infrastructure bonds? Why can't they? These are the suggestions. I'm structuring the sentence as a question, but these are the suggestions I have given to, for example, various infrastructure companies that come to me. Can we think of first 5-year fixed and then maybe reset at the original spread? Something like that. You are asking insurers or PF funds to invest for 20 years, 30 years, 40 years with no exit option. These are the challenges. As I said, AUM under PF and annuities will continue to grow and continue to grow strongly. We have to find a solution to the question that Mr. Sahu put up. It's not easy. There are various issues. We can actually move towards equities, but equity again suffers from the same supply side issue. And then equity has other concerns, Similarly, private credit. Private credit may give you 2-3, but private credit comes with significant risk. Somebody said that they come with substantial risk and ordinary profit potential. I don't know. We don't have adequate data in India to establish or deny that. So there are instruments available. The need is for the issuers and insurance companies to sit down and devise investment products that helps both. So that is my feedback on investment avenues. One good thing is that when market expands, solutions sometimes or most often come automatically. When both sides feel the need, they sit down. Right now, possibly neither side is very desperate. And when it comes to different playbooks and what type of regulatory coordination should be there, there are forums for regulatory coordination. It can be further improved, and as Pankaj mentioned, for retirees, for pension related, I think something is going on, and it may take shape as he says pretty soon. The main challenges, apart from other challenges that we are talking about, is many products, related products, similar products, differ so far as accounting and taxation are concerned. So these are, again, some of the issues that we need to take care. So challenges are there, but solutions can be found. I'm very sure that if as and when that proposed coordination committee is formed, we will very quickly find or try to find the solutions also. Thank you for the opportunity. Thank you.
Thank you. Thank you. Dr. Anand, your turn.
Sir, Indian economy is growing at a very fast rate, 7% plus over the last number of years. And our infrastructure needs are phenomenal. So I don't find that the investment opportunities may not be available going forward. But yes, out of the box thinking is required. At this point of time, the pension funds are investing in the secondary market and to a limited extent in the primary market. But if we look at the global experience of international pension funds, they have joined hands with the private sector and participated in the public-private partnership program in the infrastructure space. And they are able to generate a return of 9 to 10% on a consistent basis. Now, our pension funds at this point of time, they do have a capacity to invest the opportunities, profitable investment opportunities in the equity market, secondary market. But they don't have the capacity and skill set to invest, to join hands with the private sector and invest in the bidding, at the bidding stage itself, in a public-private partnership program. That capacity pension funds have to build, one. Second point I want to make that at PFRDA, we have now increased the equity exposure in a default scheme where the government funds are invested to 25%, 15% to 25%. And our equity universe is also top 200 stocks based on the market capitalization. And then again, we have allowed that they can invest up to 2% of their equity AUM into the top 250 stocks. Means they can invest in 200 to 250 stocks so that they can generate a better return on the investments. And as far as the REITs and InvITs are concerned, I agree with you that limited supply is there of REITs and InvITs. We have also allowed the pension funds to invest in REITs and InvITs, but the kind of issuances which are available in the market, they find that there are very few issuances. And as regards the point on pension forum, I think EPFO is playing a very important role as far as the establishments which have a number of employees 20 and above. But what I think that pension forum, EPFO and PFRDA can take a lead together along with the SEBI and IRDAI, that how can we have a auto enrollment possible in India where the feature of opt-in is there and they can opt out after some time, maybe 1 year. So that I think if we can join hands together, that will be a good point. Thank you. I'll take a pause here.
Thank you, Professor Anand. Now, Amarjit, the people here are from outside Mumbai. All those who are sitting here, they are all from outside Mumbai. But they all look at investing in Mumbai, of which you and RBI are the authority. And you and RBI also have the experience of the coordination, the regulatory coordination from 1992 when you started HLCCFM. So your take on both these questions, particularly the demand-supply mismatch and the regulatory forum.
Yeah, thank you, Sausab, and my sincere apologies. I was supposed to come, but I had to change my plans. But it's a pleasure to be a part of this very interesting conversation. So let me try and build on. I agree with most of the comments that have been made, and I think problem areas and challenges have been very rightly identified. So let me try and build on that a little bit. So obviously this 1,000 crore finding investment opportunities for 1,000 crore is a huge challenge. It's a huge supply side issue which we'll have to grapple with. In fact, in mutual fund space, we have 65 lakh crore odd AUM today. There also we've been at times we've been concerned as whether there are enough investment opportunities for such a large amount to get absorbed. So couple of thoughts here. One is, of course, our listed universe has to keep expanding. When I say listed universe, I mean both in terms of new companies to list and also the existing companies to fund their expansion and diversification needs through market-based financing. So we need more and more companies to raise money. We need new companies to come and list. So that is one side. And we are so far doing well. In fact, our IPO market has been doing pretty well compared to the rest of the world lately. Second part is the regulated, the basket of products which are there in the market, the regulated products which are there, that basket has to expand. And we've been focusing on that also in the recent years. We have a number of products like hybrids, REITs, InvITs, which we've talked about already. We have municipal bonds, and we are trying to create traction there as well. Securitized debt instrument, AIF units, ZCZP, but of course that is a different philanthropic sector and so on. Now if you look at, so two things. One is listed universe has to grow and the product basket has to grow. Now let's look at where most of the investment is happening by pension funds. So I have some data point here. Over the last 10-year trend, if you see, so share of investments in G6 as percentage of total AUM, it has remained in the range of 50 to 55%. This is since January 2014. Share of investment in corporate bonds as percentage of total AUM, it has declined from 36% to 23% since January 2014. The good news is investment in equities has correspondingly increased from 8% to 19%. So as Ramesh mentioned, the current investment pattern reflects that the approach for investing, for good reasons, has been conservative. So in the process, probably the return maximization has not happened. Of course, a lot of focus has been on risk mitigation, which is for good reasons. But as market expands, can we take a little more liberal approach to investment guidelines for investments by pension funds? Just to illustrate, can pension funds be allowed to invest, take positions in derivatives for the purpose of hedging? Can their exposure to hybrid products be increased? I know EPFO has done one investment in a recent InvIT, but can more of that happen? Also, it's a chicken and egg story. When you say that the REIT InvIT supply side is less, but if more investors come in, probably the more companies and the more entities will also come to the market. And we are trying to work in that space as well. We are trying to see how we can facilitate easier raising of money, how we can do ease of doing business, ease of compliance for the REIT and invest sector, and how they can fast track their fundraising from the market. This is on the domestic side. On the overseas side, on the international side, I remember, when we opened up, when SEBI opened up the markets to foreign portfolio investors. So CalPERS of the world, they started investing in our market, and they were big pension funds from US. But our provident funds and EPFO, we were on the fence. We were not very sure whether it's a good idea. So point is that the foreign pensioners, they benefited from the returns on our market. But anyway, things have come a long way since then, and things are changing. Today also, for example, Canadian pension investors have been investing in a major way in the InvITs market. So I guess we will have to, as we grow, we'll have to look beyond the Indian shores, beyond the Indian geography. And I think the pension funds should be allowed to chase returns with, of course, adequate safeguards, irrespective of the geographies. So that was my take on question 1. On question 2, in fact, of course, forum is a great idea. And just to mention, FSDC structure also has scope for discussion on financial sector development issues, apart from financial stability and regulatory coordination, financial inclusion, and so on. So I believe this idea of forum is probably independent of that, irrespective whether it is within that umbrella or separately. I think it's a great idea. And I see it more from the regulatory coordination perspective. I think if we have such a forum, which is having a very sharp focus on the developmental issues, it would help all the stakeholders. So just to give you another example, we want, for example, our REITs and InvIT sector to grow, and it would also be useful for the pension funds to find alternate investment products. So can we talk together and see how we can make it more effective? Let me also give you another example. Now, PFRDA norms, they require that sponsors of REITs and InvITs, they should be rated AA and above. by 2 rating agencies. So if I can submit, the risk and reward is not coming from the sponsor. It is actually coming from the underlying assets which are held by REITs and InvITs. So we need to consider together whether really insisting on sponsors rating helps. Maybe there are some good reasons for doing it, but can we look at that? So if we tweak there, maybe more investment can happen. So issues like this can be resolved in such a forum. Also, for example, PFRDA maybe would like to make use of a fantastic distribution network which has been created under IRDA or SEBI. Can you use that distribution network? How you can use it? How we can leverage each other's strengths? So I think forum is a good idea, but we'll have to see how it evolves. Thank you.
Thank you, Amarjit. I think to these very first 2 questions, we have got a very excellent, insightful perspectives, but I would not like to summarize them in the interest of time. But I'm sure PFRD has taken note of it. The panel recognizes the problems, recognizes the roadblocks, thinks that 1,000 lakh crore is not over ambitious, cannot depend on government securities of 10 lakh, 15 lakh crore, and which will be paying higher rate of interest than the market rate of interest. The other aspect which is important, I just want to mention, is that as Canadian funds are investing in India, because they find this market is quite stable market, attractive market, they are getting good returns. So even if we allow our pension funds to invest abroad, whether we will get a market comparable to Indian market where size is good, stability is good, and we will be able to protect the interests of our pensioners. As regards the forum, I think again excellent ideas. And there are models. One can build on this. I am moving to the next set of questions. Let me start with Amarjit. The mutual fund industry you just mentioned about, that has seen the tremendous growth over the last 1 decade, especially in the from tier 2 to tier 3 cities over the last 5 years. So as pension fund participation from unorganized sector so far is felt to be inadequate, are there any lessons that one can learn from mutual funds and replicate for pension funds?
Yeah, sure, Sausab, I'll take a shot on that. So we need to understand how. So let me start by saying that I believe that mutual fund growth story is a huge success story in our securities market, especially if you look at the trends and data of the last few years. And it is a result of a multi-pronged strategy, if I can say. We've worked on various fronts, and maybe I'd like to share with you 3, 4 where there could be potentially some takeaways for the pension fund industry. So one is the digital infrastructure, and we have ourselves, and also we've motivated the market players to invest hugely in creating a very strong technology-driven digital infrastructure. And just to give you some flavor of what I'm trying to say, apart from eKYC, of course, that is old news, we have a number of online platforms today. So one is MF Central platform, which is a all-in-one investment management platform. I mean, if you go to that platform, you can invest, you can track your investments, and it is very easy to operate. Then we've also we've created a framework for execution-only platforms. That is to facilitate only direct investment, not through distributors. So we've created a framework for that, and a number of players are registered under that execution-only platform. Then we've also recently launched a platform called Mitra, basically, which is a platform to help the investors locate their folios which they might have forgotten over time. So it's a lost and found sort of facility which we've created. It's just become operational, basically tracing the inactive and unclaimed folios. Then, of course, we have the old online scores platform for investor grievances. So I think a combination of all of this has really simplified and improved the access of investors to the mutual fund industry. And also, it has facilitated in terms of easy execution, easy tracking, and easy resolution mechanisms. So probably similar digital tools can be looked at for expanding the pension fund space as well. Second piece I wanted to talk about is how we evolved a strategy 10 years back in terms of how we can take the market beyond top 15 cities. So we came up with a B15 incentive structure where the AMCs were allowed, they were actually given an incentive to go and set up their offices beyond 15 cities. So that was a very useful experiment, and we saw some very good results. So in 2018, we switched to beyond 30 cities. So there we created an incentive structure for AMCs to go beyond 30 cities. And just to share some data there, the share of AUM from beyond 30 cities as a percentage of total AUM, it has increased from 15.7% to 18% in the past 5 years. So this B30 incentive or B15 incentive has been largely successful, and we are kind of revisiting that space. We've observed some instances of some misuse there, some potential misuse. We've seen that some churning happens or some kind of splitting of applications happens to capitalize on those incentives. So we are reviewing it, and temporarily we've kept it in abeyance. Again, pension funds can probably look at this strategy in terms of targeting their investors in smaller towns. Third piece is the financial literacy piece. Again, that has been very, very important in terms of our priorities right since beginning. So mutual funds are required to allocate 2 basis points, 2 bips of AUM for investor education. And 50% of this has to be given to AMFI. So AMFI actually aggregates all these funds, and then AMFI then comes up with their investor education strategy and initiative. They fund out of this money which is given by individual AMCs. This again, I think, has helped a lot in terms of facilitating our outreach and education of investors. Fourth point, and I'll stop with that, it has been, again, our thinking on developing innovative products. So SIP is a very well-known success story, so I need not spend time on that. The systematic investment plan, this has done very well as a product, and now you have close to 26,000 crore coming in every month through that route. That was a February data. It might have gone down a bit considering recent volatility in the market. So we built on SIP now. In fact, we've recently announced Choti SIP. Choti SIP is a 250 rupees low ticket, small ticket size SIP. Idea is to include, let's say, a vendor on the street or somebody who's in very, very low income group and he wants to participate in the market. So this product will help such a strata of population to get included. I think again there is a lesson here for pension fund industry can be designed similar kind of products for which can cater to the needs of unorganized sector. But of course we have to be mindful in terms of financial literacy, in terms of disclosures surrounding these products. I'll just pause with that. The final point, we've come up with another specialized investment product for the investors who are capable of taking higher risk in the market. So that again we facilitated from 1st April this year. So I'll pause with that number of initiatives.
Thank you, Amarjit. I will take a clue from your Choti SIP. Professor Anand, you have been talking about the micro pensions, inclusive old age income security, mostly about the informal sector workers like the gig workers, self-employed and housewives. So how can you suggest a strategy that the pension products that can be made available for this segment of the society?
Yeah. Sir, at PFRDA, the product NPS which has been designed, as was mentioned in the morning by the chairperson also, that even we have come out with a product NPS Vatsalya. So where not only for the adults, but also for the children, 1. 2, for gig workers, those who can afford it, for them a national pension system product is there, which is very flexible, portable. Only one contribution has to be made in a year, so they can save at any time. The farmers can come in when they have a harvesting season, they can invest at that time. The self-employed people can invest. So a lot of flexibility is there in terms of contribution. The product design and portability is there in case of gig workers also, so portability will be a very positive advantage. And we have at a PFRDA role of market development as well as to protect the interest of subscribers. So when we talk of market development, promotion and development is playing an active role in reaching out to the corporates, reaching out to the subscribers through our own means and through the banks, regional rural banks. We are trying to reach out so as to achieve the objective of the pension coverage. That's why if we look at the Atal Pension Yojana, there the enrollments have gone up to more than 6.5 crores, which is quite phenomenal in the last few years. So all out effort is being made on promotion and development of product through communication, through financial literacy also. A lot of training programs are being done on financial literacy, retirement planning, and through this we are trying to reach out to the masses. Thank you.
Yeah, please.
I think, sir, the one missing piece in the entire jigsaw puzzle is the systematic part. So when we are talking of the financial planning, we are focused too much on the systematic investment being made on a periodical basis by an investor. Now, considering the fact that we have a large unorganized sector to address to, the systematic plan may have to be given a bit more flexibility. People don't have regular wages through which they can make those contributions. So I think as regulators, as government, one challenge would be that can we think of a way through which a person can make contributions based on his choice? This will be a difficult piece in terms of planning of pension product, but I think that we need to move in this direction only because the portion of population which remains untapped is largely in the unorganized sector.
No, I think that is entirely possible, and security market shows the way. In the morning session, secretary, and also there have been some discussion about, secretary spoke about, he emphasized about the increasing public awareness, financial literacy. These are crucial to building an inclusive pension system. But the financial literacy is something, and there are many such things. These are like the public infrastructure, where in economics we say that social costs exceed the social benefit. Sorry, private costs exceed the private benefits, and these are likely to have underinvestments. Similar could be the technology, similar could be the distribution system, technology platforms. How do you think that we can have a coordinated approach for investment on this public infrastructure? Public infrastructure for you.
So I think that all the speakers have given some very valuable points, but I think the missing piece is that we still have not thought in terms of opportunities which might arise in the investment space. So let me give an example. There are various sectors which are looking for investment. So to give an example, one ripe sector could be aircraft leasing. Right now, if I look at the total aircrafts which operate in India, we have approximately around 750 aircrafts which are registered with DGCA. Now, we expect this number to go up to 3,500 to 4,000 over next 2 decades. Now, this ramping up of the aircraft capacity or the airports to support it cannot take place without any active involvement of the pension fund managers. Right now, we don't have right regulatory capacities and, as a matter of fact, investable surpluses for financing the aircraft leasing, or for that matter, even the ship leasing. Now, as and when these opportunities arise, they would create investment opportunities for every sector of the economy, including the pension sector. At that point of time, are we in a position to invest the pension funds in these sectors, keeping in place the right kind of mitigants? These are the challenges which we have to face, sir. The point number 2 would be that, sir, if we have to achieve the target of 30 trillion, I think we have to be slightly more optimistic about the investment opportunities which would come up during the course of next 2 decades. That is my take, sir.
By public infrastructure, I gave you the example of financial literacy. That is something, if somebody invests in that, all can benefit. But no one wants to make investment because the benefits to me is much less than the costs I incur. So in that sense, I need the infrastructure needed for all pension products and services. Who will make investment and how this can be coordinated?
So are you trying to say in terms of the common infrastructure
yes, like
across?
Financial literacy.
Okay.
Yeah.
Okay. So right now, the literacy bit is something which is taken care of under the FSDC platform. We have this platform called NCFE. Now, I'm sure that as and when the forum takes shape as part of its development effort, the literacy part for the pension products will also be within its remit. So at this point of time, I would just pause at that, sir.
Thank you.
So sorry, I got the question wrong, sir.
Yeah, no problem. Thank you. Thank you. Now you are the insurance person, expert in uncertainties of the market, actually, the market volatility and the demographic changes. So how do you think that you can develop the annuity or pension products to provide long-term financial security for the retirees?
Thank you. The thing is that to begin with, we are so engrossed in talking about emerging risks that we have the tendency of sometimes forgetting that the biggest protection gap that emerging economies are facing today is pension gap. So, as Dr. Sahu mentioned, there are 2 key issues. One is demographic shifts and second is cultural issues. So, we all know about how quickly the demographic dividend is going to turn against us. But thing is that another cultural or social transition is happening, that is India is more or less now in urban centers at least is a nuclear family. As a result, the traditional social security net is no longer available. So for majority of us going forward, maybe in 2 decades, 1.5 decades or even earlier, pension is a must. Post-retirement, steady income stream is mandatory. Second thing is that people are living longer than actuarial estimates actually, which of course is a backward-looking calculation. So now if at 60 the life expectancy is 20 years today, maybe in 10 years time it will be 25 years at 60. How do we fund that? And third is that majority of our pension or annuity schemes actually are offering lifelong pension. And to add to that, lifelong pension with some sort of guarantee, possibly inflation indexed, plus defined benefit if we move towards defined benefit. So these are the challenges we are facing. we know that as the investment horizon. So insurance is different from other sectors in the sense that majority of the risk comes from liability side. In banking, the risks are essentially asset side risk. So, and then we are going for hyper-personalization, partial withdrawal, conditional withdrawals. These add to additional overall risk in terms of liquidity risks. So pension systems are vulnerable, or annuity systems, to economic downturns, market crashes, large changes in interest rates because of the market risk, and as I said, longevity risk and change in demography are other risks. So key challenge is how do we ensure that the extended, what we should call golden years of our senior citizens are financed without burdening future generations. And solution, as in any other case, is one at product level, second is risk management or ALM level, and third is governance level. So if I come to product strategy, we need to innovate. That is the only solution we have. Pension essentially is transforming the current income or wealth to future income. So the basic feature of transformation, maturity transformation, must be adhered to, and that is it should be real. So how do we provide a real, maybe inflation indexed, lifelong solution that requires innovation? Can we think of deferred annuity? We have examples. For example, in the US, we are talking about qualified scheme where you can actually select that my pension will start after, say, 70 years. I don't need, people nowadays work till 70. So my pension will start at 70 or 75 years, qualified longevity annuity contracts. Can we think of pension schemes where there is no survival benefit? I mean, it looks slightly cruel, but that ensures that pension pools remain funded all the time. So for example, God forbid, if a member dies, the benefit actually will go back to the pool, so existing people will this thing. This was a very controversial thing and perhaps was banned in the US in 1970s, but it is again taking shape because possibly that is the need of the hour. Canada, especially, it is taking some shape, it seems. But similarly, inflation indexed income, if we want, then we'll have to provide enablers to the pension managers and annuity providers to use derivatives. Inflation indexation is very easy to say, but it's extremely difficult to hedge the risk in a country like India. You do not have a proper hedging mechanism. We'll have to develop that. In the meantime, we can go to some other instruments. Similarly, longevity cannot be covered except by the insurers. And insurers also, I'm not sure, many people believe that since they carry the mortality risk in their books, so they have a natural hedge against longevity risk. I don't know. Another product that we can think of, but this again requires a cultural shift. Till now in India especially, we think of income with savings. Can we think of income without assets? So can we think of, for example, a product like home for pension? It's essentially a reverse mortgage annuity product. It's pretty popular in some developed jurisdictions. It provides annuity or pension lifelong, and it has certain other features. Banks are trying to sell it for last 30 years, but it's essentially not their product. How they cover longevity risk, how they cover negative equity risk in real estate, it's extremely difficult. Inclusivity, Manojji has already spoken about, so only thing that I would add is that we already have a used case scenario. Can we build upon, for example, API? Can we offer hybrid or bundled product, for example, APY plus Jan Suraksha schemes addressing multiple risks across life stages? And missing middle, we keep talking about. Missing middle is not easy, whatever we say. with $2,500 per capita income, it's extremely difficult to buy anything. But we can think of innovation. Can we think of collective security or hybrid funding model, a sector-based approach for risk pooling, for example? We have seen this experiment in some countries, emerging economies. In India, in a very limited manner, in credit, we have seen pooled guarantees, co-funded pension pools, for example, where both the employers and employees provide something, and maybe in certain cases, if its social benefits exceed the cost, then government may also come in. These are all ideas. Can we think of pension as a part of inheritance planning? When we think of inheritance, we think of transfer of assets. What about transfer of income? NPS Vatsalya is a great step in that direction, but we need to do much more. NPS Vatsalya is slightly limited in that sense. But these are the things that we actually can think to improve the pension penetration and acceptability also. Thing here is that for these things, we need a very strong ALM risk management framework. Whatever personalization we do, whatever flexibilities we provide to the pensioners, all come at cost. Unfortunately, many of the risks are totally not hedgeable. That means those risks are priced, in a different manner completely. But even simple ALM risks, how do we manage it? We need a proper ALM infrastructure with an eye on ALM duration gap and convexity. I believe that in India, RBC framework and Indians that we are trying to implement in IRDAI will help in balanced ALM management. Can we think of, especially when the rates are going down, liability-driven index, even if you have a totally matched ALM, you can still have unmatched interim cash flows. Can we part desensitize the portfolio to rate movements? There are very few instruments here, but equity, high yield credit, if the credit spread is significantly high, can actually work like equity. Real estate, many people believe, can actually be a good thing in a risk optimized manner, of course. And optimum allocation to assets that act as inflation hedge, maybe gold, maybe real estate, in which, for example, NHIT actually does provide some hedge against inflation. It's inflation linked to some extent. So these are some of the things. And then unified governance, we have already spoken, Pankaj ji also spoke about. Can we have an ecosystem with embedding pension security, an interoperable pension insurance ecosystem? Amarjit Singh Saab also spoke about it. One single platform where it is seamless. Can we standardize KYC risk framework, product definitions to begin with across regulators? Can we harmonize pension products to be more accessible, portable, and adaptable? The problem here is that if we want to do it across regulators, we'll have to also examine the accounting and taxes and regulations, etc. also. I'll stop there. I think I've taken much time. Thank you.
Yeah, thank you. But a lot of takeaways, and particularly the one we all want income without work. So, but taking a clue from you, going the vulnerabilities beyond you discussed, and which is a slightly out of syllabus question for you, Mr. Krishnamurthy, is that these annuity providers, pension funds, they will have stress sometime in their life. 1 in 100 may have this stress. They could be insolvent. Or the companies where pension funds or annuity people are investing, those companies may also get stressed. So do you think that there is a need for some kind of a mechanism, like in case of banks, we have that some minimum protection of 5 lakh, and which is considered also inadequate. But if you have some unfortunate incident like that, an annuity provider dies or a pension fund dies, how do you take care of the interest of pensioners?
Very good question, I think, and a very valid one. particularly when we are talking about expansion of the pension space. Obviously means more providers in the ecosystem, and the ecosystem then becomes itself a risk to be considered. And as we discussed, most of the pension products are long-term in nature. Today, for example, an entrant into the job market at the age of 24, he is not thinking about 36 years later. And when the panelist was talking about defer my pension to 70 years, that is nearly about 46 years later that he will start getting pension. So now during this period, there is a concern that the providers must be viable, they must sustain themselves, and there has to be regulators who are watching with an eagle eye whether the whatever contributions are going in are to some extent protected. So in that context, I think some kind of minimum, I would say, guarantee or at least a floor similar to what we have in the banking sector as protection for the deposits and all that. I think something like that I think should be considered. I think that will be something which will be very useful. We also heard from a lot of about other products and innovation in this sector. I'll just take this short opportunity to talk about what EPFO is doing and what EPFO is planning to do. So as I said, we are today reaping the benefits of the demographic dividend. Our inflows far exceed our outflows, so our corpus is expanding at a very rapid pace. So now I think we are in the cusp of change. We are really now looking into what was referred in terms of a common digital platform or an infrastructure. We need to really go into state-of-the-art information technology. We need to have this forum, which I think, taking a leaf out of SEBI's and the mutual funds book, the mutual fund Sahi Hai campaign kind of a story, which uses your investor protection, education and protection fund kind of contribution, 2 basis points was talked about. Now these are some kind of initiatives which can go to a common forum which can develop sustainable, I would say, financial literacy, penetration, assistance for pension products, can help in setting up of technology interventions which can help delivery of pension products. And I think very validly pointed out by Amarjit was the growth of the mutual fund industry, and in fact in the recent past has been from startups who have really used I would say mobile technology and the mobile app kind of initiatives to really penetrate very quickly. I mean, if you recall earlier, the biggest challenge was the mutual fund distributor. Now the distributor is no longer in the picture. It is direct interface between the consumer and the market, and that has been enabled by these startups who have used technology in a great way. I think there is a good scope for something innovative in this sector as well. And EPFO, I'm sure, will going forward is going to take a leading role. We have the feet on the street for compliance. We have a large, I would say, in terms of the ability of our skilled manpower. So our strengths are well known. We have a credibility of a 72-year-old institution. I think in this sector, I think we really have to play a large role. So I think EPFO will surely love to collaborate with PFRDA and others to achieve this goal.
Thank you. Thank you so much. Now the floor is yours. Please ask very pointed questions to your favorite panelist.
Good evening all. Good evening all. My name is Devesh Mittal. I work with PFRDA. Many of the times we find that when a person joins a system, an employer, his or her salary is less, and they are bound to cover under the EPFO part. The employer must deduct the provident fund and submit it to the respective EPFO. However, over a period of time, when a person grows in the ladder, the salary increases. And if the option of opting out from the EPFO and to continue that corpus under the NPS, can it be a good option? Because under EPFO, there's a amount given in the return part is 7 to 8%. Whereas under NPS, the options of getting the amount in a build way are more than 9 to 10%. So can this be possible?
But we can make the EPFO equally attractive or even more attractive than NPS. But question is for you, Mr. Krishnamurthy.
So I think it's a challenge for EPFO as well. As I said, EPFO is a 72-year-old institution. It carries its own credibility. Now, of course, as was mentioned, you have there is an issue of choice. Today, the employee or the worker has multiple choices. NPS is one of them. You have private annuity providers and other pension products which are being offered. So EPFO will have to innovate, and EPFO is going to innovate. Number one, in terms of obviously not only in terms of just chasing high returns. That is only one part. If you look at the EPFO returns, they have been very stable, very high relative to other fixed income opportunities. So it has its own strengths in terms of, I would say, from a pure play long-term investment perspective, in terms of the power of compounding. It has its own benefits. NPS will have its own strengths, but it brings that issue of volatility, and since it is an NAV unitization based method, there's always going to be this uncertainty when I retire, whether my returns are going to be protected or not. So every option has its own plus and minus. But largely, if my take on your question is interoperability. Whether there are options available going forward for switching between providers, different options given to the employers as well as to workers. I think definitely that will be something in future which will definitely evolve. And I think that we have to give the choice to the citizen in terms of multiple opportunities. I may be very good at certain things which probably others may not be able to do that. So that option is always going to be there. And as I said, EPFO has to innovate in terms of getting better returns, making sure that we have close to about 8 crore subscribers, more than 7 to 8 lakh active establishments contributing. So in terms of growth, there is a full world of opportunity for EPFO. So we will go all out in terms of innovation as well.
Thank you. Thank you. Yeah, please.
I think the important piece is also that right now the conservative choices are being made both by PFRD as well as by EPFO. And so as the asset class grows, the biggest challenge would be to basically educate the investors and the stakeholders that other asset classes are also capable of giving you stable and risk-free returns, which is the biggest task which we face as regulators, as government, and as supervisors.
Yeah, one question. So basically, I'm directing my question to Amarjit sir and Secretary DFS. Basically, sir was mentioning the foreigners are reaping the benefit of our growth. Basically, even when I was submitting my doctoral thesis in pension economics, what I observed was that EPFO as well as PFRDA both were allowing 15% allocation to equity. But you all are regulators, but that intermediaries who are executing, basically fund managers, they were putting around 10% of that money into equity. And to surprising note, at that point of time, I observed that for top 10 companies on the basis of market capitalization, they were receiving around 60% of money, and top 20 were receiving 85. So we are talking about product innovations and jumping the growth in the return, but we are not taking, as Amarjit sir himself was mentioning, that we were kind of doing risk mitigation many a time, but optimization of return is also one of our responsibility. Or is it may be a bit controversial, is it that government has found a low cost source of fund that continuously getting for infrastructural growth?
Even I would like to respond.
No, the question was directed to Amarjit and Mr.
So
Sharma.
I'll take the question first. So I'll take the question first.
Yeah.
That number two, I think that if you look at the total debt size of government, I think that pension fund managers, while being significant, are still not the only source of pension funding. So I don't think that we are banking on pension funds for low cost money. Number one. Number two point that you have to keep in mind that if I speak of PFRDA, then there is around 10 to 11 pension fund managers. Of course, all of them have their own risk mitigation measures and all of them do their own risk-reward trade-offs. If an investor finds that the PFM in which he's invested is not giving him sufficient returns, then he has the option of moving out. So we have to keep in mind the fact that if somebody is being too risk-free, is being too risk-averse, then the investor has a choice of moving from him. So that liberty has been given in the PFRD architecture of choosing the PFM in which the returns can be optimized depending on the risk appetite the investor has got. Amarjit, you would like to supplement briefly?
I think Mr. Sharma has very nicely captured it. So I would only say that it's a journey. We've evolved over time. In fact, earlier what EPFO was investing in equity was much less than what they are doing today. In fact, I gave that data point also. It has gone up from equity investment has gone up from 8% to 19%. Essentially, it's a risk-return trade-off, and the pension fund has to take care of the risk appetite of the investors who are invested in the fund, and investors are free to move out, and those choices are now becoming available in our market. So I'll just pause with that. Yeah, thank you.
Professor Anand, you want to supplement?
I think I would like to respond.
Quick supplement.
See, the investment guidelines at PFRDA, they have been formulated considering prudent person principle. We should be mindful of the fact that these are the pension savings, retirement savings of the people. And then too, when we formulated these guidelines, we have looked at the concentration risk should be avoided. So we have laid down the promoters' norm that limit should not exceed, non-promoters norms, all those it has been addressed. And if you see the returns on a consistent basis, persistency has been maintained. 9.5% return in case of a central government scheme, equity 15% return. So diversification objective is there. Of course, risk return optimization, investor can do at his or her own level in all citizen model. But in case of government sector, as JS pointed out, from 1st April 2019, the choice of pension fund has been given to the subscribers. So they can make, and then life cycle 25, life cycle 50 is there for the government sector, and for the all citizen model, life cycle 75 fund, and now we have come out with a new research-based fund, a balanced life cycle fund. Now, which is again tapering off of equity starts not at the age of 35, but at the age of 45. So the objective is, yes, risk return optimization, but at the same time, prudent person principle. Thank you.
Thank you. This side.
Good afternoon. My name is Vineet Nahata. I belong to Power Guild Treasuries. I would like to make an observation of regarding Dr. M.S. Sahu's point that the issuers of annuity, if their financial position goes haywire, then what happens to the future payments receivable by the pensioners? There is a concept of credit default swap. In countries abroad, this is being majorly used. And insurance companies and large institutions, they offer CDS or credit default swaps. So the issuers' financial vulgarity or the financial creditworthiness may be, say, countered by taking this risk cover, which unfortunately does not happen to be a case in India. Credit CDS is not prevalent in India. Second is, sir, we were comparing EPFO with the other pension schemes. So one distinction which clearly the EPFO makes EPFO stand out happens to be its zero risk nature. The money which is invested in EPFO, the subscriber contribution which is held with EPFO happens to be carrying a sovereign guarantee. Under no circumstances the principal can be lost. The second thing is that if the subscriber's money cannot be attached, even if a subscriber has bank outstanding or any other creditor, PF money can never be attached. So these 2 points are there which place it.
Thank you. We have noted your suggestions. Yeah, it requires a lot more work on this.
I think that even the EPFO money, sir, to the best of my knowledge, has no sovereign guarantee.
But in any case, we are talking about market actually. We have to move away from this kind of guarantee business. We are living in a market and we are talking about 1,000 lakh crores of investment. All right, thank you. Any questions? Madam, we can have 2, 3, 4 minutes more?
Yes, sir.
2 questions.
Sir, can I
PFRD
ask?
letter. That side.
Sir, can I ask? Sir, my question is to Amarjit, sir.
PFRDA.
Yeah. I'm from PFRD, sir. My name is Ashok Soni.
Yeah.
My question is to the Amarjit Singh. Amarjit, actually in India, the corporate bond market is highly concentrated to the higher rated paper, mostly AA or AAA. That too, moreover, the tenure is also 3 to 5 years. Considering these situations, do you not think that there is a need to develop the corporate bond market in India actually?
There are standard answers for this, okay, Amarjit.
No, in fact, who will dispute that? We are, we've been focusing on further development of the market in the last few years. It is a bit of a chicken and egg. There are liquidity issues, and we have tried to address, we brought in a number of interventions. We brought in EBP for primary issuance. We brought in RFQ for, more transparent trading systems. We've also got other regulators to push their regulated entities to participate on those platforms. So there are a number of steps. In fact, it's a big subject by itself, but I don't disagree. We need to develop that market, and we are working on that continuously. Thank you.
Yeah, this is like you can pull the horse to the pond, but you can't make it drink.
Yeah.
Madam?
It's a very short question, and this is to CEO EPFO. So you mentioned in the beginning that there is a problem that the subscribers are all withdrawing their money prematurely, and that's a major problem with EPFO. But I see that, EPFO is making more and more easier for the subscribers. So they have probably introduced UPI, as a part of subscribers' seamless experience. And this limit was 1 lakh, and now I see these ads which say that it is being increased to 5 lakhs. So, sir, there is this contradictory thing, So I just wanted to know the intent, sir. Thank you so much.
So, excellent question. So, I don't see that as a contradiction. The issue is that as an institution, we have to ensure that each and every one of our members is able to have access to his or her funds within the legislative mandate of under what circumstances some withdrawals can be made, what are the eligibility criteria for withdrawals and all that. Over a period of time, we are now going to use more and more technology in order to facilitate easy access to his funds. Now, the flip side of that, obviously, maybe in the short run, is that people think that since I have access to funds, let me actually draw down. But it is the same thing as your association with a savings bank account. Just because you have an ATM card doesn't mean that you withdraw each and every paisa from your bank account. You let it be there. I think the flip side of that is that EPFO will have to also start educating all the members about the need for savings, for social security. And I think once the confidence of all the members increase in the fact that whenever I want it, it is accessible, then probably that the tide will turn. The second point I want to emphasize is that contrary to maybe most of the people here, the EPFO is, I would say, the bulwark of all the blue-collared workers. The lowest earning members of the formal sector invest their money in EPFO. So their needs are very different. And I would say that people earning 15,000, 20,000, 30,000 rupees per month, we cannot sit in judgment saying that, no, you can't withdraw, because they may have illness, they may have certain emergencies for which they want their money. And that is one of the promises that we make to the member, right? That your provident fund is available to you in case of need. So I think it is both ways. I mean, I think we should stand as the last pillar for them for support. But at the same time, we would really encourage them. And when I say encourage them to continue their savings in the long term, this is by ensuring that we provide the best of facilities, the best of services, the easiest of access, the confidence that my money is safe and it's growing. I think we'll see that, pattern changing. Yes, we will move towards higher technology adoption, but I think it'll benefit all members in the long run.
Last question, madam. Mike here. You want to be last?
I'm Kaveri Deshmukh from Central Depositories Services Limited. A part of my question relates to tapping the untapped, unorganized sector. Like we were discussing of innovations. That takes us to financial inclusion drive that banking industry started, say, around early 2000. And that time, the focus was on innovations like business correspondent model or cross-selling among organizations wherein insurance products could also be sold by banks. Can a similar innovation style be adopted in terms of pension products to promote more people going for pension products in terms of unorganized sector? And in terms of organized sector, I would say, where exactly are we standing in terms of having more and more of dematerialization of pension assets as such? And do we have such examples on global lines? Like, do we have any global examples of dematerialization of pension products? Because that would make it seamless.
Globe copied dematerialization from us.
No, sir.
No.
No,
I
sir.
mean, for this audience and for you, the word demat has is contribution of India. World copied dematerialization from India. Okay.
Yeah. Regarding your first question, banking correspondent being requested to, sell the pension products, we recently reviewed our regulations. There, in a point of presence regulation, we have allowed banking correspondents to be pension agents. So that channel, as I mentioned earlier, we are tapping all the channels, be it a banking correspondent, be it through banks, regional rural banks. So we are trying to reach out directly as well as through banks to the workers in the unorganized sector and to make it sure that pension benefit reaches to the last mile. Thank you.
Yeah, your second question, what does a depository do? It does not really dematerialize. It only does accounting entries for ownership records and transfer of securities. That is all it does. And that is why, if you recall, the CRA work was initially given to an NSDL. So actually here we do not create a physical certificate and dematerialize it. We have started with an accounting entry only. And today Protean is doing, CAM is doing, others are doing. Here there is no need for a dematerialization. We have bypassed that stage actually.
Ajita Jaggi, ACC pension from EPFO. I have a voluntary NPS account. So my question is from Dr. Anand. Right now the POP, what they are charging, that seems to be extremely high. When I transfer to NPS, I have to pay 50 rupees. When I transfer 10,000 for investment in NPS, 50 rupees is deducted from my account. Whereas if I invest in mutual fund or I invest in share, I can simply transfer through UPI and I need not pay anything. So unnecessarily, and this 50 is too high. At the initial stage, obviously the technology was not so much in an advanced stage, but right now that 50, it really looks too high. So whether PFRDA has some plan to reassess that and reduce that.
Yeah.
Thank you, sir.
Thank you. Thank you for that question. Madam, you will appreciate that NPS is a low-cost product. If you look at the investment management fee, the custodian fees are almost not there, and the trustee bank and CRA charges all put together in the all-citizen model is a 9 basis point, excluding distribution costs. You are talking about distribution cost. Now, you have opted for a channel which is a point of presence. Recently, we have reviewed POP distribution charges, and we have said that minimum is 0 now. We have earlier minimum 50 was there. Now we have done away with minimum charges. Now we have now laid down only the up to this much. So thereby, you know, it is again up to the subscriber to negotiate. Corporate subscribers are able to negotiate better vis-a-vis individual subscribers. But your point is well taken that there should be a forum whereby, you know, uniformity can be brought in the POP charge structure for the individuals. Second point, the all citizen model, the subscriber has a choice to join through the ENPS. Now, if you look at the ENPS, now ENPS has a 0 transaction cost as far as distribution channel is concerned. So I think your point is well taken. We'll look into it. Thank you.
So thank you so much.
Last question, sir. Possibly.
You can ensure that?
Because you have already given the last questions to everyone. So I think I'm the last one, sir. Thank you so much. Good evening all. My name is Arup Sarkar and I'm from Shriram Life Insurance, annuity service provider. My question is from the standpoint of the retirees. So whenever I visit the retirees, maybe possibly Dr. Sahu will be able to answer this question because he has introduced himself as a pensioner on the beginning of the session he has said. See, what the retirees are saying, see, once I'm purchasing the annuity as a superannuations, which is the minimum 40% as per the statutory norms, the ASPs are offering in terms of return of capital and without return of capital is 7% and 9% almost, right? Now what they are saying, why you don't index the inflations? Because they are calculating in such a fashions, so over a period of say 20 years down the line, if I'm going to alive, so my source of income is averaging out mathematically. If you see, it's not 7%, it will lower down to 4.5% to 5%. So my question is that as a regulator or maybe as a financial fraternity, how we are going to address this? Because this is the biggest rebuttal which we face as annuity service providers from the retirees. I'm not saying this is the only source of income what the retirees is going to have. This is one of the important source of income over a period of 15 years, 20 years, till the time he is alive. So this is question number one. And second is, can we work on giving them some sort of health insurance kind inbuilt with this product? Because if I am going to live for another 15 years, how I'm going to meet my health cost or the crisis? So can we work on this? So if I can get some good answers so that I can, thereon in down the lines, I can address these rebuttals.
No, I don't think there is any clear answer to this problem. Essentially, you are saying that have indexed pension indexed to inflation, which is not actually a market concept. Probably you can handle it to some extent through monetary policy. If you can manage the inflation, manage the interest rate, there can be some success, but there cannot be any insurance against inflation. And as regards me, I am a pensioner, I am a beneficiary of that indexed pension actually. So thank you. We should close this session. Thanks to the panelists for a very, very engaging and insightful discussion. And I am sure the audience has benefited as much as I have. Let's give a big hand, big applause to our esteemed panelists. And thank you, PFRDA, for this opportunity.
A big thanks to our incredible panelists for this engaging and thought-provoking discussion. Your expertise and perspectives have truly enriched our understanding on the topic. To felicitate our panelists, I would like to invite Mr. Rajesh Mohan, General Manager, PFRDA, to please present a token of appreciation to Dr. M.S. Sahu. Now, I would call upon Ms. Priyanka Gupta, DGM, to present a token of appreciation to distinguished panelist, Mr. Pankaj Sharma. Further, I would call Mr. Ismail Salam, DGM PFRDA, to present a token of appreciation to Mr. Ramesh Krishnamurthy ji. Also, I would invite Ms. Kavita Singham Xavier, DGM, to present a token of appreciation to Mr. Rajay Kumar Sinha. Please, Kavita. I would like to invite Mr. Sudhir Singh, DGM PFRDA, to present a token of appreciation to Dr. Manoj Anand, WTM Finance PFRDA. To Amarjeet sir, sir, if you are listening, we will deliver your memento soon. Thanks for joining online, sir.
Thank you.
Sir, can we have the group photograph of the panel? Let's give them a huge round of applause, please. Ladies and gentlemen, as we wrap up for day one of the conference, I would like to take a moment to thank each and every one of you for your active participation. Your presence here is a testament to your commitment to learning and progress. It is your participation that transforms a conference into a vibrant space for dialogue and collaboration. Looking ahead to tomorrow, we have an exciting lineup of sessions and research paper presentations. So be sure to check the agenda and join us bright and early for another day of learning and collaboration. Thank you again for being a part of this conference. Enjoy the rest of your evening, and we'll see you tomorrow. Thank you.